Thanks for taking the time to check out this course. Let me start by introducing myself. I am Yash Utmani, founder of IndianInsight.com, a stock advisory and education firm. I have passed all levels of the CFA and FRM certification exams. I have close to 8 years experience in trading different asset classes in international markets. Also, I have been successfully investing in the stock market for close to a decade. My most recent successful market calls include the surprising rally of gold in 2016 and the even more surprising rally in the stock market. You can check out my blog on indianinsight.com for more information on my services, which by the way are registered with the market regulator. I have created this course in response to people approaching me for their many queries on the stock market and also their queries on how to start trading in the stock market. This course is essentially divided into three areas. The first three sections in this course answers queries by beginners on the stock markets. Here you will find answers to most of the beginner level queries like what is a stock or a share, what is a stock exchange. I will also be answering some queries related to money management. For example, questions like I have less money, should I start trading in futures and options? Or another commonly asked question, how much money should I invest in the stock market? And many more questions like these. I have covered close to 25 to 30 most frequently asked questions by beginners in this section. The next three sections deal with the financial statements. Specifically, you learn the basics of financial statements so that you can read and understand the financial statements of companies. You will also learn how to perform a common size analysis of financial statements, and you will also learn how to perform the financial ratio analysis. These tools will help you judge the financial and operational quality of any business you are looking to invest in. After this, the next few sections will deal with technical analysis. Specifically, you will learn the charting basics, gaps trading, support and resistance concepts, trend lines and trend channels, and technical indicators. These tools will help you in short term trading and they'll also help you make investments at the right price. What is more, these tools can be applied to any asset class and not just equities. The last section will introduce you to one of our favorite trading patterns, which by the way we use to predict the recent rally in gold prices. So as you can see, there is a lot of valuable content waiting for you on the other side of this lecture. I urge you to check out the detailed curriculum and I hope to interact with you a lot through this course. See you in the next lecture. Welcome back. Let's start by understanding how you can keep track of a simple business. Let's say you have $10,000 in savings and you want to start a manufacturing business. In order to set up a unit, you need to buy a place. Let's say you get a place for $3,000. Let's write this down in order to keep track of money. So you write down land/building, $3,000. Let's say you also buy machinery worth $3,000. Apart from this, you need money for raw material, employee expenses, and other miscellaneous expenses like electricity bill, office supplies, etc. To meet these expenses, you keep $4,000 in cash with yourself. By writing this all on one side, you know how you have allocated your money. In order to keep track of the original money you started with, you create another column and write down this amount of $10,000 on the right side here. In accounting, the term owner's equity is used to denote this sum. This table here can help us keep track of our investment, and this table is actually a simplified balance sheet. By looking at this, anyone can say that $3,000 was invested in buildings, another $3,000 went into machinery, and the rest of the money is held in cash. All these items on the left side of the table are known as assets in accounting. Since the money for all this came from the business owner, he owns all the assets of this company, and this ownership is denoted on the right side of the table as owner's equity of $10,000. By comparing the sum totals on the left side and the right side, we can be sure that we have accounted for every penny of owner's money. This was an example of a simple balance sheet. In the next video, let's complicate this a little. In the last video, we assumed that you started with $10,000 in savings. Now let's assume that instead of $10,000, you have only $8,000 in savings. Now assuming you want to start the same business at the same scale with exactly the same assets, you are now short of capital by $2,000. So how do you fulfill this shortfall in capital? One way is to take a loan of $2,000. Again, in order to keep track of money, we are going to write this down as borrowings on the right side of our balance sheet. So on the right side, we write borrowings $2,000 and owner's equity of $8,000. This balance sheet now reflects the fact that you don't have complete ownership on all the assets of the business. In fact, now your ownership is only limited to the net assets of the company. Net assets is essentially the value of assets after settling your liabilities due to borrowings. Hence, net assets is defined as total assets less total liabilities. This is so because the business has an obligation to people who have lent you money in the hope of receiving interest over the borrowing period. They also expect their money back once this tenure of the loan is over. So if you were to liquidate all your assets today, these people have the right for their money to be returned to them, and this right comes before your right to these assets. Accordingly, the value of your equity is equal to net assets of the company. Let's now complicate this example a little further. Say for some reason, you now decide that you only want to invest $4,000 instead of your original investment of $8,000. But you also don't want to disturb the current activities of your business by reducing the size of your business or by borrowing more money. One way to achieve your goal is by bringing in a partner who will invest the remaining $4,000. In return, he will become a part owner of the business. This is where the concept of shares or stocks comes in handy. Shares essentially represent a partner's percentage interest in owner's equity. For example, in this case, the partnership can be represented by an agreement which might state that you own one share worth $4,000 and your partner owns one share worth $4,000. This arrangement also clearly says that since you own one share out of a total of two shares issued by the business, you have 50% ownership of net assets of the company. What this also means is that each shareholder has right to 50% of the business's net profit. This net profit is obviously arrived after paying the borrowers the interest due to them on the loans. Hence, here you are entitled to a share in the profits of the company after the lenders have got their due. By making this arrangement, you have managed to release your money without affecting a running business. So theoretically, shares help in transfer of ownership of business from one person to another without affecting the day-to-day operations of the business. Now that you have developed some understanding of what is a stock, it's time to formally define what is a stock or a share. We'll do this in the next video. Welcome back. In this video, we are going to define what is a stock and what is a stock market. We are also going to look at who all participate in the stock market. A stock or a share represents a fixed percentage ownership in a company or business. For example, if a company has issued 100 shares and if you own one share, then you have 1% ownership in the company. What this means is that you own 1% of net assets of the company. You also have the right to 1% of the net profit of the company. Now that we have defined what is a stock, let's define what is a stock market. A stock market is a marketplace for stocks where willing buyers and sellers of stock come together to trade with each other. This trading may happen either on a stock exchange, where the exchange manages the risk of trading, or the trading may happen privately between two willing parties. Stock exchange is essentially a platform or a network of computers where buyers and sellers transact in any security. We will cover stock exchanges in greater detail in a later lecture, but if two parties decide to privately trade a stock that is listed on exchange, then they are obliged to register their trade with the exchange. For the purpose of this course, we are limiting ourselves to stock trading on exchanges. When it comes to stock market and stock exchanges, the trading of stock may happen either in the primary market or in the secondary market. We cover this topic in detail in later lectures. For now, let's look at who all participate in the stock market. The various participants in the stock market can be broadly divided into two categories based on the quantum of their investment and also the complexity of their investment strategy. The first participant we look at is the retail investor. These are individuals who have surplus savings in their personal account. They either trade based on their own analysis or on the basis of recommendations from financial intermediaries like stockbrokers or research analysts. They usually do not follow a complex investment strategy. Also, the quantum of investment made by any single retail investor is very low when compared to institutional investors. The next participant is the institutional investor. Institutional investors are institutions like corporate, banks, government organizations, mutual funds, insurance companies, and pension funds. They are considered to have specialized knowledge and skills in investing. Often they do a lot of independent research before making any investment. They may also frequently deploy complex investment strategies and try to achieve superior returns using derivatives. The quantum of investments made by institutional investors is large. This is because they have access to large amount of capital as they pool financial resources from many individuals or entities. For example, mutual funds collect money from a wide range of individuals in order to manage it in accordance with a particular investment objective. Similarly, insurance companies collect insurance premiums from a diversified group of individuals in order to provide insurance cover. Their corpus is made out of these premiums. This corpus has to be managed so as to meet future insurance claims. Institutional investors often employ fund managers with considerable experience to manage the huge corpus. These managers are supported by a dedicated team of research analysts and traders who devote their entire time to this activity of investing. Hence, institutional investors often deploy complex investment strategies and achieve superior returns. Welcome back. In the last video we said that you can buy stocks either in the primary market or in the secondary markets. In this video, we are going to discuss this topic further. Most businesses usually start with capital of the promoter or their relatives and friends. As the requirement of capital grows, it may become necessary for a promoter to source funds from a wider group of investors. This may be either because the existing investor cannot invest more money or because the promoter does not want to be over-dependent on a small group of people. Primary market is the market where debt or equity securities can be issued by businesses. This is subject to them meeting certain criteria. The business is known as the issuer of the security. The issuer receives funds from investors, which may be individuals or institutions. Since here the investor buys securities directly from the issuer, this market is called the primary market. Since the securities are issued for the first time in this market is also known as the new issue market. The process of issuing securities in primary market is also known as going public, as this is where the public gets the opportunity to buy these securities for the first time. In the primary market, sometimes institutional investors like private equity funds also sell their stake along with the promoter. A company's ability to raise funds through primary market depends on its performance in the past and also its expected performance in the future. Retail investors who may not have specialized knowledge or skills require protection against a possible default or against their rights getting diluted by the company. In order to provide this protection, the primary market securities are issued under the scrutiny of the regulator. Regulators ensure that the issuers have clearly defined obligations. Regulators also make sure honor commitments they make at the time of raising funds. All the securities issued in the primary market later get traded in the secondary market. These securities are listed on exchanges where any investor owning these securities can exit their investment as and when they see fit. Since securities get traded on the exchange, a business's operation essentially remains unaffected from this exchange of securities between various investors. Also, since exchanges require companies to regularly disclose key information, the investors can regularly evaluate their investment based on this information. A stock's price reflects this continuous evaluation by investors and also their expectation of performance of the business in the future. You might naturally ask, are all issues in the primary market open to the public, that is the retail investors? The answer is that not all primary market issues are open to the public. It is very common for companies in early stages of growth to issue equity capital to certain institutional investors only. These institutional investors may include venture funds and private equity investors. Only when the issuer does not choose any specific group of investors but instead offers his securities to anyone interested in buying a security, the issue is called a public issue. Here is the rough classification of various types of issues in primary market. These include the public issue, the private placement, which can either be a qualified institutional placement or a preferred placement. Finally, you have the rights and bonus issue. Let's briefly look at them one by one. Public issue is one where the securities are issued to members of public or anyone interested in buying the security. The public issue may be an initial public offer, also known as the IPO, or the issue may be a follow-on public offer, also known as the FPO. We will cover these terms in a bit. The next kind of issue is the private placement. In case of a private placement, securities are issued only to institutional investors. Private placements are of two types. One is the qualified institutional placement or the QIP. The other is preferential issue. Qualified institutional placement is a private placement made by a listed company to qualified institutional buyers like mutual funds or insurance funds. The issuers issue a prospectus to various investors and invite them to bid for the securities. The other kind of private placement is preferential issue. In this case, the securities are directly issued to an identified set of investors on preferential terms. These preferential terms may be offered to any person, including the promoters and employees. Lastly, you have the rights and bonus issue. In case of rights and bonus issue, the securities are issued to existing investors. If it is a rights issue, the investors are required to pay for the new securities. In case of bonus issue, the investors get additional shares without making any payment for the security. We will cover rights issue and bonus issue in greater detail in upcoming videos. Now that we have briefly understood the various types of issues in the primary market, in the next video we are going to look at IPO and FPO in greater detail. Welcome back. All public issue of shares is categorized as either IPO or FPO. IPO stands for Initial Public Offering. FPO stands for Follow-on Public Offering. Let's discuss this further. Public issue of shares is categorized as Initial Public Offering or Follow-on Public Offering. Initial Public Offering or IPO is the first public offer made by the company. Post-IPO, the shares of the company become widely available for investment by the public. Through the IPO, there is a change in the shareholding pattern of the company. After the IPO, instead of just the promoters, now all kind of investors also become the shareholders. IPO involves either fresh issue of shares by the company or offer for sale by existing promoters or institutional investors. In case of fresh issue of shares, the company issues new shares so that they can be sold to the public. On selling the new shares, the capital of the company increases and the percentage shareholding of existing shareholders comes down. In case of an offer for sale, the existing shareholders of a company offer a part of their holding to other investors. The share capital of the company does not change as the company doesn't issue new shares. This is because the proceeds of these sales go to the existing shareholders who are offering their stake for sale. Hence, the proceeds do not go to the company and there is no change in the capital of the company. As a result of sale of shares, the percentage shareholding of existing shareholders who have offered some of their shares for sale comes down. Now let's look at FPO or the follow-on public offer. The FPO route is taken by an issuer who has already made an IPO in the past, that is by companies who are already listed on the stock market. When such companies want to make a further issue of securities to the public, they can do so by offering a follow-on public offer. The company may take an FPO route if it requires additional capital for growth or in order to restructure its capital by retiring debt. Some FPOs may also happen through offer for sale, where existing shareholders offer some of their shares for sale. This may happen if the promoters would like to dilute their holdings in the company after the lock-in period imposed at the time of their IPO is over. Once the shares are made public through an IPO, these shares become available to be traded on the exchange, which is essentially the secondary market. In the next video, we are going to discuss secondary market in greater detail. Primary market is where the securities are issued for the first time. After this process is complete, these securities become available to be traded on stock exchanges. The universe of securities that you can trade on stock exchanges actually constitute secondary market. The first thing you should understand is that secondary market transactions do not result in additional capital to the issuer. This is because only existing shares get traded between different investors and the company itself does not receive any funds because of the trades in the secondary market. Primary market is the only market where a company can go for raising capital. Secondary markets essentially support primary market by performing some specific functions. These functions include liquidity and price discovery. Let's look at them briefly. Security markets provide liquidity and improve marketability of existing securities. So markets provide investors the option to sell their equity shares. This means that the investor can stay invested without the fear of his funds being blocked, as they are free to sell their shares whenever they want to. This also means that new investors have the opportunity to buy these shares if they want to. Another function performed by the secondary market is price discovery. The price at which an investor buys or sells a security depends on their assessment of future prospects of the company. The logic is that when a company performs well, it is likely to attract buyers. Similarly, when the business suffers, there is a lack of buyers, as many of the existing investors would also like to sell their holdings. Hence, there is a continuous market evaluation of the company. This continuous process benefits issuers when they have to raise further capital from the markets. This is because the price at which their existing security is trading is a fair indicator of the price at which they can issue new securities. Secondary market is also an indicator of economic activity. Secondary market data is used to generate benchmark indices. Every country has some leading stock indices which are continuously tracked and are viewed as the barometer of economic performance. For example, there is S&P 500 and Nasdaq in US, the DAX in Germany, Sensex and Nifty in India. A sustained rise in indices indicate healthy revenue, profitability, capital investment, and expansion in large companies. This also indicates a strong growth in economy. Similarly, a decline in indices indicates a weakening economy. Secondary market is also known as market for corporate control. Secondary markets promote efficient governance. If a management is inefficient, the company will underperform, which will lead to a fall in its stock's price. This would make it an acquisition target for acquirers who would replace the inefficient management with an efficient management. Now that we have understood primary market and secondary market, you might naturally wonder as to who sets the price in these markets. And this is going to be the topic of our discussion in the coming videos. Welcome back. A question that I often come across from beginners is who sets the price in the stock market? We are going to answer this question for primary market and secondary market separately. Let's start with the secondary market first. In case of secondary markets, stock prices are a result of continuous buying and selling by all the various types of participants in the market. This includes the retail investors, the institutional investors, short-term and long-term traders, and market makers. Since this group of participants covers people from all walks of lives, including those individuals who are trading in the stock of a company they are employed in, it would be fair to assume that some individuals who trade in the market might have access to insider information as well. This implies that every information available to anyone, that is both retail and institutional investors, is reflected in the market prices of the stock. Hence, it is said that the prices reflect the collective wisdom of all market participants, and the price of any security in the stock market is set by this collective wisdom of participants. Now, pricing in the primary market, that is the IPO market, works differently, and we are going to look at how the pricing works in the IPO market in the next video. Welcome back. In this video, we are going to look at how an IPO may be priced. Now, the details of how IPOs are priced might vary slightly from country to country. However, broadly we can say that there are two ways in which an IPO may be priced. These are the fixed price issue or the Dutch auction. Let's look at them one by one. Starting with the fixed price issue. In a fixed price issue, the company issuing the security decides the issue price by consulting a lead manager. A lead manager may be an investment banking firm. This lead manager justifies the price based on the expected performance of the company and also on the basis of price of shares of comparable companies in the market. The issuing company then may inform the public about the issue price along with all the relevant information related to the company's past financial performance. The investors can then take a decision on whether they would like to invest at the issue price or not. The other way the pricing of an IPO is decided is through the book-built issue or the Dutch auction. In case of the Dutch auction, the price of the issue is decided by an auction. The company, in consultation with the lead manager, specifies a floor price, which is the minimum bid price they are willing to accept for their security. Alternatively, the issuer may specify a price band, that is a minimum and maximum price within which the investors can bid. When the issue opens, the investors place a bid price and a corresponding bid quantity. This bid price is required to be above the floor price or within the price band. Once all the bids have been received, the issuer of the security, in consultation with his lead manager, decides on the cut-off price for the security. All bidders who have bid above this cut-off price get an allotment of shares at the cut-off price. Let's understand this with an example. Let's say a company A wants to issue 1000 shares through a book-built offer. Let's say the company has decided on a price band of 120 to 144. Let's assume that the company has received all these bids. The company would start by sorting the bids from highest to lowest. It would start by allocating shares to the highest bidder first and then progressively moves down until all the shares that need to be sold are allocated. So in this example, first the company allots 200 shares to the bidder with the bid price of 144. Since the company intends to sell 1000 shares, it still has 800 shares left. Hence, it will look at the next bid at 140 and allot 300 shares. After both these allocations, 500 shares are still left. So the company will look at the next bid. Here it will allot another 500 shares. So now the company has allotted all of its 1000 shares. Since 135 is the lowest bid price at which shares were allotted, this becomes the cutoff price. All investors who bid at this price or higher than this price are eligible for allotment. For the benefit of the investors, the company may also choose to decide the cutoff price at a lower price than the price at which the issue is subscribed. Sometimes companies also have a clause for retail investors to be allotted shares at a discounted price. With this, we have covered how pricing works in the primary market and the secondary market. In the next video, we are going to understand stock exchanges. Welcome back. I already mentioned that trading in the secondary markets happens on stock exchanges. In this video, let's understand what are stock exchanges. Stock exchange is a platform where willing buyers and sellers transact in various financial securities, one of which is stocks. These transactions take place in an organized manner within certain rules and regulations so that the risk of settlement of funds and securities is minimized. They also stipulate rules for listed companies to protect investors against any wrongdoings by the company. Any person who wants to buy or sell stock can only do so through stockbrokers. Stockbrokers are registered members of the exchange. They are often referred to as trading members as well. Trading members need to fulfill certain minimum requirements for capital, qualification, net worth, and other criteria. Members of the exchange can either be trading members, clearing members, or both trading and clearing members. We will look at this later. Stock exchanges monitor members for their positions, capital, and compliance to various rules. Stock exchanges also provide facilities for issue and redemption of securities and corporate events like payment of dividends. Stocks are not the only securities that get traded on exchanges. Apart from stocks, it is common for securities like corporate and government bonds, currencies, and mutual funds to also get traded on stock exchanges. Apart from this, certain derivative instruments like futures and options also get traded on exchanges. We will understand futures and options in later videos. For now, let's understand what are the advantages of trading on exchanges. You might wonder why investors do not trade with each other directly instead of trading on exchanges. One big reason you should trade on exchange is because by trading on exchanges, you enjoy certain benefits due to regulatory and redressal provisions of law. By trading on exchanges, investors get a liquid market to transact, which ensures that they get the best possible price for their trade. It also ensures that your trades are completed efficiently, as you don't need to search for counterparties to transact with. All investors trading on exchange are required to comply with the Know Your Customer or KYC norms, and everyone has to trade through a broker. The brokers provide investors with market information, news updates, research reports, and other analytical tools to analyze securities for buying and selling. For retail investors, this information is not readily and cost-effectively available otherwise. Stock exchanges also reduce the settlement risk between various parties. Settlement risk is the risk that one of the parties to a trade may default on its obligation to deliver a security or cash as per the trade. Stock exchanges have risk management systems in place to ensure that parties fulfill their obligation. In order to manage this risk, the stock exchanges operate with various intermediaries. In our next lecture, we are going to look at the life cycle of a typical transaction on the exchange and also learn a bit about the various intermediaries associated with the exchange. Welcome back. Now that you have some understanding of stock exchanges, let's try and understand how a typical transaction gets completed on the stock exchange. There are three phases in a secondary market transaction. The first phase is trading. This is where the actual buying and selling of securities happen. Exchanges take various buy and sell orders from different people on their electronic order matching system. Then they match the various buy and sell orders to execute trades. So for example, if these are the various buy orders on a security and these are the various sell orders, then the matching system tries to see if there is a match between a buy and a sell order at a particular price, and if so, fill both the orders. Through this process, the trade is executed speedily, efficiently, and anonymously. All investors route their order through brokerages. Brokerages collect various orders from investors and route it to the exchanges. As a retail investor, the intermediary you will deal with directly is the broker, and the broker in turn interacts with the exchange on your behalf. The next phase is clearing. Once two orders match, a trade is executed. This trade has to go through what is called a clearing process. Clearing process is the process of identifying which securities and in what quantity is owed to which buyer. The clearing process also identifies what amount of payment is owed to the seller for this transaction. So if an investor A buys 100 shares of company X at $10 each from investor B, the clearinghouse does the math and determines that investor A is owed 100 shares while investor B is owed $1,000. In case the buyer or the seller perform multiple transactions, then the clearinghouse identifies all the securities owed to or by them and also all the payments owed to or by them. This clearing process is managed by an independent entity known as the clearinghouse. Once the clearing process is complete, the next phase is settlement. On completion of the clearing process, it becomes clear what security is owed to which investor and what payment is owed to or by each investor. The next step is to fulfill these obligations. The settlement process is the process where securities and payments are made to respective investors. Once the settlement process is complete, the buyers receive their security and the sellers receive their payments. Various intermediaries play different roles in a security market transaction. The first intermediary is the trading member. Trading members are your typical stockbrokers and their affiliates, also known as sub-brokers. Every investor is required to route their transaction through one of the trading members. A broker can become a member of the exchange only on fulfilling certain minimum requirements for capital, qualification, and net worth, among other requirements. The exchange closely monitors all the members and all members are required to fulfill their obligation to their clients. The second intermediary is clearinghouse. Clearinghouse conducts the clearing process. They are independent entities who act as counterparty for all trades executed on the exchange. This means buyers transfer all the funds of the transaction to the clearinghouse and sellers deliver all the securities to them. This of course happens through the broker. Clearinghouse employ risk management systems to reduce the settlement risk between parties. Another intermediary involved in transactions is the depository and depository participant. Like you keep your money with a bank, you are required to keep all your securities with a depository. A depository maintains a record of all the securities you own. Hence, depositories also facilitate the exchange of securities. Only the securities that are held in electronic or dematerialized forms may be traded in the secondary market. When the securities are issued through the primary market for the first time, the issuer deposits the security with the centralized depository. From there on, the record of which owner owns which security and in what quantity is maintained in the centralized depository. Depositories appoint depository participants who act as intermediary between the depository and the investors. So every investor is required to hold a demat account with a depository participant. The settlement of securities is done in this demat account. On completion of a trade, the depository participant then informs the centralized depository about change of ownership. The payments for respective trades are settled through pre-identified clearing banks. Practically, your broker manages the nitty-gritties of this process for you. Another intermediary that is mostly employed by institutional investors is the custodian. A custodian is a bank which holds funds and securities on behalf of large institutional investors like mutual funds and insurance companies. Custodians settle the secondary market trades and may also act as clearing members and clearing banks for the institution in order to manage the settlement of both securities and funds. Now that we have developed some understanding about stock exchanges, in the next video we are going to understand what are securities and what are the various types of securities that get traded on stock exchanges. Welcome back. In this video, let's understand the term securities, and we will also look at the various securities that get traded on exchanges. A security represents terms of exchange between two parties. For example, a stock is a security which defines your percentage ownership in the firm. This security has no maturity date. As long as you own the security, you are entitled to a proportionate share in the profits of the firm. Securities are issued by different institutions like corporate, governments, banks, or other financial institutions. Securities are purchased by various investors who have surplus money to invest. Securities allow investors to convert their savings to financial assets that can provide them returns. The issuer of the security proposes the terms on which they are raising capital. The investor who invests in these securities has the claim to the rights represented by the security. These rights may involve ownership or participation in management or claims on assets. Stocks are not the only type of securities that get traded on exchange. Different types of securities belonging to different asset classes can trade on exchanges. The exchange decides which securities can be traded after taking due permissions from the relevant regulators. Typically, you will find that stocks, corporate debentures, bonds, government bonds, close-ended mutual funds, and currency futures get traded on the exchange. Also, derivative instruments like futures and options, which derive their value from one of these underlyings, also get traded in the derivative segments of the exchange. It is up to the exchange to decide which securities would have derivative securities also available to be traded on the exchange. Before we move on to more details around stock trading, I would like to introduce the term stock indices to you because we may be referring to this term in later videos as well. So in the next video, we are going to understand what is a stock index. So see you in the next video. Welcome back. In this video, we are going to understand what is a stock index, and we are also going to look at how the stock index is calculated. Stock index is a number that represents a particular section of the stock market. Usually, it is seen as the leading measure representing the entire stock market. Very often, you will see one stock index associated with an exchange which represents the leading stocks trading on the exchange. Stock indices are widely quoted in the press and tracked by the public as they reflect the prevailing sentiment in the economy. Stock indices are also used as a benchmark for determining if a fund manager has added value by selecting stocks for a fund. By subtracting the yearly return of the stock index from the fund manager's annual return, you can arrive at alpha, which is a measure of value added by the fund manager due to his stock selection skills. Stock index is just one out of many different types of indices. For example, one can create an index from price of stocks of all banking companies to represent a banking index, or one may create a real estate index from price of stocks of real estate companies. Now let's look at how the value of an index can be calculated. There are primarily two ways of calculating the value of any index. These include the price weighted index and the capitalization weighted index. Let's look at the price weighted index first. In case of the price weighted index, the value of the index is calculated by adding the price of each stock and dividing the sum total by the number of stocks. So you essentially add the prices of all the stocks that constitutes the index and divide it by the number of stocks that are in the index. This implies that a stock with higher price has a greater influence on the value of the index compared to a stock with lower price. So for example, if a stock A is trading at 10 and another stock B is trading at 10,000, and suppose if only these two stocks are used to create an index, then the value of index is given by 10 plus 10,000 divided by 2. So the value of index comes to 5005. Now if suppose stock A were to move by 10% while stock B remains unchanged, the new value of the index would be 11 plus 10,000 by 2, which comes to 5005.5. On the other hand, if stock A remains unchanged while stock B moves by 10%, then the new value of the index will be 5505. Since both the stocks are given equal weight, the same percentage move in stock B may move the index more than the corresponding percentage move in stock A. So the key drawback with price weighted index is that a stock with higher price dominates the movement in the index, and so such an index is not truly representative of the stock market. In order to avoid this, indices are often calculated using the capitalization weighted method. A capitalization weighted index is also known as market weighted index. In case of capitalization weighted index, the market cap of the stock is used to determine the weight of each stock in the index. This ensures that a stock with greater market capitalization has greater influence on the index. So in case of this example, if stock A has 100,000 stocks issued, while stock B has only 10 stock issued, then the market capitalization of stock A would be 1 million, while that of stock B will be 100,000. We will use each stock's market cap and divide by the total market cap of the index constituents. So in this case, the total market cap would be 1.1 million. In order to arrive at the index, the weight of each stock would be calculated by dividing the stock's market cap to the total market cap. So stock A gets a weight of 1 million divided by 1.1 million, which is 10 by 11. Similarly, stock B gets a weight of 100,000 divided by 1.1 million, or 1 by 11. So now it is easy to see that a stock with higher price cannot simply dominate the index. Now that we have covered the basics of stocks and stock exchanges, in the next section we are going to answer some of the common queries related to practical stock trading. So see you in the next section. Welcome back. Now in this video, let me answer the basic question as to how you can start trading in the stock market. In order to start trading, you need to open a trading account with a stockbroker in your country. The stockbroker would guide you on the formalities that you need to complete so that a trading account can be set up for you. Once this trading account is set up, you need to transfer funds to your account so that you can start trading. If you would like to start trading, you should also broadly understand how your trade is executed. A typical trade life cycle consists of certain steps. The first step is trade order initiation. In this stage, you will place an order with the broker. You will decide on the price at which you want to buy the security. You will also decide the quantity, that is the number of stocks or shares you would want to buy. Depending on your preference, you will place a market order or a limit order. We will look at the details around order types a little later. The next step in the process is risk management and order routing. The broker is responsible to ensure that the client does not default on his trade. So if you are buying a stock, the broker will check if you have the required amount of cash in your account. If you are selling a stock, the broker will check if you have the required number of securities in your account. Once he verifies that you have the cash or the securities, he will pass on your trade to the exchange. At the same time, he will lock in the funds and securities in your account so that you do not make the same trade again using the same funds or securities. The next step is order matching and trade execution. Once the exchange receives all the orders, they collate all the buy and sell orders. Then the exchange tries to allot the security to the best available price. Once a match is found, the trade is executed and the exchange sends the notification to the broker, who in turn informs the investor. The last step in executing a trade is clearing and settlement. Once a trade is executed, it goes through the clearing process we discussed before. After the clearing process is complete, the settlement process is executed so that the buyers get the securities credited to their account and the seller receives cash in their account. The entire process is facilitated by the broker, so as far as you are concerned, your broker will be the sole point of contact for you. Now that you have an understanding of the trading process, in the next couple of videos, we will cover the details around placing your trading orders through your broker. So see you in the next video. Welcome back. When you trade through your broker, you will often see the term bid price and offer price on your trading software. So in this video, we'll understand these terms, that is bid price and offer price. Bid price is the price a buyer of a security is willing to pay in order to buy the security. Correspondingly, an offer price or ask price is the price a seller of the security is willing to accept in order to part away with the security. As a trader, you will place an order that specifies a bid price or offer price. You will also specify a corresponding bid quantity or offer quantity associated with the price. Before you place an order, you have the option to see a live feed of active orders. Often the brokers provide you with a snapshot of top 5 bid and top 5 offer prices. A sample snapshot is shown here. This here is the best bid price and this here is the best offer price. The best bid available at this time is 179.30 and the best offer available is 179.35. Let's look at a few examples to understand how the execution of an order placed by an investor will work given this bid offer price quantity situation in the market. Now if these are the available bids and offers in the market and you wish to sell 50 shares at 179.30, you can do so by placing a market or limit order. A market order tells the broker that you want to execute your trade at the best available price in the market. So in this case, when you place a market order to sell 50 shares at 179.30, if the order reaches the exchange in time and the market bid offer price quantity does not move, you will be able to sell your 50 shares at a price of 179.30. Similarly, if you wish to buy 50 shares at 179.35 and you place a market order which reaches the exchange in time, you would be able to buy 50 shares at 179.35. Now if instead of placing an order to buy 50 shares, suppose you place a market order to buy 100 shares. In this case, you will be able to buy 50 shares at 179.35 since only 50 shares are available at that price. Another 50 shares would be bought at 179.40 as this is the next best offer available in the market at the time. Market order is one type of order that is available to you. Actually, there are a range of order types available to you, and we are going to look at these different order types in the next video. Welcome back. In this video, we are going to look at the different common order types available to you. Some of the basic order types include the market order, the limit order, the stop loss order, and combination orders like the stop loss limit and stop loss market orders. A market order instructs the broker to buy or sell the security at the best price currently available in the market. A market order tells the broker to execute the buy or sell trade irrespective of the price available in the market. If you place a market buy order, it is filled at the lowest available offer price. If you enter a market sell order, then it is filled at the highest available bid price. If the quantity available at the bid price is not sufficient to fill the order, then the remaining quantity is filled at the next highest bid. If the quantity at the next highest bid is also not sufficient, then the next highest bid is hit. This goes on till you get a fill for your entire quantity. So in case of a market order, it is possible that you get fill at different prices depending on the quantity available at various prices in the market. The advantage of market order is that it is virtually guaranteed that your entire order will be executed. The disadvantage is that you cannot be sure at what price your orders will be filled. So for example, if at the time of placing your buy order, you see that the stock is trading at 118.7, it may so happen that by the time your order reaches the exchange, the stock has moved to 119, so you might end up buying the stock at 119 instead of 118.70. So essentially, in case of market orders, there is always a risk that the market may move adversely by the time your order reaches the exchange. In order to eliminate the risk, there is the option to place the limit order. In case of limit orders, you are required to specify a limit price and limit quantity. In case of a limit buy order, the broker is instructed to buy the security only if it is possible to get a fill at or below the limit price. Similarly, in case of a limit sell order, the broker sells the security only if it is possible to get a fill at or above the limit price. The advantage of a limit order is that you can be certain about the price at which your order will be filled. The disadvantage is that you can never be sure if your order will be executed. For example, if you want to buy a security at 100, but by the time your order reaches the exchange, the prices go up and do not come back, then your order will not be executed. So this is how market and limit orders work. In the next video, we are going to look at stop loss and some combination orders. The next type of order is the stop loss order. The stop loss order is used to contain your losses on a trade. The stop loss order requires you to mention a stop loss price for your trade. By specifying a stop loss order, you instruct the broker to get you out of the trade if the prices reach the stop loss price. Once the prices reaches the stop loss price, your broker will automatically close your position, thereby limiting your losses. Let's say you are long 100 shares of company A at 20 and you want to exit the trade if prices fall below 18. In such a case, you can place a stop loss order with your broker by specifying the stop loss price at 18. If subsequently the stock's price falls to 18, your stop loss order will be triggered and your broker will get you out of the trade. A stop loss order can again be of two types. These are the stop loss market order and stop loss limit order. A stop loss market order tells the broker that once the stop loss price is hit, the trade should be exited at the best available price in the market irrespective of whether the price is worse than the stop loss price or not. For example, if for a long trade, you place a stop loss market order at 18 and say there is a rapid decline whereby the prices moves from 18 to 17.8 very fast, your stop loss order will still be executed and you will get a fill at 17.80. By placing a stop loss market order, you can be sure that you will be out of the trade once your stop loss is triggered. But the price at which you get out of the trade is not certain. Stop loss limit order allows you to specify a limit price as well. For example, in case of the long trade, you may place a stop loss limit order with a stop loss price at 18 and limit price at 17.90. This will instruct the broker to get you out of the trade once your stop loss price is hit, as long as he is able to get a fill at or above 17.90. So for example, if prices suddenly move to 17.8 before your order can be executed, then the broker will not sell your stock at 17.80 and would instead wait for prices to come back to at least 17.90 so that he can get you out. In case of stop loss limit order, the price at which you will exit the trade is certain. However, it is not certain that your stop loss order will be executed. This means that there is a chance that you may not exit a losing trade even though your stop loss price is triggered. For this reason, I prefer to use the stop loss market order in my trading. With this, we have covered the basic order types. It is possible that your broker provides you some other order types as well. So in the next video, I am going to cover the different order types provided by my broker so that you get a feel for how different order types might work in real life. So see you in the next video. Welcome back. In this video, I am going to cover the various options to execute your trade. I'll be doing this using the software I use. This software is provided by my broker, Zerodha. I'll cover the options provided by my broker. Now, of course, your broker may provide slightly different options or similar options that go by different names. But once you go through this video, I feel you will get a good understanding of how you would like to execute trades with your broker. So let's get started. This is basically my market screen. Here where I have all those securities that I'm currently tracking. Now here are the different order types that my broker provides. First is a simple buy order, a simple sell order, then I have the bracket order and the cover order. So these are the basic options that my broker provides me to execute trades. We will look at them one by one. I of course assume that you know what is a market order, what is a limit order, or what is a stop loss order. I'm not going to get into that basic stuff here. I'm going to just cover these various options that I have to execute my trades. So let's start with the simple buy order. In case of a simple buy order, you just select the exchange, the product type, select the symbol of the security. In this case, it is Sun Pharma. Because I have selected this on my market screen here, you mention the order type. It may be a limit order, a market order, a stop loss order, or a stop loss market order. Now I assume you know these basic order types. Then you mention the quantity. Let's say I want to buy 100 shares of Sun Pharma and I basically enter the price. Let's say I want to buy these 100 shares at 520. So you can just press this submit, and if the market is such that you can buy 100 shares at 520, then your order will be executed. This is a simple buy order. Similarly, you have a simple sell order. Again, in this case, what you need to do is basically select your exchange, select your product type, then you select the security name, select the order type. Let's say you select market. Maybe you now want to sell at market price. Select the quantity. Since this is a market order, you will obviously not enter the price because the order will be executed at the current market price. Now you can just press submit and your order will be executed. So this was simple buy and sell order. Now let's look at a different order type, which is one step forward from the simple way of execution. Now let's look at the cover buy order. The cover buy order takes you one step forward. Again, you will see you have similar options here. You can select the exchange, you can select the security type, and you can select the symbol. You can make this order a limit order or market order. You can mention the quantity. Let's say you want to buy 100 shares and you want to buy at 520. So far, it is as simple as in the case of a simple buy order, but in case of cover order, the broker has provided me an option to specify my stop loss price also. So for example, say I want to execute a trade where I want to buy at 520 and I want to get out of this trade in case it goes against me by say 5 points. So let's say I want to get out of this trade at 515. So I can just mention 515 and this will basically instruct my broker to get me out of the trade if the prices fall to 515. Similarly, you have the cover sell order. Basically here too you will mention the exchange, the security type, the symbol, whether you want to place a limit order or market order. You select the quantity, the price, and again you can basically place your stop loss price. Let's say you want to sell these shares at 520. Maybe you want to place a stop loss at 525. And so this will instruct the broker to get you out of the trade if the prices go against you to 525. The advantage of cover order is that it immediately protects you in case the prices go against you. So right at the moment you enter the trade, you also place your stop loss. So this will basically make sure that you get out of the trade if there is adverse development and it goes against you. However, if the prices go in your favor, then you have to manually book your profits because this option type basically does not allow you to mention a target price in this order. So this is where bracket order comes in handy. So now what we are going to do is look at the next order type, which is the bracket order. Here is the bracket order buy. Again, you see these are similar fields. You select the exchange, select the security type, select the symbol of the security. You select the quantity. Let's say you want to buy 100 shares of Sun Pharma and let's say you want to do so at price of 520. Now let's say you enter a trade where you go long 100 shares of Sun Pharma at 520 and you want to book your profits if the prices hit 525 and say you want to book a loss if the prices hit 515. So let's see how we can execute this order using the options we have here. This square of cell option here is used to basically mention your target price. In this case, you don't directly mention the target price. Basically, you won't write 525. No, instead you need to write 5 here. That is, you need to mention the number of points your target price is away from your entry price. And the system will automatically calculate your target price. So once you mention 5 here, this tells the broker that your target price is 5 points away from the entry price. Similarly, once you mention 5 here, it will tell the system that your stop loss price is 5 points away from entry price. Now instead of mentioning the absolute number of points, you also have the option to mention the number of ticks. So instead of 5 points, you can mention 100 ticks. Similarly, instead of placing a stop loss sell order and mention 5 points, you may mention 100 ticks. This again will tell the broker that basically the price at which you want to exit your trade if it goes against you is 100 ticks. So this will again come to 515. So basically your broker will know that you want to exit the trade if the prices go 100 ticks in your favor. So again your exit price will be 525. Now I find it easier for me to just directly enter the number of points, where basically I don't want to do the math of multiplying the number of points to the number of ticks. So I usually directly enter the number of points here. So in case of target price, I write 5 points here. And again in case of stop loss also, I place 5 points here. Now apart from this, there is another parameter that you can select for your stop loss and take profit price. This parameter is shown as LTP and ATP here. If you mention LTP, what happens is once your stop loss price is hit, then your broker will get you out of your trade at the best possible price. So for example, in this case, the stop loss is 515. So the broker will get me out of the trade once the stop loss is triggered. So let's say if prices go to 514 suddenly, then the broker will still get me out at 514. if it is not able to get me fills at 515. If you choose the ATP option, the broker will place an order to get you out of your trade at 515. So what happens is, if you have a fast move and prices move to 513, then your exit order will still be placed at 515 and your position will still be open. As you know, this can be very risky, which is why I prefer to use LTP and not ATP. So this is how you can place a buy bracket order. Now what will happen is, once you enter a trade, you automatically instruct the broker to book a profit at price mentioned by you or book a loss at the stop loss mentioned by you. And once your stop loss price or take profit price is hit, the broker will cancel the other order. So basically, if your stop loss price is hit, then your take profit order will automatically be cancelled. Similarly, if your take profit price is hit, then your profit will be booked and your stop loss order will automatically be cancelled. This is why this bracket order is often also known as OCO order, which stands for one cancels other order. This OCO order is very common in forex, but this order is nowadays being provided by certain equity brokers also. So I hope your broker also provides this option to you. There is obviously an advantage to using this kind of a system, because all you need to do is to be there when you are entering the trade and the system will take care of the rest. Now what happens in case neither your stop loss price nor your take profit price is hit? Well, in that case, what happens is that when you are just 10 minutes away from the closing, the broker will close your position at the prevailing price. So for example, let's say in this case, we entered a buy order at 520. Let's say neither your take profit nor your stop loss gets triggered. And let's say the prices are trading around 522 just 10 minutes before closing. Then in this case, the broker will close the position at 522. So basically, once you have entered the trade using bracket order, there is nothing else you need to do, and your broker is going to manage the entire trade from here on. Now, like you have the bracket buy order, you also have the bracket sell order. Again, in this case, let's say your trade becomes sell, you want to sell at 520 and you want to get out of the trade if the trade goes 5 points in your favor or against you. So all you need to do is mention your entry price. You have to select the number of points your target price is away from your entry price, and then you have to select the number of points your stop loss price is away from the entry price. So let's say if your entry price is 520, then placing this order will instruct the broker that your stop loss price is 525 and your take profit price is 515. With this, we have covered the various options for you to execute your trade. You might like to use one type or the other depending on what you are comfortable with. I personally prefer to use bracket order because I just need to be there at the time of placing my entry and the broker will take care of the rest. So that's all for this video, and I hope you liked it. And now you can move on to the next video. Welcome back. In this video, I'm going to share a few tips on how to select a stockbroker. Brokers can be divided into two broad categories. These include the full service brokers and discount brokers. Full service brokers don't just execute transactions, but they also provide a range of services to the customer. Full service brokers also have a dedicated research desk for providing recommendations to the client. They may also provide portfolio management, tax planning, and retirement planning service to the clients for some extra cost. On the other hand, discount brokers mostly deal with executing trades at much lower cost compared to the full service brokers. They generally do not provide any investment advice. If you are new to investing, it is better to stay with a full service broker instead of a discount broker. This will give you a range of investment options. As you gain more knowledge and become comfortable with active trading, you may shift to a discount broker as well, especially if you are looking to day trade markets. But before you select a broker, it is important to do your research. I will now share some factors that you should consider when evaluating brokers. The first and foremost factor you should check is website availability. Since most of the trading is electronic, you should check the availability of the website during peak trading hours. It is important to consider how fast their website responds, especially if you are considering a discount broker. The next factor is alternative trading facilities. This will become an important factor when the broker website is facing outage. In such scenarios, you may want to check if they take your orders over the phone, and if so, do they charge a different brokerage fee for this service. The next factor is customer feedback. You can look for feedback from investing community when you choose a broker. Since existing investors speak from their experience of using different brokers, you could benefit from their feedback. You could search for various discussion forums where you can find reviews from the investing community. The next factor you should look at is minimum deposit requirements. Most brokers would require you to deposit a minimum amount with them. This deposit is available for you to trade. You will find that most of the times the initial deposit requirement is negotiable, especially if you are talking to multiple brokers at the same time. The next factor you should look at is the product you are going to trade. If you are a beginner, you would probably start by trading stocks in cash, but there are also other alternatives for you to trade. For example, after you gain some experience, you may like to trade futures and options on stocks. Usually there is difference in brokerage fee for these products, so you should compare the brokerage fee of different brokerages across products before choosing a broker. Lastly, you may also compare the interest offered by them on your deposit. Most brokers offer some interest on money deposited with them. Since you are probably going to have some deposit with them at any point of time, you should check and compare the interest rate offered by them on your deposit. In this video, we have discussed some factors you should consider before choosing a broker. In the next video, we are going to cover a totally different topic. So see you in the next video. Welcome back. In this video, I am going to give you some understanding about algorithmic trading. Algorithmic trading uses mathematics and computer programming to reduce the effect of human emotions and biases in trading. Algorithmic trading is often used for two purposes. The first is to automate order executions for efficiently executing large orders. The second is to place automated trades in order to profit from them. Often the term algorithmic trading is used to refer to automating the order execution, while the term automated trading is used to refer to place trades in order to profit. Automated trading involves automation of the complete trading process. When a new investor asks this question, he often has automated trading in mind, where he wants to profit from using a programmed trading strategy to execute his trades. In order to be effective at automated or algorithmic trading, one needs skills in two domains. First is computer programming, and the other is some amount of knowledge of mathematics or statistics. These skills may or may not be readily present in every individual. Brokers often assist high net worth individuals to execute trades using algorithmic trading, but the same is not true for automated trading. Automated trading requires developing a trading system that applies certain rules to determine the entry price for the trade and also to determine the exit. Before deploying any trading system in the market, one needs to backtest this system using historical data to determine if the trading system has been profitable in the past. This essentially means that the trader may need to create and test multiple trading systems before he comes across a profitable trading system. Even after finding and fine-tuning such a trading system, it is not uncommon to find a system that works well in simulated setting, but it does not work so well when implemented on real-time markets. What is more, even if a trading system works, one needs to continuously monitor these systems when they are operating in the market, as they require manual abort if something goes wrong. As there are multiple tasks that need to be performed in order to be successful in automated trading, it is often best to work in teams instead of individually. Also, automated traders need to adhere to strict guidelines from various exchanges in terms of capital requirement and system requirements, which may be capital intensive in nature. It is not uncommon for stiff penalties to be levied by the exchanges if automated trading firms are found in violation of their rules. Hence, considering the complexities involved in automated trading, it is best for new investors to not immediately indulge in automated trading in individual capacity. In fact, a team setting is probably the best place for any beginner to start with automated trading. So if you are really serious about getting into automated trading, you should do it in teams. In this video, I have shared my thoughts on how individuals should approach algorithmic trading. Depending on your skill sets and your mindset, you should take a call on how you want to proceed in this area. For now, I'm going to move on to the next topic, which is money management for retail investors. So see you in the next video. Welcome back. A very important question you should ask before you start investing is how much money should you invest in the stock market? In this video, I'm going to share my thoughts on this topic. The first point you should remember is that each individual's personal and financial situation is different. So it is imprudent for anyone to give a specific number or percentage income or assets that might work for everyone. In fact, I will go one step further and urge you to not pay attention to some common formulae for asset allocation that are touted in media. For example, one common suggested formula is 100 minus your age is the percentage allocation you should have to equities. This kind of a formula is flawed not only because it fails to consider the specific situation for every individual, but also because it does not take into account the possibility of wild fluctuation in investment value, which may lead to liquidity issues for the investor. Consider this example. A recent graduate from college may have limited savings even after working for 2 to 3 years. He may also be servicing an education loan. In such a scenario, if he decides to invest close to 70 to 75% of his savings in equities, he runs the risk of getting into liquidity issues very early in his life. What if the stock market crashes and his portfolio goes down by over 30%? Will he be comfortable exiting at such a loss? What if the market-wide crash is so severe that he ends up losing his job? He will immediately run into trouble, not just for his living expenses, but also on his education loan. Ideally, you should only invest some portion of your investment portfolio into the stock market. I will explain what I mean by investment portfolio, but before that, let's define some terminologies first. Savings in a given month is given by savings equals income minus expenses. Income may be income from salary or business or profession or even multiple sources. Expenses should include both essential expenses and discretionary expenses. Essential expenses include living expenses, rent, loan repayments, health and life insurance premiums. Discretionary expenses include expenses on travel, luxury, leisure, and other non-essentials. Accumulated savings is essentially the sum of your savings over your lifetime. Emergency fund is a fund that one should always hold, and it should include at least 6 months of essential expenses. If your accumulated savings is less than your required emergency fund, then your first priority should be to build up your emergency fund. Hence, most of your monthly savings should go to your emergency fund first. Needless to say, no part of your emergency fund should be invested in equities. In case your accumulated savings is greater than emergency fund, then the excess of accumulated savings over your emergency fund value is your investable surplus. Before you decide on the percentage of investable surplus that can be invested in equities, you need to figure out your foreseeable fund requirements over next 2 to 3 years. For example, if you know that you would require a sum of money in the next 1 to 2 years, say for meeting some obligations, then this amount should also not be invested in equities as equity returns are volatile. This fund requirement must be invested in products which provide fixed returns. After you deduct all your fund requirements over next 2 to 3 years from your investable surplus, you arrive at the sum that is available to you that can be allocated to equities, and we will call this the investment portfolio. While your entire investment portfolio can be allocated to equity, it is not advisable to do so for everyone. For example, if you have just started working, it is possible that this investment portfolio is only 20 to 30% of your entire savings. In such a case, it may be possible to allocate this entire capital to equities. On the other hand, if you are in your early 50s, it is possible that your investment portfolio is more than 60 to 70% of your entire savings. Since you are only few years away from your retirement, it won't be advisable for you to allocate your entire investment portfolio to equities. For example, if you have created a corpus for your retirement, you would not want most of it to be allocated to equities. Instead, most of your portfolio should be allocated to instruments which offer fixed returns, and only some portion, say 20% of your corpus, should go into equities. When investing in equities, one should try to diversify into multiple mutual funds and individual stocks in order to protect yourself from losing too much money in one equity investment. Doing so also has the benefit that some securities may provide positive returns, which may offset negative returns from some other securities. For investors who are risk averse, this reduces the overall volatility in returns from your equity investments and helps you stay invested for longer periods during times of volatility. Now that you have some idea as to how much money you should invest in the stock market, in the next video we are going to look at how much money you should invest in an individual stock. So see you in the next video. Welcome back. In this video I am going to share my thoughts on how much money you should invest in a particular stock. Just keep in mind that this discussion is going to be applicable to only long-term investing. Now the answer to this question actually depends on number of factors, like whether you are a beginner or do you have experience with investing, do you have the skills to evaluate securities, or are you willing to learn the skills, do you have the necessary time to invest in the activity of stock picking, and are you comfortable with evaluating new information on a particular security very quickly. If you are a beginner, you would be better off investing most of your money in equities through mutual fund and a substantial but only a small portion through individual stocks. In order to invest in individual stocks, one needs to have skills to evaluate securities. If you don't have these skills, you need to learn these skills and start investing in small amounts in different securities based on your own analysis. Learning new skills and stock picking are activities that require time. So in case you have commitments that don't allow you to invest time in these activities, then you are better off passively investing through mutual funds. Irrespective of whether you are a beginner or experienced person in stock picking, your portfolio of individual stocks should consist of multiple securities. This gives you diversification benefits and shields you from adverse movement in one security. Also, by limiting your investment in one stock, you avoid getting too carried away or being excessively vested in one idea. This is important because if you are too vested in one idea and it does not work, it can have adverse effect on your confidence. You should always remember that no matter how confident you are in your analysis, you can still go wrong as the security's performance might be affected by some factor you ignored in your analysis. Considering this, it is important to limit your initial investment in any security to a level that it effectively does not solely dominate your portfolio returns. So it is a good rule of thumb to limit your initial investment in any particular security to less than 10%. This way you would at least have 10 securities in your portfolio, which would make it a reasonably diversified portfolio. I hope this discussion gave you some idea about how to manage your money in the stock market. In the next video, I'm going to again discuss on a topic in a related area. So see you in the next video. Welcome back. Another question that I get a lot of times from a lot of beginners is whether they should only invest in futures and options if they have less money. Let me share my viewpoint on this through this video. Actually, it is not very uncommon for someone who is just starting out in their investment journey to have less money to invest. Consequently, you may feel that without enough money, you may not be able to make a lot of money soon, and in such a scenario, you may think of using only futures and options with the hope of making a lot of money with small investment. The fact is, futures and options were not created for this purpose. The primary purpose of futures and options is to serve as a hedging instrument for existing positions. Futures and option contracts on indices and stocks are often used by individuals for this purpose. At the same time, it is true that a lot of people use it for speculation as well. Futures and options certainly have the advantage that you need little upfront money to take bigger positions in the market. Investors can often take the same notional position by investing less than 20% of the notional money depending on the margin requirement in place by the exchange. Let's take an example. If a stock future contract has a lot size of 2000 stocks and the stock is trading at 100, and let's suppose that the margin requirement is 15%, then you would require only 15% of 2000 multiplied by 100 or 30,000 to take a long or short position on 2000 stocks of the company. In the cash market, you would have required 2000 multiplied by 100, that is 200,000, which is the entire amount. And if you compare these two amounts, then this obviously is a much higher initial investment. Here I have presented the calculation from taking equivalent positions in cash market and futures market. In cash market, in order to buy 2000 shares at 100, you need 200,000. In case of futures market, if you assume a margin requirement of 15%, you would need 15% of 200,000, which comes to only 30,000. So your initial investment is very low if you use a futures contract to take an equivalent position. Now let's say if we assume that the position moves 10% in your favor, then you make 20,000 in both cases. However, your return on investment in case of futures is way higher compared to your return in case of the cash market. This is because you have a low initial investment if you invest through the futures market. In this case, the return in cash market is 10%, while your return in the futures market would be around 66%. This may entice a beginner into thinking that he can make a quick buck by trading in futures and options. However, using futures is a double-edged sword. Let's look at the calculations here to see what happens in case the price of the stock moves against you by 10%. As you see here, using futures not only magnifies the return on investment if the trade works in your favor, but your losses also get magnified. Hence, someone starting with a capital of just 30,000, looking to make quick money by trading through futures, may also end up losing 2/3 of his capital if the stock prices just move against him by 10%. From my experience, I can tell you that most beginners end up losing big money in futures and options if they do not practice sound money management principles. As a beginner, if in your initial trading you lose a substantial amount of capital, it is very likely that you would get disenchanted with the stock market. So my advice to you is that do not look to futures and options to provide you capital for trading. Instead, you should try to be profitable in the cash market first, and only once you have gained sufficient experience, you should consider trading in futures and options. Now for discussion purposes, we touched upon the topic of futures in this video, but in the next video, we are going to formally cover this topic in greater detail. So see you in the next video. Welcome back. In this video, we are going to understand what is a futures contract. In the next video, we are going to look at the options contract. For now, let's concentrate on the futures contract. A futures contract is a derivative instrument between two parties. In simple words, it is a financial contract or an agreement between two parties. One of the parties to this contract is the buyer and the other is the seller. By entering this contract, the two parties agree to transact a financial instrument, which may be a stock or a bond, or they may agree to transact a physical commodity for future delivery at a certain price. While the formal definition says that the contract is for delivery of a financial instrument or commodity, in reality, most of the contracts are settled by the way of cash instead of actual delivery. Let's understand all this in greater detail. The futures contract is a contract traded on exchanges just like a stock is traded. Buyers and sellers place their bid and offer prices, and the exchange electronically matches these orders and executes trades. So as far as actually executing trades is concerned, these contracts are not very different from what you are doing with stocks. What is different though is the nature of what you are buying or selling. Let's say a bread maker enters a contract with a farmer for supply of grains at a fixed price at the end of the month. Now the farmer is obliged to deliver him the grains at the end of the month, and the buyer will pay him the fixed price decided as per the contract. If during this period the price of the grain goes up, then the buyer is insulated from this change in price. This is essentially the essence of a future contract and how it works in case of a commodities futures contract. In case of stocks, the delivery of grains is just replaced by delivery of stocks, where the buyer of the contract is insulated from an increase in price of the stock during the period. Since the futures contract is a legal contract, everything is essentially specified in a standardized way in the contract. The exchange essentially specifies the various details of the contract. In case of stock futures, the exchange may specify the name of the stock to be delivered, the quantity of the stock to be delivered, and the date at which the stock would be delivered. While it is true that the parties to a futures contract may deliver the underlying security or commodity, in reality it is not necessary that an actual delivery may take place. This is because there is an alternative available whereby the obligations of the contract can be fulfilled by the way of cash settlement. Let's say a buyer and a seller enter a futures contract on a stock at a price of $10. At the end of the month, the buyer agrees to buy 1,000 stocks from the seller at a price of $10. Now if at the end of the month, the stock prices go up to 11, the buyer has benefited from the trade because he is going to be buying the stock at 10 while the same stock is trading at 11 in the market. One way for him to book his profits is by taking the delivery of stocks and selling the stock in the market at 11. This would lock him $1 profit on each stock, or effectively $1,000 profit on one futures contract. The seller of the contract in this case has a loss of $1. Now if he does not already own this stock, he would need to buy this stock from the market at $11 and deliver it to the buyer of the contract, this would result in $1 loss for him or $1,000 loss on one futures contract. Now, instead of going through this cumbersome process of taking the delivery and then selling the stock in the market, the two parties can settle the contract if the seller directly pays the buyer $1,000. This is what is known as cash settlement of contracts. In fact, most of the contracts in futures market are actually cash settled. As we saw in the last video, futures contracts have an advantage that you require less capital compared to the cash market for taking a similar sized position. But as we already said, this is a double-edged sword as both your losses and profits are magnified due to leverage. With this, we have completed our discussion on futures contract. In the next video, we are going to look at the options contract. Welcome back. In this video, we are going to briefly understand options. An option is a contract that gives the buyer of the contract the right but not the obligation to buy or sell the underlying at a specific price within a certain time period. The underlying in an options contract can be a stock, stock index, commodity, or currency. In an options contract, the buyer of the contract has the right to buy or sell a security. However, he may choose to not exercise his right if it is not profitable for him to do so. The buyer of the option contract buys the option from the seller, so the option seller is the counterparty to this trade. The seller of the option is always obliged to buy or sell a security depending on the type of option. Let's understand this with an example. Say you want to buy a diamond ring in 3 months. The price of this ring is $35,000. You feel that the price may rise in 3 months' time, but since you don't have enough money right now, you cannot buy the ring immediately. Let's say you negotiate with the seller that he gives you the option to buy the ring after 3 months at today's price of $35,000. The seller agrees but asks you to give him $500, which is a price for providing you this option. Now consider two situations. Let's say the price of diamonds increased during this period of 3 months and is now at $39,000. But since you bought an option to buy this ring at $35,000, you can do so, and so it will save you from this price increase after adjusting for the options price you paid. So you will be saving $39,000 minus $35,000 minus the $500 you paid for this option. This comes to a saving of $3,500. It may also happen that the price of diamonds actually decreases over this period, and so let's say if the price of the ring after 3 months is $31,000, now instead of paying $35,000 for the ring, you can forego this $500 option and instead you just buy the ring from another shop for $31,000. So by negotiating an options deal, you had the choice to buy the ring without the obligation to do so. Now let's look at two basic types of options, which are call option and put option. Call option is an option that gives the buyer of the option the right but not the obligation to buy an asset within a certain time period at a certain price. The last example we discussed on buying a ring was actually a call option. By owning a call option on the stock, you essentially have a long position in the stock, which benefits if the price of the stock rises. Another type of option is the put option. Put option is an option that gives the buyer of the option the right but not the obligation to sell an asset within a certain period of time at a certain price. By owning a put option, you essentially have a short position in stock, which benefits if the prices fall. So from this it should be clear that there are 4 participants in options market of any asset. These are the buyer of the call option, the buyer of the put option, the seller of the call option, and the seller of the put option. As far as the buyers of the options are concerned, they are not obligated to buy or sell the asset. They can choose to exercise their rights only if it is profitable. As far as the sellers of the option is concerned, they are obligated to buy or sell the asset if the buyer of the option exercises his rights. Whenever the buyer of the option exercises his right, the seller of the option will be at a loss and will need to fulfill his obligation. Since the seller of the option is obligated to buy or sell the asset on the wishes of the buyer of the option, the seller of the option gets compensated for this in the form of options premium paid to him by the buyer of the option. This premium is paid to the seller at the time of initiation of the options contract. If the contract expires and the buyer does not exercise his right, then the seller of the option gets to keep the entire premium, and this entire premium becomes his profit. If you are a new investor, I would suggest to stay away from futures and options until you have sufficient knowledge to handle this kind of risk. For now, we are going to move to the next topic, so see you in the next video. It is very common for inexperienced and even experienced traders to look for stock tips in order to make some easy money. In this video, I am going to share with you an example on how it is very easy to scam anyone looking for easy money in the stock market. So I'm going to share an example, and I hope you understand that instead of looking for shortcuts and finding ways to make easy money in the stock market, you choose the long hard way of learning and gaining skills to apply in the stock market. So let me give you an example. Imagine a stock operator with 200 contacts. He starts by dividing his 200 contacts into two groups of 100 each. He sends a buy signal to one group and he sells a sell signal to another group on the same stock. One of this signal would obviously be correct, so he takes the group that gets the right call on the stock and divides it into two groups of 50 each. One group is again given a buy signal on a particular stock, and the other group is given a sell signal on the same stock. Again, one of the group would get the correct call, so he takes this group that got the correct call and divides it into two groups of 25 each. Again, one group gets a buy signal on a particular stock and the other group gets the sell signal on the same stock. At the end of this process, the operator has a group of 25 investors who have got 3 consecutive correct trading calls. He can now try and sell his services to these people and make easy money in spite of the fact that he probably has no understanding of the market, and also there is no research whatsoever that went into generating these calls. Now, the best way to avoid such scams is to not look for quick money making ways and instead treat stock picks and stock tips with high degree of skepticism. If you are new to the stock market, your energies would be better directed in learning stock analysis instead of looking for tricks or shortcuts. These activities invariably lead people to scams looking to fool gullible investors. I hope the example I shared as part of this video convinces you to start learning more about the stock market and start developing your skills. Now in the next video, we are going to move to the next topic, which is mutual funds. So see you in the next video. Welcome back. As you start your investing journey, I highly recommend you to start investing through mutual funds. In this video, I'm going to give you a brief understanding of how mutual funds work. Mutual funds pool funds from various investors who have the same investment objective to create an investment corpus. Mutual funds then manage this corpus in accordance with the investment objective. Each fund is managed by a fund manager. The fund manager has an analyst team supporting him who helps him in analyzing various securities. The fund manager's main responsibility is to allocate the funds from the corpus to various securities. The objective is to maximize returns from investments. Mutual funds provide investors with the choice of investing in an asset class of their choice. The asset class can be equity, debt, gold, or real estate. Any investor who is uncomfortable with directly investing in an asset class can choose to invest through mutual funds. This allows him to invest small amounts and also employ the services of a fund manager. The fund manager makes all the investment decisions relating to investing. Fund managers essentially make decisions related to security selection, timing of investments, reviewing and rebalancing the portfolio periodically, and executing other operational decisions related to the fund. Mutual funds are not only a good investment vehicle for those who have little knowledge about security analysis, but they are also good for those who are comfortable with security analysis. This is because equity mutual funds provide great diversification benefits for smaller amounts. Even if you are comfortable with investing directly in equities, you can still use mutual funds to invest in other asset classes like debt, gold, or commodities. Hence, mutual funds are a good option for both beginners and seasoned investors. So I strongly recommend you to keep investing regularly through mutual funds. Welcome back. In this video, we are going to understand some common corporate actions. Corporate actions are actions on the share capital of the company that have a direct impact on the shareholders. These actions are proposed by the board of the company and approved by the shareholders. At times, companies also require the approval of the market regulators. Corporate action includes sharing the surplus profits of the company by paying dividends or buybacks, also known as share repurchases. Or corporate actions may include changes in the capital structure through issue of bonus issue, rights issue, and mergers and acquisitions. Let's look at these corporate actions one by one, starting with dividends. Dividends are share of profits of the company received by its shareholders. A company may declare dividends more than once in a financial year, but they are allowed to declare dividends only out of the profit and loss account. Also, the dividends can only be paid out of the profits of the year in which the dividend is being paid. Hence, a loss-making company cannot make dividend. It is the board of the company which recommends dividend, and it requires further approval from the shareholders. The next corporate action is buybacks or share repurchases. In a share buyback, the company buys some of its shares listed on the stock exchange. The company buys these shares from its reserves and surplus account on its balance sheet. The shares bought back are extinguished by the company, and it leads to reduction in its share capital. Since the shares bought back are extinguished by the company, so the number of shares outstanding are reduced. This essentially leads to an increase in earnings per share for the remaining shareholders. In order to be eligible to offer a share buyback, the company should not have defaulted on its interest payments, loan repayments, or dividends. The next corporate action is a bonus issue. A bonus issue of shares is made to existing shareholders of the company. As part of the bonus issue, the existing shareholders receive new shares in a certain proportion at no extra cost. For example, a 1:3 bonus issue would mean that each existing shareholder will receive one extra share for 3 existing shares held by him. A company is eligible for a bonus issue only if it has not defaulted on its interest payments, dividend payments, or loan repayments. The next corporate action is a rights issue. A rights issue involves giving the existing shareholders the first right to buy new shares issued by the company. If a company decides to issue new shares in order to raise capital, it affects the existing shareholders adversely. This is because this action reduces the percentage holding of existing shareholders. In order to avoid this, companies go for rights issue to existing shareholders. This allows the existing shareholders to buy the new shares before they are offered to others. If the investors do not want to buy more shares, they can sell their right entitlement to others. To facilitate this, right entitlements also get traded separately from the shares of the company. The last corporate action is mergers and acquisitions. Mergers and acquisitions deal with buying, selling, dividing, and combining different companies and similar entities. Mergers and acquisitions can help an enterprise grow rapidly in its own sector or in a totally new sector. The term merger refers to legal consolidation of two companies, which leads to formation of one new entity. The term acquisition is used to refer to a situation when one company takes over another and completely establishes itself as the new owner. Mergers result in creation of a new entity, while acquisition results in one company buying the other and no new company is formed. With this, we have briefly covered the various corporate actions. In the next video, we are going to look at some important dates associated with corporate actions. So see you in the next video. Welcome back. Now most corporate actions have some important dates associated with them. Two of these dates are the X date and the record date. These dates are important because these dates tell you owning the stock on which date would make you eligible for receiving the benefits due to the corporate actions. Let me explain this by taking the example of dividends. Here are some important dates associated with dividends. First is the dividend declaration date. This is the day on which the board of the directors announced that the company is going to pay dividend. Next you have the ex-dividend date. This is the date on or after which the security would trade without dividend. If someone were to buy the security on or after the ex-dividend date, they won't be eligible to receive dividend. Hence, in order to receive dividend, one has to buy the security before the ex-dividend date. In case of bonus issue, you similarly have an ex-bonus date, which is the date on or after which the investor would not be eligible to receive the bonus. Next you have the record date. The record date is the date on which the company looks at the shareholding records in order to determine which shareholders will receive dividends. For an investor to be eligible to receive dividends, their names must be on the records on this date. In order to ensure that their names are on the record, the investor may need to hold the shares either 2 days or 3 days before the record date. Now, whether the investor has to buy 2 days before or 3 days before depends on the settlement cycle in the country. Lastly, there is the date of payment of dividend. This is the date by which the company intends to pay out the dividend to those eligible to receive dividends. This date may be a week or more after the date of record so that the company has sufficient time to accurately pay dividend to all those entitled to receive dividend. Let's look at an example to better understand this. If the stock's ex-dividend date is 15th, anyone buying the stock on the 15th would not be eligible for receiving dividends. Hence, in order to receive the dividend, one needs to be the owner of the stock on 14th. If the exchange follows a T+2 settlement, this would mean that the stock would be settled in 2 days and the records will be updated in 2 days. In such a scenario, the record date would be 1 day after the ex-dividend date. As this way, anyone buying the stock one day before the ex-dividend date will be the shareholder as per the records on the record date. If the exchange follows a T plus 3 settlement cycle, then the record date would be on 17th, which would be the second day after the ex-dividend date. With this, we have covered all the important dates associated with corporate actions, and we have also come to the end of our section on the basic queries with respect to the stock market. And now you are ready to move on to the next section. Welcome back. Now let's first briefly understand what do we mean by the term financial analysis. Financial analysis is a process of looking at a company's performance to arrive at a decision on whether to invest in equity or debt of the company and at what price. An investor in debt of a company is concerned with receiving regular interest income from the company and also return of principal at the time of maturity of debt. On the other hand, an investor in equity has residual ownership in the company and hopes that the company pays dividend and grows profitably with time so that the stock price increases and he gains from this increase in the stock's price. The central focus in financial analysis is to evaluate a company's ability to earn returns on invested capital such that it can grow its operations profitably and generate enough excess cash to meet obligations and also so that it can pursue new opportunities. Now, fundamental financial analysis involves looking at the information found in a company's financial reports, which includes the company's audited financial statements, its periodic disclosures, and other formal and informal commentary by the management from time to time. Through what is covered in this module, we intend to build a foundation to enable you to better understand information gathered from various sources. All publicly traded companies listed on exchanges are required to disclose regular and periodic updates, which includes their financial statements. These statements can be accessed from the exchange's website or the company's website, or sometimes even from the regulator's website in some countries. In the next few lectures, we'll briefly cover various components of financial statement one by one. Let's start by briefly looking at the contents of the financial statements issued by any company. A typical financial statement would at least include all of these sections. The first is a statement of financial position, also known as the balance sheet. Then you have the statement of income, which is also known as the profit and loss statement. Next, you have a statement of changes in equity, which essentially summarizes the change in equity capital structure of the company in the period of reporting. Another important section that you find in financial statements is a statement of cash flows, which summarizes the various cash flows in the given period. Then you have the notes to account, which includes additional disclosure with respect to various items in these previous statements we have covered. And also you have the management discussion and analysis, which gives you the perspective of the management on various issues faced by the company. Now in the next few lectures, we'll briefly look at each one of these one by one. Welcome back. Let's start by understanding an important part of financial statement of any company, which is the balance sheet. Now, balance sheet presents a company's current financial position by disclosing the resources the company controls. These resources are called assets. The balance sheet also discloses the company's obligation to its lenders and creditors, and these obligations are known as liabilities. The financial statement also discloses owner's equity, which is essentially the excess of assets over liabilities. Essentially, the balance sheet discloses what an entity owns, what it owes, and what the owner's claims are at a specific point in time. The basic elements of a balance sheet are shown here. First is assets. Now, assets are what a company owns or controls. More specifically, assets are resources controlled by the company as a result of past events. It is expected that future economic benefit to the company will flow from utilization of these assets. Next, you have the liabilities. Liabilities are essentially what a company owes, hence, they represent obligations of a company arising from past events. Settlement of liability results in cash outflow from the entity. Apart from assets and liabilities, you also have equity. Equity represents owners' residual interest in the company's assets after deducting the liabilities. The relationship between assets, liabilities, and owner's equity is governed by the equation shown here, which is essentially assets equal to liabilities plus owner's equity. This equation says that total amounts of assets must equal or balance the combined total amount of liabilities and owner's equity. Another way to see this is that the left side of the equation reflects the resources controlled by the company, which are known as the assets, while the right side of the equation reflects how those resources were financed. So essentially, all these assets were either bought by utilizing the funds from owner's equity or liabilities, or maybe partially both of them. Now, if we rearrange this equation, we get this formula, which is owner's equity is equal to assets minus liabilities. This arrangement emphasizes that equity holders do not have rights to all assets of the company. They in fact only have residual rights to assets after taking care of the liabilities first. In order to briefly understand these, let's look at balance sheet of a hypothetical company which we will call V Group. Now these essentially are the assets. As you can see, the company has shown its 2009 numbers and 2008 numbers. This is a common practice and makes it easy to compare the current numbers with the previous year's numbers. In this case, the 2009 represents the current numbers as per this balance sheet, and the 2008 numbers are the previous year's numbers. Now the total assets are shown as 177 billion euros, which is the sum of non-current assets of 99 billion and current assets of around 78 billion. The liabilities are shown here, and while the total liability figure is not given, we can calculate it by adding non-current liabilities and current liabilities, and this amount of total liabilities is close to 140 billion. We also see that total equity is around 37 billion. So we see that for this balance sheet, the total assets equals total liabilities plus total equity. This of course is a detailed balance sheet, which as you can see has many components. Let's understand the components in greater detail one by one. We'll start by understanding current assets and current liabilities. The first thing to notice is that both on the asset side and the liability side, there are both current and non-current items. The question naturally comes, how do you classify assets as current or non-current? The answer is simple. All items held primarily for purpose of trading, or those items that are expected to be sold, used up, or otherwise realized in cash within one operating cycle are classified as current item. Now we use the term operating cycle. Now a company's operating cycle is the average amount of time that elapses between acquiring inventory and collecting the cash from sales of finished goods to customers. For a manufacturer, operating cycle is the average amount of time between acquiring raw materials and converting them into cash by sale of goods. Now current assets are maintained for operating purposes. These assets include cash or items expected to be converted to cash, like trade receivables or account receivables, or assets expected to be used up, like office supplies and prepaid expenses. Alternatively, the current asset may be inventory that is expected to be sold in the current period. Similarly, current liabilities are liabilities expected to be settled within 1 year or within one operating cycle of the business. For the purpose of classifying a liability as current liability, it should meet certain criteria. Now this criteria is shown here. Firstly, a liability can be classified as current liability only if it is expected to be settled in the entity's normal operating cycle. Also, the current liability can be classified as current if it is held primarily for purpose of being traded. Also, if the liability is due to be settled within 1 year after the balance sheet date, then it forms part of a current liability. Also, if a liability is a current liability, the entity should not have an unconditional right to defer its settlement by more than 1 year. Now let's look at the common classifications under current assets. First of these is cash and cash equivalents. Now here cash equivalents are highly liquid, short-term investments that are close to maturity. These are essentially financial assets which are reported at fair value. Then you have marketable securities, which are also financial assets, and they include investments in debt or equity securities that are traded in a public market. Their price is determined from price information in the public market. Examples of marketable securities include treasury bills, bonds, equity securities, and mutual funds. Another commonly found current asset is trade receivables, also known as accounts receivable. These are amounts owed to a company by its customers for products and services which have already been delivered. Another commonly found current asset is inventories. Inventories are physical products that will be eventually sold to the customers either in their current form as finished goods, or inventories may be raw material kept as an input to be converted into finished goods. Apart from this, you may have some other current assets which may not be individually material enough to require a separate line item on the balance sheet. So all these current assets are aggregated into a single account. Apart from this, in case of V group, we see some more items listed under current assets. The details of such items are usually found in notes to account section of the financial statement, but their nature would be similar to the different types of current asset we have discussed. Similarly, we have common classifications under current liabilities. The first of these is trade payables, also known as account payables. Trade payables or account payables are amounts the company owes its vendors for purchase of goods and services. So any goods or services which have been purchased but their payments have not been made, they would be classified as current liabilities under trade payables or account payables head. Now these essentially represent the unpaid amount for goods and services taken on credit from the vendors. Another current liability is notes payables, which are financial liabilities owed by a company to creditors, including trade creditors and banks, through a formal loan agreement. If any of these arrangements are due within 1 year, then they come under the head notes payables. Another current liability is tax payable, which reflects taxes based on taxable income that have not yet been paid. Similarly, you might have a range of current liabilities that you may find on different balance sheets. Now you can often read the notes to account section of the financial statement to understand what payments due they represent. Now in the next video, we'll look at some other components of the balance sheet, starting with the non-current assets and the non-current liabilities. Welcome back. Now let's look at some other assets which are not current assets and hence are known as non-current assets. These are also known as long-term or long-lived assets. Let's look at some common non-current assets. Starting with property, plant and equipment. These are tangible assets used in company operations and are expected to provide economic benefits over more than one fiscal period. Example of tangible assets include land, buildings, equipments, machinery, furniture, and even natural resources like minerals and petroleum resources. Property, plant and equipment are reported at their historical cost, which is adjusted for depreciation or impairment due to age or wear and tear. Hence, depreciation is accumulated over the life of an asset and subtracted from historical cost to arrive at the value of this asset. Another non-current asset is investment property. This asset is the property which is not used for production of goods or services or for administrative purposes. Instead, it is used to earn rental income or capital appreciation or both. The next common non-current asset is intangibles. These are essentially identifiable non-monetary assets without any physical substance. Examples of intangibles include patents, licenses, and trademarks. Goodwill is another intangible, which is a result of a company paying a premium above the fair value of the assets being acquired as part of a merger or acquisition. This excess amount over the fair value is recorded as goodwill on balance sheet and is another intangibles. There may be a range of other non-current assets on the balance sheet as separate items, and they can be understood by going through the notes to account section associated with them. Now let's look at different types of non-current liabilities. Simply put, all liabilities not classified as current liabilities are considered to be non-current or long-term liabilities. Let's look at two common types of non-current liabilities. First of these is long-term financial liabilities, which includes loans and notes payable or bonds payable. Liabilities such as loan payables and bond payables are reported at amortized cost on the balance sheet. For example, if a company issues $10 million of bonds, then the bonds are reported at a long-term liability value of $10 million. The next common non-current liability is the deferred tax liability. Deferred tax liability is a result of difference between a company's income as reported for the tax purposes and the income as reported for financial statement purposes. So for example, if a revenue is not recorded for tax purposes but is reported in income as part of financial statement of the company, then the taxes associated with the income have not been paid and hence are a liability that would need to be settled in the future. This liability is recorded as deferred tax liability. As you can see here, there are other non-current liabilities for this company, but their nature would be similar to what we described here, and essentially they represent long-term obligations of the company that would need to be settled in the future. With this, we come to the end of the discussion on non-current assets and liabilities. In the next video, we'll look at another component of the balance sheet, which is known as the owner's equity. Welcome back. Next, let's look at another component of the balance sheet, which is equity. Now, equity is the owner's residual claim on a company's assets after subtracting its liabilities. Equity represents the claim of owner against the company. It includes funds directly invested in the company by the owners, as well as earnings that have been reinvested over time. Now let's look at the various possible components of equity. Now note that not all components that we are going to discuss may be found on all balance sheet. As we discuss these components, you will see that some of them are not shown in case of V group balance sheet, but for a complete understanding, we'll briefly cover each of the components. The first component of equity is capital contributed by owners, also known as common stock or issued capital. This is the amount contributed to the company by the owners. Ownership of a corporation is represented through issuance of common shares. For each company, the number of shares authorized, issued, and outstanding must be disclosed to the shareholders. The number of shares authorized represent the number of shares that may be sold by the company under its article of incorporation. The number of issued shares refers to those shares that have been sold to the investors, and the number of outstanding shares consists of issued shares less treasury shares. We'll see what are treasury shares in a bit. The second component of equity is preferred shares. Preferred shares have rights that take precedence over the rights of common shareholders. These rights refer to receipts of dividend and also receipts of assets if the company is liquidated. The next component of equity is treasury shares. These are the shares of the company which have been repurchased by the company and are held as treasury shares rather than being cancelled or extinguished. The company can in future sell or reissue these shares. Companies repurchase their shares if they perceive them to be undervalued or if they need to use them to pay as stock options to the employees. So it is up to the company to either cancel or extinguish these shares or hold them as part of equity on their balance sheet in the form of treasury shares. The next important component of equity is retained earnings. This is the cumulative amount of earnings recognized in a company's income statements. It represents the share of profits of shareholders that have not been repaid to them as dividends. The last component of equity is known as the minority interest or non-controlling interest. This represents the equity interest of minority shareholders of the subsidiary companies that have been consolidated by the parent company, but these subsidiary companies are not wholly owned by the parent company. So while all assets of the subsidiaries are included in the consolidated balance sheet, in order to represent the fact that the parent company does not wholly own the subsidiary, in the equity section of the balance sheet, a section known as minority interest is created to represent the share of minority interest shareholders. Now with this, we have broadly seen the various components of a balance sheet. In the next video, we are going to briefly look at the income statement. Welcome back. In this video, we are going to look at another important component of financial statement, which is the income statement, also known as the profit and loss statement. The income statement represents information on financial results of the company's business activities over a period of time. It communicates how much revenue and other income the company generated during a period, and also the expenses it incurred to generate the revenue and other income. Revenue reflects amount charged for delivery of goods or services in the ordinary course of business. Other income includes gains which do not arise in the ordinary course of business. Expenses represent outflows or depletion of assets and incurrence of liabilities that decrease equity. Expenses include cost of sales, which is essentially the cost of goods that were sold, administrative expenses, and income tax expenses. Now, income statement has calculation of net income, which is governed by this equation here. According to this equation, your net income is equal to revenue plus your other income minus all your expenses. Net income is also commonly referred to as the bottom line because of its proximity to bottom of the statement. Other names of net income are net earnings, net profit, and profit or loss. In the event the expenses exceed revenues and other income combined, then the result is referred to as a net loss. The basic equation governing income statement is shown here. So your revenue plus your other income minus all the expenses is your net income. You can actually combine the first two terms, which is the revenue and other income, and call it total income, and then this equation becomes total income minus expenses equals your net income. If one company, which we may call the parent, controls another company, which we may call the subsidiary of the parent company, then the parent company is required to present its own financial statement consolidated with that of its subsidiaries. This is mandatory when the parent holds more than 50% stake in the subsidiary company. Each item in the consolidated income statement includes the entire amount from the relevant item from the subsidiary's income statement. However, if the parent does not own 100% stake, then it is necessary for the parent to present an allocation of net income to the minority interest. Minority interest refers to owners of the remaining shares of the subsidiary that are not owned by the parent. The share of consolidated net income attributable to minority interest is shown at the bottom of the income statement along with the net income attributable to the parent company. Let's look at our V Group income statement. Now V Group sales were at 105,187 million at the end of 2009. Subtracting the cost of sales from revenue gives your gross profit of 13,579 million. After subtracting operating costs and expenses and adding other operating income, the company's operating profit totals 1855 million. Now the operating profits represent the results of the company's usual business activities before deducting your interest expenses or taxes. Operating profit is often also referred to as earnings before interest and taxes or EBIT. Now operating profits of V Group is increased by V Group's share of profits generated by certain of its investment of about 701 million and also by profits from its other financial activities of about 972 million. These profits are decreased by the financing cost or the interest expense of about 2268 million, which results in profits before tax of 1261 million. Total income tax expense in 2009 is 349 million, resulting in profit after tax or net income of 911 million. After allocating losses attributable to minority interest ownership in V Group subsidiary companies, the profit attributable to shareholders of V Group for 2009 is 960 million. Companies also present what is known as both basic and diluted earnings per share in their income statement. Earnings per share represents the net income attributable to all shareholders divided by the number of shareholders. Basic earnings per share is calculated by using the number of ordinary shares actually outstanding during the period and profit and loss attributable to ordinary shareholders. So when you divide the profit or loss attributable to ordinary shareholders by the number of ordinary shares actually outstanding during the period, you get your basic earnings per share. On the other hand, diluted earnings per share calculation uses diluted shares, that is the number of shares that would hypothetically be outstanding if all potentially dilutive claims of common shares like stock options or convertible bonds were exercised and converted by their holders, which would result in an increase in the number of shares outstanding and also a decrease in the share of earnings for the existing shareholders. V Group also has two types of shareholders, which is the ordinary shareholder and the preferred shareholder, and V Group presents the EPS for both these types of shareholders. From this statement, it is clear that V Group ordinary shareholder basic earnings per share is 2.38 euro. That is, for every share that a shareholder owns, the company is making an earning of 2.38 euros for the period. The actual calculation of these numbers by every company is usually presented in notes to account section as part of the financial statements. Often these numbers are used in valuation ratios, which we are going to see in a later lecture. For now, we'll move on to our next lecture, where we'll look at the statement of changes in equity, which is another important section of the financial statement. Welcome back. Now we will look at the statement of changes in equity, which is also known as statement of changes in owner's equity or statement of changes in shareholder equity. Now this section of the financial statement serves to report changes in the owner's investment in the business over time. The first basic component of owner's equity is the paid-in capital, which essentially is a result of issuing shares to the investors. The other component of owner's equity is retained earnings. Now retained earnings includes the cumulative amount of company's profit that have been retained in the company. Now for each component, this statement of changes in equity presents the beginning balance. It also presents any increase during the period or any decrease during the period, and ultimately after summing it up, it also presents the ending balance. So for example, the paid in capital of a company can increase in case there is a new issuance of stock by the company, and the paid in capital can decrease if the company repurchases any of its previously issued stock. In case of retained earnings, if the company has had a profitable year, then the retained earning increases because of an increase in income. However, in case the company pays some of these profits generated in the year in the form of dividend to the investors, then this will result in a decrease in the retained earnings. So for example, in case of V Group, the equity at the end of 2009 is 37,430 million, while equity at the end of 2008 was 37,388 million. Now in this statement of changes in equity, you see that the equity amount in 2008 is reduced due to dividend payment and increased due to comprehensive income and deferred tax. So this is what is shown in the statement of changes in equity. Basically, the statement of changes in equity summarizes the changes that have taken place to the equity capital of the firm over the relevant period. Now in the next lecture, we'll look at another important component of the balance sheet, which is known as the cash flow statement. Welcome back. Now in the previous videos, we looked at the income statement and the balance sheet. Now these provide us measures of a company's success in terms of performance. Essentially, by looking at the income statement, you see what was the net profit or net loss of the company during the period. So this is a measure of the company's performance. By looking at the balance sheet, you get to see what the company has achieved over the period of its existence. So by looking at the balance sheet, you can have a fair knowledge of the financial position of the company. Now cash flow statement is another important component of the financial statements. Cash flow statement, as the name suggests, tells you about the flow of cash to and from the company. So essentially, through a cash flow statement, the company discloses the sources and uses of cash. So by looking at the cash flow statement, you can say that from where the company received all its cash during the period, and you can also tell how it deployed this cash over the period. When a company discloses the sources and uses of cash, it helps the creditors, investors, and anyone who is looking at the company in evaluating the company's solvency, liquidity, and overall financial flexibility. When we say financial flexibility, we mean the ability of the company to adapt and react to financial adversities and opportunities. A cash flow statement essentially classifies all cash flows to the company or from the company into three categories. These categories are the operating activities, investing activities, and the financing activities. Let's start with the bottommost activity. Cash flow from financing activities are cash flows from activities related to obtaining or repaying capital to be used in the business. So financing activities include obtaining or repaying capital such as equity and long-term debt. The two primary sources of capital are shareholders and creditors. So cash inflows includes cash receipts from issuing stock or bonds. So whenever the company issues a stock or a bond, it receives a cash inflow in exchange. On the other hand, cash outflows include cash payments to repurchase stock or to repay bonds and other borrowings. The next important category of cash flow is cash flow from investing activities. Now, cash flow from investing activities includes purchasing and selling long-term assets and other investments. These long-term investments include property, plant and equipment, intangible assets, or other long-term assets, and both long-term and short-term investments in equity and debt issued by other companies. Cash inflows in investing activity includes cash receipts from sale of non-trading securities, property, plant and machinery, intangibles and other long-term assets. Cash outflows include cash payments for the purchase of these assets. So for example, when you buy a machinery, there would be a cash outflow. So this would be a part of your cash flow from investing activities and it will be a cash outflow. Similarly, if the company were to sell a property, then it will receive cash in exchange of selling that property. So this will be part of cash inflow from investing activity. Then lastly, you have cash flow from operating activities. These are activities not classified as either investing activity or financing activity, and they generally involve cash effects of transaction that determine net income, and hence they arise from day-to-day operations of the company. So all your cash flows which arise from day-to-day operations of the company are classified as cash flow from operating activities. The cash effects of these transactions directly determine your net income of the company. Hence, operating activities include the company's day-to-day activities that create revenues, such as selling inventory or providing services. Also, any other activity that cannot be classified as investing or financing forms part of your cash flow from operating activity. In general, the cash inflows as part of operating activity results from cash sales and from collection of accounts receivable. Similarly, cash outflows which form part of cash flow from operating activity result from cash payments for inventory or payment for salaries, taxes, and other operating related expenses. Cash outflows under operating activity may also result from paying your accounts payable. Now let's look at an example of a cash flow statement. Here is the V Group cash flow statement. It starts with the profit before tax of 1261 million. Then you subtract the actual income tax payments and then adjust this amount for effect of non-cash transactions, accruals and deferrals and transactions of financing and investing nature to arrive at the amount of cash generated from operating activities. This amount is 12,741 million. The way the statement is shown here is known as the indirect way of cash flow reporting, because what you do is you start with the profit before tax and you adjust this amount for effect of non-cash transactions to arrive at the amount of cash generated from operating activities. There is another way of reporting cash flow statement known as the direct reporting, which we are not covering for now. Now the indirect method emphasizes different perspectives of income statement and cash flow statement. On income statement, income is reported when the income is earned and not necessarily when cash is received. Similarly, expenses are reported when incurred and not when actual payment is made. So for example, if you made a sale to a customer and delivered the goods, then you would recognize this income as part of your income statement, but the customer may not immediately make payment to you. So the date on which the cash is received for this sale may be different from the date on which you recognize the income on your income statement. Similarly, in case of expenses, the expenses are reported when they are incurred and not when the actual payment is made. So for example, if you received certain goods, you know that you have an obligation to pay to your supplier or the vendor, but you might not make this payment immediately. So the date on which this expense is accounted for in your income statement might be different, while you might make an actual payment on a different date. The cash flow statement presents another way to look at the performance of the company. Specifically, it tells you about the ability of a company to generate cash flow from running its business. This is essentially the part of your cash flow from operation. This number tells you how much cash the company is generating from running its business. Ideally, an established company should generate most of its cash flow from its operating activities rather than generating cash flows from investing or financing activities. When you sum up the net cash flow from operating activities, investing activities, and financing activities, after taking into account the effect of exchange rates on cash, the sum of all these cash flows essentially equals the net change in cash during the fiscal year. So for example, in case of V Group, the sum of these items is 8,792 million in 2009. Since this is a positive amount, it results in an increase in cash for the V Group at the end of the period. To keep things simple, we are not covering other details of cash flow statement for now. In the next lecture, we are going to look at another component of financial statement, which is the financial notes. and supplementary schedules. Welcome back. Now in this lecture, we are going to look at financial notes and supplementary schedules that always accompany every financial statement by a company. The notes, which are sometimes also referred to as footnotes, always accompany the financial statements of the company. These notes help you in better understanding the income statement, balance sheet, and the cash flow statements. For example, the notes to account to V Group balance sheet may clearly mention that the fiscal year for the company corresponds to the calendar year, that the statement has been prepared on a consolidated basis, that is, it includes performance of the subsidiaries of the company also. Financial notes are also used to disclose what accounting policies have been followed with respect to depreciation and inventories and other such issues. It may also disclose what is the company's revenue recognition policy, as in when the company recognizes the revenue. A company may decide to recognize the revenue when it ships its goods, or it may decide to recognize the revenue when the shipment is actually delivered and accepted by the customer. All these details are found in the notes accompanying the financial statement. You should understand that all this information is very important in determining the validity of the numbers provided by the company and how these numbers may be impacted by the change in policy. Also, by looking at the notes associated with the account statements, you will get a complete picture as to whether the company is aggressive or conservative with respect to recognizing revenues and expenses. While this may seem insignificant to someone new to investing, the truth is that notes to account is the single most important source for information in determining the quality of numbers provided in the financial statements. Also, often companies use the notes to account section to provide information on other factors that may affect the operational or financial performance of the company, especially if these factors are not captured as part of balance sheet, income statement, or the cash flow statement. So for example, information related to any contingent claims arriving out of legal issues or derivatives, or any guarantees or other such off balance sheet items can only be found in notes to account. So for example, if the company is facing a lawsuit, then this information you will find in the notes to account. Or if the company has given a guarantee on behalf of one of its subsidiaries, then this information can also be found only in the notes to account. As you can understand, this information is important to take into account before you make any investment decision. Next, let's look at another section within the financial statement, which is known as management discussion and analysis. Now, all publicly traded companies include a section in the annual report titled Management Discussion and Analysis. In this section, the management of the company discusses a variety of issues of concern, including the nature of business, the past result performance, and the future outlook of the company. This section is referred to by various names, including management report, or management commentary, or operating and financial review, or simply management discussion and analysis. A fair management is expected to highlight any favorable or unfavorable trends and identify significant events and uncertainties that may affect the company's liquidity, capital resources, and future results of operations. Also, managements are expected to provide information about the effect of inflation, changing prices, or other material events that may affect the future operating results or the financial condition of the company. In addition, the management may provide information on off balance sheet items, contractual commitment like purchase obligations, and also critical accounting policies or changes associated with accounting policies that may have significant impact on reported financial results. While in general there is no regulation with respect to what should be part of management discussion and analysis, nevertheless, many regulators are moving in this direction to standardize the content of this section also, so that it is made more relevant for the investors. With this, we have broadly covered the contents of most financial statements. Now what we are going to do is move towards analyzing the information provided in these statements. So in the next video, we are going to see how we can analyze the balance sheet of a company. Welcome back. Now that we have seen the basics of financial statements, we'll now look at how we can actually analyze balance sheets. There are essentially two tools to make this analysis. These tools are known as the common size analysis and the balance sheet ratios. In this video, we are going to look at what is known as a common size analysis of the balance sheet. In a later video, we'll look at the ratio analysis. Now, analysis of a company's balance sheet provides insights into the company's liquidity and solvency. Let's first understand these terms liquidity and solvency. Liquidity refers to a company's ability to meet its short-term financial commitments. Assessment of liquidity requires evaluating a company's ability to convert assets to cash and to pay for operating needs. On the other hand, solvency refers to a company's ability to meet its financial obligations over the long term. Assessment of solvency requires evaluating a company's financial structure and its ability to pay long-term financial obligations. Now let's understand the tools for analyzing the balance sheet one by one by starting with the common size analysis. A vertical common size analysis involves stating each balance sheet item as a percentage of total assets. Common size statements are useful in comparing the company's balance sheet composition over time and across companies in the same industry. Let's look at an example. Now this table has balance sheets of three hypothetical companies. Company C with assets of 9.75 million is much larger than Company A and Company B, both of which have 3.25 million in assets. Let's look at a common size balance sheet for these three companies, which we use to compare these companies. Now this is the common size balance sheet for these three companies. What you can see here is that most of the assets of Company A and Company B are current assets. However, Company A has nearly 60% of its total assets in cash and marketable securities, while Company B has only 6%. Hence, Company A is more liquid than Company B, since it can quickly meet any cash obligation that may arise in its usual course of business. Next, we see that the Company A has not much of a current liability, as its current liabilities are less than 10,000, while it has a cash of 1 million, which is more than sufficient to meet any near-term financial obligation it might have. In contrast, Company B has 2.5 million in current liabilities, which actually exceeds the available cash of only 200,000. To pay these near-term obligations, Company B will need to collect some of its account receivable, sell more of its inventory, or maybe, if this does not materialize, it may need to borrow from a bank or raise long-term capital. Company C also looks more liquid than Company B, as it holds over 30% of its total assets in cash and short-term marketable securities. At the same time, Company C's current liabilities are only 6.2% of the total assets. Also, we note that the Company C's 3.3 million in cash and short-term securities is substantially more than its current liabilities of 600,000. But if we were to look at the solvency, we see that 98.5% of Company C's assets are financed with liabilities. If Company C experiences significant fluctuation in cash flows, it may not be able to pay interest and principal on long-term liabilities. Hence, Company A is a lot more solvent than Company C because it has less than 1% of assets financed with liabilities. The common size balance sheet analysis may also reveal difference in a company's strategy. So in this case, by comparing the asset composition, we see that the Company C has made a greater proportion investment in property, plant and equipment, probably because it manufactures more of its products in-house. On the other hand, presence of goodwill in case of Company B balance sheet signifies that it has made one or more acquisitions in the past, as any excess price paid over the assets of a target company are recorded as goodwill on the balance sheet. In general, the common size analysis is useful for cross-sectional analysis, that is comparing companies with each other for a particular time period or comparing a company with an industry or sector data. In this video, we have broadly covered common size analysis of balance sheet. In the next video, we are going to look at the common size analysis of income statement. Welcome back. In the previous video, we looked at the common size analysis of balance sheet. In this video, what we are going to do is look at the common sense analysis of income statement. A vertical common size income statement divides the income statement item by revenue for non-financial institutions. However, in case of financial institutions, the vertical common size income statement divides the income statement items by total assets of the institution. Apart from this, if there are multiple revenue sources for a company, a decomposition of revenue in percentage terms is also useful in analysis of the income statement. Let's look at an example of common size analysis of income statement. Now this is a hypothetical company's common size income statement in 2 time periods. Revenue is separated into company's 4 services. Each of these is shown as a percentage of total revenue. Now here we see that the revenue from service A became far greater percentage wise in the second period. So one should ask, what are the possible reasons or implications of this change in the business mix? One question that can come to your mind is, did the company make a strategic decision to sell more of service A because it is more profitable? But when we look at the earnings before interest, taxes, depreciation and amortization, which is known as the EBITDA, we see that the EBITDA declined from 53% of sales to 45%. So probably the reason for selling more of service A is not because it is more profitable. So in this case, we'll need to look for other possible explanation for this change in the business mix. If no other reason is obvious, then this can become a good question to be asked to the management. Also, we note from the composition of operating expenses that the employee benefits have increased from 15% to 25% of total revenue, and this is a main reason for decline in the profitability of the company. Hence the natural question is, are more highly compensated employees required for service A, or maybe was a higher training cost incurred in order to increase the revenue from service A? If one has to predict future performance, then such reasons might need to be understood in detail. Also here we see that the company's income tax as a percentage of sales has declined dramatically from 15% to 8%. Also taxes as percentage of earnings before tax has decreased from 36%, which is calculated by dividing 15 by 42, and this has decreased to 24%. This raises the question that is service A provided in a jurisdiction with low tax rate because its contribution is higher in the period 2. So with this we saw how we can do a common size analysis of income statement and make some conclusions about what is happening in the business. You might end up in a situation where you might have questions that cannot really be answered from just looking at the financial statement. In such a scenario, it is best to attend the investor meet and ask the management directly regarding these questions so that you can understand what changes the business is going through. Now in the next video, we are going to look at the common size analysis of the cash flow statement. Welcome back. Now we saw that in common size analysis of income statement, each income and expense line item is expressed as a percentage of net revenue, which is essentially the net sales of the company. In case of common size analysis of balance sheet, each asset, liability and equity line item is expressed as a percentage of total assets. Now in case of common size cash flow statement, there are two alternative approaches. The first approach is to express each line item of cash inflow as percentage of total cash inflow, and similarly expressing each line item of cash outflow as percentage of total cash outflow. This approach helps us clearly see what dominates the cash inflow or outflow. Another method to perform common size cash flow statement analysis is to express each line item as percentage of net revenue. Now in this example for this company, we see that in case of the inflows, the common size statement is telling us that around 97% of the inflows came through receipts from customers and only close to 3% of the receipts came through sale of equipment. Similarly, in case of outflows, we are expressing all the outflows as percentage of total outflows, and we see that here payments to suppliers dominate the outflows, so that around 49% of outflows are because of payments to the suppliers. The next highest contribution to outflows comes from the payment to employees as employee expense probably. And the next highest source of outflow is the payments for other operating expenses. So by looking at the common size analysis, it is easy to determine what dominates the cash inflow or the cash outflow. Now in the next example here, we see that the common size analysis is expressed as a percentage of net revenue. Under this approach, each line item in the cash flow statement is shown as a percentage of net revenue. This common size exhibit is developed using the net revenue of 23,598 for the company. Each line item is expressed as a percentage of net revenue. The common size format makes it easy to see the trends in cash flows rather than just looking at the total amount, and it is very easy to use this common size statement to forecast future cash flows. This is so because each line item is represented as a percentage of net revenue. Now if an analyst forecasts net revenue for the future period, he can use the same ratios to determine forecast for each line item. Now let's take another example of common size cash flow analysis using the net revenue. Now we have shown here a hypothetical company and its cash flow expressed as a percentage of net revenue for a period of 3 years. Let's see what conclusions can be drawn by looking at this. So for example, here we see that the depreciation and amortization expense is less than 2% of the total net revenue in the year 2010. However, as a percentage of total revenue, it has been increasing each year. And in the year ending 29 January 2010, adding this expense back to determine operating cash flow has a significant impact on the cash flow from operations as a percentage of total revenue because its size was approximately 60% of the net profit margin. Also, we see that this company's capital expenditure is relatively small. It is less than 1% of revenues in most recent years, and the cash flow from operations as a percentage of total revenue indicates that operating cash flows are more than sufficient to cover these expenditures. Also, we see that the company's operating cash flow as a percentage of revenue is usually much higher than the net profit margin, with the exception of the year 2009. In that year, it seems the net profit margin was 4% and operating cash flow as a percentage of total revenue was 3.1%. The primary difference between the year and the other years appears to have been a significant reduction in accounts payable. In each of the other years, accounts payable increased. For the year ending 29 January 2010, the operating cash flow as a percentage of total revenue was 7.38% and the net profit margin was 2.71%. Also, let's see how this company uses its positive operating cash flow. In the year ending 29 January 2010, the largest cash outflow was for acquisition of business, which is essentially an investing activity. In prior years, much of this company's operating cash flow was used to repurchase its own stock, which actually comes under the financing activity. In each of these 3 years, the company's purchases of investments were less than the amount of maturities and sale. Thus, on a net basis, the investments of the company proved to be a net source of cash. With this, we have come to the end of common size analysis. In the next few videos, we'll look at ratio analysis for different components of financial statements. Welcome back. Now, starting from this lecture, we are going to look at financial ratios. A financial ratio expresses one financial quantity with respect to another and conveys some aspect of a company's performance or valuation. For example, one common ratio is net profit margin, which is calculated by using the net income and dividing the net income by revenue. This ratio essentially tells you the percentage of revenue in excess of all its costs, which results in a profit for the company. For example, this ratio can be used to answer the question that which company is more profitable when comparing two or more companies. Let's look at an example. Say company A has 100,000 as net income, while company B has 200,000 as net income. So you see that the company B generates twice as much net income as company A. But if company A revenue is 2 million, while the company B revenue is 6 million, you see that the profit margin of company A is given by 100,000 divided by 2 million, which is 5%, while the profit margin for company B is given by 200,000 divided by 6 million, which is close to 3.33%. So company A generates $5 profit for every $100 in revenue, while company B generates $3.33 profit for every $100 revenue. Hence, actually, the company A is more profitable despite the fact that the company B is reporting higher revenue and net profit. However, this analysis does not tell us why company A is more profitable than company B, and we would need to dig deeper to answer that question. Now, ratio analysis enables investors to evaluate past performance, assess the current financial position of the company, and gain insights useful for projecting the future results. The ratios serve as an indicator of some aspect of a company's performance. We have listed these various aspects here. The first aspect is the company's financial flexibility or ability to obtain cash required to grow and meet its obligation. The next aspect may be the management's ability to manage a company efficiently. Also, the ratios will help you track the changes in the company or industry over time. Also, ratio analysis enhances the comparability of a company with its peer companies or with the relevant industry. Theoretically, it is possible to calculate a number of ratios, but for our purposes, we are going to categorize ratios based on what aspect of performance a ratio is intended to measure. Common ratio categories includes activity ratios, liquidity ratios, solvency ratios, profitability ratios, and valuation ratios. Let's briefly see the definitions of these different categories, and then we will have a look at few of the ratios in each of the categories. The first category of financial ratio is the activity ratio. Activity ratios measure how effectively a company performs its day-to-day tasks, such as the collection of receivables and the management of inventory. The next category of financial ratio is the liquidity ratio, which measures the company's ability to meet its short-term obligations. Then you have the solvency ratios, which measures a company's ability to meet its long-term obligations. The next category of ratios is the profitability ratios, which measures the company's ability to generate profits from its resources. Then you have the valuation ratios, which measures the quantity of an asset or cash flow associated with the ownership of a company's share. One should understand that these ratios are not mutually exclusive. For example, if there is an activity ratio that measures how quickly the company collects its receivables due from its customers, it is also useful in assessing the company's liquidity because the collection of revenues increases the cash available to the company. Now, in the next few videos, we'll look at a variety of ratios associated with each of these categories. Welcome back. In this video, we are going to look at activity ratios. Activity ratios are also known as asset utilization ratios or operating efficiency ratios. These ratios measure how well a company manages various activities, particularly how efficiently it manages various assets. These ratios are analyzed as indicators of ongoing operational performance, that is, how effectively assets are utilized by a company. As we said in the last lecture, efficiency of assets may have a direct impact on liquidity also, so some activity ratios are also useful in assessing liquidity. In this table here, I have shown some commonly used activity ratios. The table shows what item should be used in the numerator and what item should be used in denominator of each ratio. Activity ratios generally combine information from the income statement in the numerator and information from the balance sheet in the denominator. Income statement measures what happened during a period, whereas balance sheet shows condition at the end of the period. So to judge the performance during the period, it is important to take into account data both at the beginning of the period and end of the period so that we don't end up giving importance to only the performance of the current period. Hence, it is common to use average balance sheet data using the end of the period values and the beginning of the period values instead of just using the end of the period value. So for example, in order to calculate inventory turnover, an income item cost of goods sold is used. This item essentially is cost of inventory that has been sold. In the denominator though, average inventory is used, which takes beginning of the year inventory value and end of the year inventory value and divides it by 2 to calculate the average. This ratio inventory turnover actually calculates how many times per year the average inventory is being sold. For example, if this year for a company, the cost of goods sold is 120,000 while the average inventory is 10,000, the ratio is 120,000 divided by 10,000, which is just telling you that in an year the company is actually selling its average inventory 12 times, which also means it is able to clear its inventory once every month. This is represented in another way by calculating the days of inventory on hand. In short, this is known as DOH. This number is calculated by dividing the number of days in a year by the inventory turnover. So in this example, the DOH comes to 365 divided by 12 or 30.42, meaning that the company kept around 30 days of inventory on hand. Now let's discuss all the ratios one by one and their interpretation. We'll start again with the inventory turnover and DOH. Inventory turnover lies at the heart of operations for many entities. It indicates resources tied up in inventory and is a good indicator of inventory management effectiveness. A high inventory turnover implies that the inventory is held for shorter time. This means lower DOH. For any company, this number should be compared with its peers in the same industry to take a call on its effectiveness. A high ratio value relative to the industry might indicate a highly effective inventory management. Alternatively, it could also indicate that the company is not carrying adequate inventory, so inventory shortage might be potentially hurting its revenues. To assess which explanation is more likely, the analyst should compare the company's revenue growth with that of the industry. Slower growth combined with higher inventory turnover could indicate inadequate inventory levels. However, revenue growth at or above industry level might indicate that higher turnover is a result of greater inventory management efficiency. A low inventory turnover ratio relative to industry might be an indicator of slow moving inventory, maybe due to technological obsolescence or a change in fashion. In the next video, we'll look at some more activity ratios. Welcome back. The next ratio we will discuss is receivables turnover and DSO. DSO stands for Days Sales Outstanding. Now receivables turnover is calculated by dividing the revenue with average receivables. Average receivables is receivables at the start of the period and end of the period combined and divided by 2. And the days of sales outstanding or DSO is calculated by dividing the number of days in a period by the receivables turnover. This number DSO represents the elapsed time between sale and cash collection, reflecting how fast company collects cash from the customers. A relatively high receivables turnover might indicate highly efficient credit and collection. Alternatively, it might indicate that the company's credit or collection policies are too stringent, suggesting the possibility of sales being lost to competitors offering more lenient terms. A relatively low receivables turnover raises questions about efficiency of company's credit and collections procedure. Again, one might need to compare these figures with sales growth of the company to come to any conclusion. The next ratio we will discuss is payables turnover and number of days of payables. Number of days of payables reflects the average number of days the company takes to pay its suppliers, and the payables turnover ratio measures how many times per year the company theoretically pays off all its creditors. Payables turnover is given by purchases divided by the average trade payables, while the number of days of payables is given by dividing the number of days in a period by the payables turnover. If purchases are not available to calculate payables turnover, then one can use costs of goods sold plus ending inventory minus beginning inventory, essentially this formula, as a proxy for purchases. Sometimes cost of goods sold can directly be used as an approximation for purchases. A high payable turnover or a low number of days of payables relative to industry may indicate that the company is not making full use of available credit facilities. Alternatively, it may be getting a discount on early payment. An excessively low payable turnover may indicate trouble making payments on time, or it may indicate exploitation of lenient supplier terms. This is where one would need to look at other ratios to get the exact reason for low turnover If liquidity ratios indicate that the company has sufficient cash and other short-term assets to pay the obligation, and if still the payment turnover is high, it is likely that the supplier is lenient on credit and collection. Now in the next video, we are going to look at part 3 of the activity ratios. Welcome back. In this video, we'll look at some more activity ratios. We'll start with the working capital turnover. Working capital is defined as current assets minus current liabilities. Working capital is the capital that should be available with the firm so that it can continue to operate smoothly. Working capital turnover is calculated by dividing a company's revenue by its average working capital. So for example, a working capital turnover of 4 would indicate that the company generates 4 euro of revenue for every 1 euro of working capital. A high working capital turnover indicates greater efficiency, that is, the company is generating a high level of revenue relative to the working capital. Sometimes working capital for a company may be negative. In that scenario, we cannot use this ratio for any meaningful analysis, but we can use other ratios that we discuss next. Next, let's look at the fixed asset turnover. Fixed asset turnover is calculated by dividing revenue by the average fixed assets. This ratio measures how efficiently the company generates revenue from its investments in fixed assets. Generally, a higher fixed asset turnover ratio indicates more efficient use of fixed assets in generating revenue. A low ratio can indicate inefficiency or a capital intensive business or a new business not yet operating at full capacity. This ratio will be lower for company whose fixed asset is newer than for an old company. This is so because the value of fixed assets is reduced by depreciation in case of an older company. Also, the fixed asset ratio can be erratic because even though revenue may have a steady growth, increases in fixed asset may not follow a smooth process. So every year-to-year change does not necessarily indicate important changes in company's efficiency. Next, let's look at the total asset turnover. This ratio measures a company's overall ability to generate revenues with a given level of assets. The ratio is calculated by dividing revenue by average total assets. A ratio of 1.2 indicates that the company generates $1.2 of revenue for every $1 of average asset. A higher ratio indicates greater efficiency. The total asset includes both fixed and current assets, so inefficient working capital may distort this ratio. So it is helpful to analyze working capital and fixed asset turnover ratios separately. A low asset turnover may indicate inefficiency or relatively capital intensive business. It also reflects strategic decision by management, for example, the decision to use more labor intensive approach or a more capital intensive approach. With this, we come to the end of activity ratios. In the next lecture, we'll look at liquidity ratios. Welcome back. In this video, we are going to look at liquidity ratios. Analysis of liquidity measures a company's ability to meet its short-term obligations. Liquidity measures how quickly assets are converted to cash. Liquidity ratios also measure the ability to pay off short-term obligations. In day-to-day operations of a company, liquidity management is achieved through efficient use of assets. In the medium term, liquidity in the non-financial sector is also addressed by managing the structure of liabilities. The level of liquidity needed differs from one industry to another. A company's liquidity position might vary according to the anticipated needs for funds at any given time. Now we have shown here some common liquidity ratios. These ratios represent a company's position at a point in time. Liquidity ratios typically use data from the ending balance sheet rather than the average values. The current, quick, and cash ratio reflect three measures of a company's ability to pay current liabilities. The defensive interval ratio measures how long a company can pay its daily cash expenses using only its existing liquid assets without any additional cash flow coming in. Lastly, the cash conversion cycle which is actually a financial metric and not an actual ratio, measures the length of time required for a company to go from cash paid to cash received. It is essentially the length of time funds are tied up in working capital. Let's look at each of these ratios one by one to understand them better, starting with the current ratio. The current ratio is calculated by dividing the current assets by current liabilities. Current assets are short-term assets. For example, when you sell goods on credit to someone, it results in a current asset on your balance sheet, which reflects the fact that the buyer owes you some money. Similarly, current liabilities are short-term liabilities. For example, when you buy some goods on credit from someone, it results in a current liability on your balance sheet, which reflects that you owe some money to them. A high value of current ratio reflects a higher level of liquidity, which implies greater ability to meet short-term obligations. A current ratio of 1 indicates that the book value of its current assets exactly equals the book value of its current liabilities. A lower ratio indicates less liquidity, implying greater reliance on operating cash flow and outside financing to meet short-term obligations. The next ratio we'll look at is the quick ratio. Quick ratio is more conservative than current ratio because it only includes more liquid assets among the current assets. Usually, current assets also include assets like prepaid expenses, taxes, and employer-related prepayments. These are costs that have been paid in advance and hence form part of current assets. But the fact is that these cannot be converted to cash. Similarly, while inventory is also part of current assets, it also cannot be quickly converted to cash. Hence, quick ratio uses the formula cash plus short-term marketable securities plus receivables in the numerator to reflect the assets that can be quickly converted to assets. This number is then divided by the current liabilities in the denominator. Since we use a more conservative number in the numerator, quick ratio is more conservative than current ratio. The next ratio we will look at is the cash ratio. Cash ratio is calculated by dividing only cash plus short-term marketable securities with current liabilities. This represents a reliable measure of an entity's liquidity in a crisis situation. In case of cash ratio, only highly liquid short-term securities and cash are included. This makes this ratio stringiest compared to current ratio and quick ratio. Next, let's look at the defensive interval ratio. This ratio is obtained by adding cash, short-term marketable securities, and receivables, and dividing this total by the daily cash expenditure. This ratio measures how long company can continue to pay its expenses from its existing liquid assets without receiving additional cash inflow. A defensive interval ratio of 50 would indicate that the company can continue to pay its operating expenses for 50 days before running out of quick assets, assuming it has no cash inflows. The higher this number, the greater the liquidity. In case for a company this ratio is lesser compared to its peers, then you should ascertain that the company has sufficient cash inflow expected to mitigate the risk. Lastly, let's look at a liquidity measure known as the cash conversion cycle, also known as the net operating cycle. This number is calculated by adding DOH, which as you would remember is the number of days inventory is on hand, plus DSO, which is the days sales outstanding, and then subtracting the number of days of payables. The first day DOH here represents the number of days inventory is on hand. So for this many days, cash is locked in inventory. Days sales outstanding represents days it takes to convert receivables to cash. So for these many days, cash is locked in receivables. The last term is number of days of payables, which is the number of days company takes or avoids to pay the cash to its suppliers. This actually completes the complete life cycle of cash in the company. This metric indicates the amount of time that elapses from the point when a company invests in working capital until the point the company collects cash from its customer. In a typical course of events, a merchandising company acquires inventory on credit, incurring accounts payable. The company then sells the inventory on credit, increasing amounts receivable. The time between this outlay of cash and collection of cash is called the cash conversion cycle. A shorter cycle implies that the company needs to finance its inventory and receivables for a short period of time. A longer cycle implies lower liquidity, and hence the company must finance its inventory and accounts receivables for a longer period of time, which indicates a need for higher level of capital to fund its current assets. With this, we have come to the end of liquidity ratios. In the next video, we'll look at solvency ratios. Welcome back. In this video, we are going to look at solvency ratios. Solvency refers to a company's ability to fulfill its long-term obligations, which is essentially its ability to make interest and principal payments. Solvency ratios provide information regarding the relative amount of debt in the company's capital structure and the adequacy of earnings and cash flows to cover interest expenses and other fixed charges like lease or rental payments. Solvency ratios are primarily of two types. First is the debt ratio, which focuses on balance sheet and measures the amount of debt capital relative to equity capital. The second type of solvency ratio is coverage ratios, which focus on income statement and measures the ability of a company to cover its debt payments. These ratios are useful in assessing a company's solvency and so are also useful for evaluating quality of a company's bond and other debt obligations. Here we see commonly used solvency ratios. Let's look at them one by one. First is the debt to assets ratio. It is obtained by dividing total debt by total assets, and this ratio measures the percentage of total assets financed with debt. So a debt to asset ratio of 0.4 indicates 40% of company's assets are financed with debt. Generally, higher debt means higher financial risk and thus indicates weaker solvency. The next ratio is debt to capital ratio, which is the ratio of total debt to total capital. Total capital is the sum of total debt and equity. Just like debt to assets ratio, a higher debt to capital ratio means higher risk and weaker solvency. The next ratio is the debt to equity ratio, which measures the amount of debt relative to equity capital. The interpretation of debt to equity ratio is the same, that is that the higher debt to equity ratio means higher risk and weaker solvency. The next ratio is the financial leverage ratio, which is obtained by dividing average total assets by average total equity. This ratio measures the amount of total assets supported by each dollar of equity. For example, a value of 3 for this ratio would mean that $1 of equity supports $3 of total assets. The higher the ratio, the more leveraged the company. The next ratio is the interest coverage ratio, which measures the number of times the company's earnings before interest and taxes covers its interest payments. This ratio is also referred to as times interest earned. A higher interest coverage ratio indicates stronger solvency, offering greater assurance that the company can service its debt. The last ratio we look at is the fixed charge coverage, which is calculated by dividing earnings before interest and taxes and lease payments by the interest payments and lease payments. It measures the number of times the company's earnings before interest, taxes, and lease payments can cover the company's interest and lease payments, which is actually the fixed charge for the company. A higher fixed charge cover implies higher solvency and offers greater assurance that the company can service its debt. With this, we have come to the end of solvency ratios. Next, we are going to look at the profitability ratios. Welcome back. In this video, we are going to look at profitability ratios. Now, the ability to generate profits is a key determinant of a company's overall value and the value of the securities it issues. Hence, it should be a key focus area of your analysis. Profitability reflects a company's competitive position in the market and to an extent the quality of management too. The income statement reveals the source of earnings and the components of revenue and expenses. Earnings can be distributed to shareholders or reinvested in the company. Reinvested earning enhances the solvency and provides a cushion against short-term problems. We have shown here some common profitability ratios. The various return on sales ratios express various subtotals on the income statement like gross profit, operating profit, and net profit by dividing them with revenue and thus measuring them as a percentage of revenue. The other type of profitability ratio is the return on investment profitability ratio. These ratios measure incomes relative to assets, equity, or total capital employed by the company. Now let's look at these ratios one by one. The first ratio we are looking at is the gross profit margin. Gross profit margin is measured as a gross profit divided by revenue. This ratio indicates the percentage of revenue available to cover operating and other expenses, and are they sufficient to create profits. Higher gross margin reflects combination of higher product pricing and lower product costs. The ability to charge higher prices is constrained by competition, and the company can charge more only if it has a competitive advantage. Also, higher gross profit margin may also indicate that the company has a competitive advantage in product costs. The next ratio is the operating profit margin, which is calculated by dividing the operating profit, which is also known as the earnings before interest and tax, and this value is divided by the revenue of the company to arrive at the operating profit margin. Operating profit is calculated by subtracting operating costs from gross profits. Hence, an operating profit margin increasing faster than the gross profit margin can indicate improvements in controlling operating costs like the administrative overheads. Similarly, a declining operating profit margin would indicate deteriorating control over operating costs. The next ratio we will look at is the pre-tax margin. This ratio uses pre-tax income, that is earnings before tax, which is also calculated as operating profit minus interest. The pre-tax margin is ratio of pre-tax income to revenue. The pre-tax margin reflects the effects on profitability of leverage and other non-operating income and expenses. If a company's pre-tax margin is increasing, primarily as a result of increasing amounts of non-operating income, the analyst should evaluate whether the increase reflects a deliberate change in a company's business focus and thus the likelihood that the increase will continue. The next ratio we'll look at is the net profit margin. This ratio is calculated by dividing net profits by revenue. Net profits are calculated as revenues minus all expenses. This ratio reflects the overall profitability of the company after accounting for all expenses, whether they be recurring expenses or non-recurring expenses. Another important ratio is the return on assets, which is calculated by dividing the net income by average total assets. This ratio measures the return earned by a company on its assets. The higher the ratio, the more income is generated by a given level of assets. Some analysts add back interest expense to the numerator to account for the fact that we are using total assets in the denominator, which is financed by both equity and debt. Hence, ROA formula is often modified by adding interest multiplied by 1 minus tax rate to the net income in order to get a fair picture of the returns generated by total assets. The next ratio is return on total capital, which is calculated by dividing earnings before interest and taxes by short and long term equity and debt. Hence, this ratio measures the profit a company earns on all of the capital that it employs, whether it be short term debt, long term debt, or equity. Another important ratio is the return on equity, which measures the returns earned by a company on its equity capital. Now, equity capital includes minority interest, preferred equity, and common equity. This ratio is calculated by dividing the net income minus preferred dividends with average common equity. preferred dividend is deducted because the company is required to pay this dividend to the preferred shareholders, and hence the income available to common equity shareholders is reduced to that extent. With this, we have covered a range of important profitability ratios. In the next video, we'll look at valuation ratios that help us make some better sense of valuations of different companies. Welcome back. In this video, we are going to briefly look at the different valuation ratios that have been used often in investment decision making. An example of a valuation ratio is the price to earnings ratio, also known as the PE ratio. It is one of the most widely cited indicator in discussing the value of stocks and relates price to earnings per share. Also, some analysts use some other market multiples like price to book value and price to cash flow in order to make some sense of the valuation of a stock. Here we have shown some common valuation ratios. The first important ratio is the price to earnings ratio, which is calculated by dividing price per share by the earnings per share. This ratio tells us how much an investor is required to pay for per dollar of earnings. So if the price to earning ratio is 10, then it would mean that for every $1 of earnings, the investor is paying $10. Because PE ratios are calculated using net income, this ratio can be sensitive to non-recurring earnings or one-time earning events. Also, net income is considered to be more susceptible to manipulation than cash flows, so it may be wise to see price to cash flow as an alternative measure, especially when earnings quality may be an issue. Also, instead of using the net income as earnings in the PE ratio, one can also use EBITDA, which is the earnings before interest, tax, depreciation and amortization. EBITDA per share is calculated using earnings before interest, taxes and depreciation. It can be used to eliminate the effects of different levels of fixed asset investment across companies. This facilitates comparison between companies in the same sector but at different stages of infrastructure maturity. Then another common ratio that is used is price to sales ratio. The price to sales ratio is calculated by dividing price per share with sales per share. Now this ratio is used as a comparative price metric, especially when a company does not have positive net income, so you cannot use its earnings to calculate the PE ratio. So when you have to compare a company which has no earnings with a company which has positive earnings, you won't be able to use the price to earnings ratio. In some cases, you may still try to make sense of the valuations by looking at the price to sales ratio. Another common ratio is the price to book value. Now, price to book value ratio facilitates useful comparison of a company's stock price. This ratio is often interpreted as an indicator of market judgment about relationship between a company's required rate of return and its actual rate of return. Assuming book values reflect the fair value of assets, a price to book value of 1 is interpreted as an indicator that the company's future returns are expected to be exactly equal to returns required by the markets. A ratio greater than 1 indicates that future profitability of the company is expected to exceed the required rate of return, and a value of less than 1 would indicate that the company's future profitability are not expected to exceed the required rate of return. Now, using book value as a measure in the price to book value can be misleading, especially when you are valuing technology companies. Now, typically technology companies do not have a lot of fixed assets, which means that there is a very high chance that their book values are not truly reflective of their true worth, because their true worth lies in the human resources of their company. In such scenarios, the price to book value ratio becomes irrelevant for your analysis. Similarly, while using any of these ratios, it is very important that you use your common sense in determining whether a specific ratio is applicable in case of the company you are analyzing. With this, we have come to the end of this section on financial ratios. Welcome back. Let's start by understanding the term technical analysis. Technical analysis is a form of security analysis This analysis uses price and volume data in order to make decisions regarding the future movement in price of the security. Since price and volume data are raw numbers, it could be difficult to directly interpret them. Hence, this data is often graphically displayed in order to ease analysis for decision making. The biggest advantage of technical analysis is that its application is not limited to any particular security or asset class. Hence, this technique can easily be used to analyze securities from different asset classes which are traded in a freely traded market. When we say freely traded market, we mean any market where willing buyers trade with willing sellers without any external impediment. The price of security in any freely traded market is a result of interaction of supply and demand for that security in real time. Since application of technical analysis only requires the price and volume data, it is often used for analyzing a wide range of financial instruments, including equities, bonds, commodity futures, and currency futures. Hence, the techniques you learn as part of this course can be readily applied to a variety of financial instruments. But before we look at various techniques, let's first understand the underlying logic behind technical analysis. The underlying logic of technical analysis is that the price of a security is only dependent on the supply and demand for that particular security. So, as far as the technical analyst is concerned, these two factors are the only factors that ultimately affect the security's price. This also means that if there is any change in the supply of the security or any change in the demand for the security, it would lead to a corresponding change in the price for the security. Ultimately, since supply and demand for a security would directly reflect in the price and volume of the security, this also means that analyzing these data points can yield significant insights into the future price of the security. Hence, price of a security can be projected using charts and other technical analysis tools. A key feature of technical analysis is that technical analysis of any instrument does not require detailed knowledge of that instrument. As long as the chart represents the action in a freely traded market, an analyst does not even need to know the name or type of the security in order to conduct the analysis. Technical analysis can also be applied over any time frame, whether it be short-term price movements or long-term movements. Because fundamental analysis is more time consuming than technical analysis, investors with short time horizon, such as traders, tend to prefer technical analysis. At the same time, fundamental analysts with long time frames often perform technical analysis to time the purchase and sale of securities they have analyzed. Now that we have understood the term technical analysis, in the next video we are going to look at the common principles and assumptions behind technical analysis. Welcome back. Now let's look at certain basic principles and assumptions behind technical analysis. Technical analysis is thought of as study of collective investor psychology or collective sentiment. Prices of security in any freely traded market are set by human beings or their automated proxies like computerized trading programs. Hence, the price of a security is set at the equilibrium between supply and demand at any instant in time. Technical analysis also does not believe in rational human behavior. This is in direct contrast to what is believed by fundamental analysts. Fundamental analysts or theorists propose that markets are efficient and rational, but technical analysis believes that humans are often irrational and emotional, and they tend to behave similarly in similar circumstances. If you think about it, this is not such an unreasonable assumption. You see, fundamental data is definitely a key input into determination of value of a security, but since this data is analyzed by human beings, and since human beings can be driven at least partially by factors other than rational factors, it must be fair to assume that price of a security may be significantly influenced by human beings' irrational and emotional behavior. Also, if you look at it, human behavior is often erratic and driven by emotion in many aspects of one's life, so you can understand that it is unreasonable to believe that investing is the one exception where human beings always behave rationally. So technical analysis believes that market trends and patterns reflect this irrational human behavior when applied to investing. The next important assumption behind technical analysis is that trends and patterns repeat themselves. So technical analysis is study of market trends or patterns, and technical analysis tends to believe that the trends and patterns tend to repeat themselves and are somewhat predictable. Technical analysis relies on recognition of patterns that have occurred in the past in an attempt to project future patterns of securities price. Also, technical analysis assumes that market reflects the collective knowledge and sentiment of many varied participants and the amount of buying and selling activity in a particular security. In a freely traded market, only participants actually buying or selling the security have any impact on its price. The greater the volume of participants' trades, the more impact the market participant will have on price. Those with most conviction and best information have more say in setting prices because the informed traders are expected to trade higher volumes. Technical analysis relies on knowledgeable market participants putting their knowledge to work by trading in the market, and thereby they influence the price and volume of a security. In case a trade is not entered on an information, then that particular information is not captured in the charts of a security's price. Essentially, trade determines volume and price. The impact of a trade occurs instantaneously, and sum total of trades is reflected in price movements which frequently anticipate fundamental developments correctly. By studying market data, technical analysis seeks to understand the investor sentiment. Hence, technical analysis benefits from wide range of knowledge of market participants and collective conclusion of market participants about a security. With this, we have covered most of the principles and assumptions behind technical analysis. In the next video, we'll briefly compare technical analysis with fundamental analysis. Welcome back. When it comes to technical analysis, there are two primary tools. These tools are known as charts and technical indicators. In this video, we are going to look at charts, and in a later video, we are going to look at technical indicators. Charts are a graphical display of price and volume data, and this display may be done in a number of ways. Charts are subject to various analysis, including identification of patterns, time cycles, and trends. Charts provide information about past price behavior, and they also provide a basis for inferring likely future price behavior. A variety of charts can be used in studying the markets. The selection of charts to use technical analysis is determined by the intended purpose of the analysis. There are primarily three types of charts. These are line charts, bar charts, and candlestick charts. Let's start by looking at the line charts. Line charts are a simple graphical display of price trends over time. Here we have shown an example of a line chart. So this is a line chart, and here we have also included the trading volume associated with each price point on the line chart. Line chart is a plot of data points such as share price with a line connecting these points. Line charts are typically drawn with closing price as the data points. The vertical axis reflects the price level, and the horizontal axis represents time. By looking at a line chart, you can do a quick analysis of the price behavior of the security in question. For example, in this chart, you can see that the markets formed a peak around 8,990 levels and then entered into a correction phase. There was also a rally in the month of June, which could be looked as a correction of this downtrend. And after this correction was over, there was another down leg whereby the markets made a new low in the month of September. This low was around 7,575. Now this line chart is using the closing price data. So while you see that on a particular day, say the closing price was 7,576, what this line chart is not telling you is that how was the intraday movement on a particular day. Line chart provides a broad overview of investor sentiment and can lead to further analysis. Importantly, anyone can access and analyze this information very quickly. Collecting and analyzing full array of data, normally incorporated in fundamental analysis, would take much longer time. By looking at this chart, for example, you can quickly say that the market was willing to pay a price of 8,400 in the month of May. But if we look at it in September, the market is no longer willing to pay this price, and hence the market is trading much lower, around 7,500 to 7,700 levels. This kind of quick analysis is only possible through line charts. On the contrary, if one were to go by using fundamental analysis, forming this kind of an opinion would take much longer. Next, let's look at another chart type, which is the bar chart. In case of the line chart, you saw that there was just one data point for every time interval. Essentially, you plotted the closing price of the security on each day to arrive at the line chart. But in case of the bar chart, there are 4 price points that are captured for each day. These price points are the high price of the day, the low price of the day, the opening price, and the closing price. The bar chart notation is shown here. In order to create a bar chart, you connect the high price and the low price of the day with a vertical line. Then you place a cross hatch to the left to indicate the opening price of the day. You also place a cross hatch to the right to indicate the closing price. You plot such bars on each day in order to create a bar chart. The single biggest appeal of this chart is that you can immediately get a sense of the nature of the day's trading. So for example, a short bar indicates little price movement during the day, that is the high price, low price, and the close price were near the opening price. Similarly, a long bar would indicate a wide divergence between the high and the low of the day. This is how a plot of bar chart would look across timeline. By looking at this, you can say that there are certain days where volatility is typically very high. For example, on this day, the markets opened on day high and then ended up closing on day lows. If you look at it in conjunction with the volume that was traded on this day, then you can come to some concrete conclusions regarding the future price trends of the security. In the next lecture, we'll look at the most popular chart type, which is known as the candlestick charts. Welcome back. Now let's look at another type of chart, which is the candlesticks chart. Candlesticks trace their root to Japan, where technical analysis has been in use for centuries. In fact, candlestick patterns are so rich and varied that a whole course can be dedicated to explaining the various patterns within candlestick analysis. But for now, we will only introduce you to candlestick charts, as we will be using candlestick charts in most of our examples. Candlestick charts provide 4 data points for every day. These 4 data points are the opening price of the day, the closing price of the day, the high of the day, and the low price. A candlestick is formed by first drawing a vertical line showing the range throughout which the security price traded throughout the day. This line is known as the wick or shadow of the candlestick. The body of the candle is shaded if the opening price was higher than the closing price, and this would indicate a bearish day. The body is clear if the opening price was lower than the closing price, and this would indicate a bullish day. Creating candlestick body like this essentially gives the body a color combination of black and white. Similarly, other color combinations are often used to represent a bearish and a bullish day. It is common to use red or black color to represent a bearish day. Also, one can use a blue or green color to represent a bullish day. The advantage of candlestick chart over the bar chart is that the price moves are much more visible in the candlestick chart, which allows faster analysis. In case of candlestick chart, the difference between opening and closing prices and their relationship to the highs and the lows of the day are clearly apparent. For example, by looking at this chart, you can say that on the third day here, there is significant volatility because the high of the day and the low of the day are considerably apart when you compare it to other candlesticks on this chart. Also on the fourth last day, the closing price and the opening price are almost the same, and this creates a special kind of pattern which is known as the cross pattern. This pattern in itself has some specific implications. Essentially, this candle is telling you that after a full day of trading, the positive price influence of buyers and the negative price influence of sellers exactly counteract each other, which tells you that this market is in balance. With this, we have broadly covered the various chart types. The most common of these chart types is the candlesticks, and we have a separate series of videos dedicated to candlestick charts later in the course. For now, we are going to move on to the next video, where we'll look at some other considerations that you should be aware of when it comes to charting. Welcome back. In this video, we are going to look at some considerations related to charts in general. For any chart, be it line chart, bar chart or candlestick, the vertical axis can be constructed either with a linear scale, which is also known as the arithmetic scale, or it can be constructed with a logarithmic scale, depending on how you want to view the data. In order to understand the difference between the linear scale and logarithmic scale, I have produced two charts here. One is a linear scale chart and other is the logarithmic scale chart. When you look at the linear scale chart, you see that the distance between 5 to 10 on vertical scale is same as the distance between 10 to 15. Also, you see that the distance between the price of 10 and 20 is the same as the distance between 20 and 30. But now, if you look at the log scale, you see that the distance between 10 and 20 is the same as the distance between 20 and 40. What this means is that when the price of a security moves from 10 to 20, during this period, the prices have given a return of 100%. Similarly, when prices move from 20 to 40, again the security has given a return of 100%. So in case of log scale, equal vertical distances on the chart correspond to an equal percentage change. So for example, when you move from 10 to 100, there is a tenfold increase in the price of a security. Similarly, when you move from 100 to 1000, there is again a tenfold increase in the price of the security. Now you might wonder, why would someone want to plot prices using log scale? This is so because log scale is appropriate for analysis when prices move through a range of values representing several orders of magnitude. So for example, if you are analyzing a stock that has moved from 10 to 10,000, you should be using the log scale to plot the prices. An arithmetic or linear scale, on the other hand, is better suited for narrower ranges, example for price movements from 35 to 50. The next important consideration when dealing with charts is volume. Volume is actually an important characteristic that is included at the bottom of many charts. It is used to assess the strength or conviction of buyers and sellers in determining a security's price. If volume increases during a time frame in which price is also increasing, that combination is considered positive and the two indicators confirm each other. This signal is interpreted to mean that over time more investors are buying the financial instrument and they are doing so at higher and higher prices. Also, if volume and prices diverge, for example if stock's price rises while its volume declines, it means that fewer and fewer market participants are willing to buy that stock at the new price. If this trend in volume continues, the price rally will soon end because the demand for the security at higher prices will cease. In many of the tools we discuss, we'll be using this characteristic of volume to further confirm our analysis. For now, we will move on to the next important consideration. The next important consideration is the time interval used to plot the chart. Most of the charts we use in this tutorial are daily charts. Now daily charts plot price action on each day, with each day being plotted on the horizontal axis. However, one can also use hourly, half hourly, 5-minute or even 1-minute chart for short term trading. Similarly, for longer term investing, one can use weekly, monthly, or even yearly charts. The key advantage of technical analysis is that the same analytical approach applies irrespective of the time interval used. However, using long time intervals allow the analyst to chart longer time periods than does using short time intervals, since long intervals contain fewer data points. Also, it is common to use many different time frames to analyze any security. Now, keeping these considerations in mind, we will start looking at specific tools to analyze securities. So in the next video, we'll look at an important analytical pattern, which is known as the gap. Welcome back. In this lecture, we'll compare technical analysis with fundamental analysis. Technical analysis focuses on price and volume data of the security. On the other hand, fundamental analysis encompasses financial and economic analysis, as well as different types of trends like political trends and societal trends. Technical analysis factors in the results of extensive fundamental analysis in terms of how it affects the price and volume of a given security. Technical analysis assumes all factors considered by a fundamental analyst are reflected in the price of a financial instrument through buying and selling activity. The type of data used by each of these methods is another key distinction between them. Technical analysis uses price and volume data, while fundamental analysis uses numerous data estimates and assumptions that have been added together to arrive at the line items in the financial statements. Since technical analysis uses only price and volume data, and there are no assumptions or vagueness about the data and its interpretation, hence technical analysis uses more objective data to make decisions about future price movements. On the other hand, fundamental analysts rely on a result of numerous estimates and assumptions which are added together to arrive at the line items in the financial statements. For example, even the cash line on the balance sheet is subject to management's opinion about which securities are liquid enough to be considered cash. This opinion must be agreed to by the auditors and the relevant regulators. Also, financial statements are subject to restatements because of changes in accounting assumptions and in extreme cases due to fraud. When you compare this to the price and volume data used by technical analysis, you see that technical analysis uses more objective data to make decisions. Hello there. We looked at candlestick patterns in a previous module. Let's start this module by once again revising the basic concepts quickly. Candlesticks essentially use 4 data points, which includes the opening price of the day, the high of the day, the low of the day, and the closing price of the day. Candlestick consists of a main body of the candle, which essentially is the area between the opening price and the closing price. The wick is the line which connects the high price or the low price of the day to the body of the candlestick. The main body uses a color combination like white and black, where a white body means that the closing price was greater than the opening price, meaning that there was overall buying during the day. On the other hand, a black body means that the closing price is less than the opening price, meaning there was selling during the day. Now, depending on the length of the wick and the body, there are different shapes of the candlesticks with specific implications. Also, a combination of 2 or more candlesticks have some specific implications. In this lecture, we'll first look at basic candlestick patterns. Later, we'll look at patterns involving 2 or more candlesticks. The first basic candlestick pattern is spinning top. Here, the length of the body is small compared to the length of the upper and the lower wick. The color of the body is not important. It might be black or white. But this kind of a candlestick represents indecision because the longer wick represents that the trading happened in a wide range, while the lesser length of the body says that in spite of trading in the wide range, the prices finally failed to move much away from the opening price of the day. Since the body is essentially formed by the opening and the closing price of the day, a small body represents indecision. If the opening price of the body is the same as the closing price, a doji candlestick pattern is formed. In case of the doji, since the opening price and the closing price are the same, the body of the candlestick is just a straight line. Doji again is of three types. First is the long-legged doji, where both the upper and lower wicks are long. This pattern represents considerable indecision. Second, you have the gravestone doji, which has a long upper shadow and no lower shadow. Now, the longer the upper shadow, the more bearish the implication, since the prices failed to close away from the opening price in spite of trading much higher for the entire period. Now, opposite of gravestone doji is the dragonfly doji. This pattern has a long lower shadow and no upper shadow. This pattern is considered bullish since the prices were able to recover back to the opening price even after trading substantially below the trading price for the entire period. Now this covers the basic candlestick patterns. In the next lectures, we'll look at patterns that combine two or more candlesticks. We'll start by first looking at some reversal patterns, and in a later lecture, we'll look at continuation patterns. Welcome back. Now let's look at some candlestick patterns that can be used to determine reversal points in the market. Now these patterns are a combination of two or more candlesticks appearing after an uptrend or a downtrend. Let's first define what is a reversal candlestick pattern. A reversal pattern is essentially a combination of candlesticks that indicates a reversal in trend. One should pay attention to the trend before the pattern to determine whether the pattern is bullish or bearish. Essentially, a bullish reversal pattern would only be valid if it appears after a downtrend, and a bearish reversal pattern would only be valid if it appears after an uptrend. So for example, you cannot have a bullish reversal pattern appearing after an uptrend. Now let's look at the different reversal patterns. The first reversal pattern we'll be looking at is the engulfing pattern. An engulfing pattern can be a bullish engulfing pattern or a bearish engulfing pattern, depending on the implication of the pattern. This pattern consists of two candlesticks of different colors. A bullish engulfing pattern occurs after a market fall and indicates a change in trend. The first candle in a bullish engulfing pattern is a black candle, which reinforces the recent downtrend. The next candle is a white candle, where the white body completely engulfs the previous period's black body. Now this indicates that the bulls have taken over from the bears. Now opposite of a bullish engulfing pattern is a bearish engulfing pattern, which occurs after a market rally. The first candle of this two candle pattern is a white body signifying the recent upward trend. The next candle is a black body, which completely engulfs the previous period's white body and thus indicates that the bears have taken over from bulls, and you can expect a substantial reversal in the uptrend. Now the next reversal pattern we'll look at is the dark cloud cover. This is also a two-day reversal pattern with bearish implication. Since this pattern has a bearish implication, it should appear after an uptrend for it to be valid. The first day of this pattern is a long white candlestick. It reflects the current trend of the market, which is up. And the next day, the prices open above the high price of the previous day, which essentially adds to the bullishness of the previous day but then the prices trade lower for the rest of the day, with closing price at least below the midpoint of the body of the first day. This signifies significant blow to the bulls, as many might be forced to exit the market. Since the second candle has a black body, this is referred to as the dark cloud in the name dark cloud cover. The occurrence of this pattern after an uptrend signifies a substantial pullback in prices. It may also indicate a complete change of trend. However, if this pattern appears in a downward trending market, then it has no forecasting value. Now the next pattern is the piercing line pattern, which is opposite of the dark cloud cover pattern. Now for this pattern to be of significance, it should occur after a substantial downtrend. The first candle in this pattern is a long black candlestick, which essentially confirms the downward trend to the trader. The next day, prices open at a new low, but then recover to trend higher all day, and ultimately the prices close above the midpoint of the first candlestick's body. This signifies significant change in the downtrend and may force many traders to reverse or exit their position. Since this pattern is formed only after a downtrend, it is essentially a bullish reversal signal, and the prices are expected to move up after occurrence of this pattern. Also, it should be obvious that if this pattern occurs in an uptrend, then it has no forecasting value. The final reversal patterns we'll look at are the evening and morning stars. Now the evening and morning stars are both 3-day reversal patterns that are just opposite to each other. A evening star is a bearish reversal pattern. The first day of this pattern is a bullish white candlestick, signifying the uptrend in full force. On the second day, the prices open gap up and trade in a narrow range. On this day, the opening and closing prices are near to each other, but throughout the day, the prices continue to stay above the body of the previous day. On the third day, there is a change in trend, and the prices open lower with a gap below the body of the second day, and further the prices close lower, going below the midpoint of the body of the first day. This essentially signals a reversal in the uptrend. Now you should wait for all 3 candlesticks to be completed before you initiate any action. Now the opposite of evening star is the morning star. Hence, morning star is a bullish reversal pattern, and its occurrence is of significance only if it comes after a significant downtrend. Now the first day in this pattern is a bearish black candlestick, which signifies the downtrend in full force. On the second day, the prices open lower with a gap and trade in a narrow range. The opening and closing price on the second day are near each other, but the prices continue to stay below the body of the first day. On the third day, the prices open with a gap up above the body of the second day, and they happen to close higher with the closing prices above the midpoint of the body of the first day. The completion of this pattern essentially signals a reversal in the downtrend. Now these are some important reversal patterns which will indicate to you a change in trend. In the next lecture, we'll look at some continuation candlestick patterns. Welcome back. Now in this lecture, we'll look at some continuation patterns. Now continuation pattern helps us determine if the trend before the appearance of this pattern is likely to continue. So while in case of reversal patterns, we saw that there was a change in trend, in case of a continuation pattern, this pattern only signifies a period of rest for the market, and once this pattern is complete, the trend right before the appearance of this pattern resumes. Now the first of the continuation patterns we'll look at is the rising and falling 3 patterns. A rising 3 pattern is a bullish pattern, while a falling 3 pattern is a bearish counterpart of the rising 3 pattern. Let's look at them one by one. The rising 3 pattern appears when the uptrend preceding the pattern takes a pause. So a rising 3 pattern is valid only in an uptrend. The first day of this pattern is a long white day which supports the upward trending market. However, over the next 3 days, we see small body for the candlesticks which as a group trend downward. The body of all the three candlesticks remains within the range of the first day's long white body, and at least two of these three bodies are black bodies. These 3 days are considered to be a period of rest before the previous bullish trend resumes. On the fifth day, a long white body develops, which closes at a new high. Now, the opposite of the rising 3 pattern is the falling 3 pattern, which is its bearish counterpart. The falling 3 pattern appears when a downtrend preceding the pattern takes a pause. The first day of this pattern is a long black body, which only signifies the downtrend in the market. Over the next 3 days, we see small bodies for candlesticks, which as a group trend upward. The body of all three candlesticks remain within the range of the first day's long black body, and at least two of these three bodies are white bodies. On the fifth day, a long black body is expected to develop, which should close at a new low. Now, what we have described here are perfect details of the rising and falling 3 pattern. It is not uncommon to relax some details of this pattern. For example, it is common to ignore the color of the 3 small bodies, which signify the periods of rest. Also, the period of rest could last for more than 3 days. The next pattern we'll look at is the 3 white soldiers. Now, this pattern consists of 3 candles, which form a group of 3 white candlesticks with consecutive higher closes. So, all these 3 candlesticks have consecutive higher closes. If this pattern appears after a period of stable prices, then it indicates strength in prices ahead. The 3 white soldiers are a gradual and steady rise, with each white candle opening within or near the prior session's white real body. Each of the 3 bodies should close at or near their highs. This is considered as a healthy method for prices to rise. A caution should be exercised if the white candlesticks are very extended, as this may signal an overbought market, and in such cases it is best to ignore this pattern and not expect higher prices going ahead. There are also other patterns that may involve 3 consecutive white candlesticks, but these patterns should not be considered as 3 white soldiers, and hence these patterns are not considered to have any bullish implications. For example, if the second and third candle or just the third candle shows signs of weakening, then it is called an advancing block pattern. This does not have any bullish implication. In fact, this indicates that the uptrend is close to exhaustion or the prices may actually fall, and hence if one comes across this pattern, it implies that those who are long should protect themselves. One should be especially cautious if one comes across this pattern during a mature uptrend. Signs of weakening could be progressively smaller white real bodies or relative longer wick on the last 2 white candlesticks. Another pattern that involves 3 consecutive white candlesticks but should not be considered as 3 white soldiers is known as the stalled pattern. This pattern essentially indicates that the uptrend may be stalled. This pattern involves 2 white candlesticks which are long, followed by a small candlestick. After the formation of this pattern, the bull market's strength is at least temporarily exhausted. The small real body of the last candle indicates a deterioration in the market's strength, and so one is advised to take profits on long positions. Now, in case of the advancing block pattern and the stall pattern, it is advisable to book profits, but it is not advisable to initiate fresh short positions, even though sometimes these patterns may be followed by substantial price decline. This is so because they do not necessarily signal a major reversal in the trend. Welcome back. In this section, we are going to look at gaps. A gap represents a price range at which no shares change hands or no trading happened. Gaps on daily charts are produced when the lowest price at which a certain stock is traded on one day is higher than the highest price at which it was traded on the other day. The price action on these 2 days do not overlap, which results in a price gap between them. Gaps have historically attracted a lot of attention. Traders and analysts have always attached great importance to them. This has also led to certain rules becoming very popular, but some of them are no more than myths. One such rule is that a gap must be closed. Sometimes it is stated more cautiously as if a gap isn't closed in 3 days, it will be closed in 3 weeks, and if isn't closed in 3 weeks, it will be closed in 3 months. There are numerous variations to this rule, but they all add up to the belief that a gap, if created, then it must necessarily be closed in the future. Let's understand what we mean by this term, closing the gap. Here is the chart of a security. We see that on this day here a gap was created, and hence there was a price range around which no trading happened. After a couple of days, we see that the prices reverse and finally the prices go up, so that trading happens in this price range now. When this price action occurs, it is said that the gap has been closed. So the question is, must a gap be closed before prices move very far away from it? Certainly not. Will it be closed eventually? Probably yes. But this may take a few years to happen, and if it does happen, then knowing this would not be of any interest to most traders. For example, in the US markets, there were hundreds of gaps made in the charts between 1929 and 1930. These gaps have never been closed since, and many of them, it is safe to say now, will never be closed. If you think about it, what I am saying for gaps is true for a stock's price returning to any price range. So it is very important for you to remember that it is not necessary that all gaps made on any chart will be covered. Now we will look at different types of gaps which have some special implications. But before we do that, let's first look at gaps that have no special meaning. So in the next video, we'll look at gaps that have no special significance, and then we will look at gaps of significance. So see you in the next lecture. Welcome back. In this video, we'll look at gaps that have no significant forecasting implication. The first gap with no significant forecasting implication are those found by low volume issues. These are stocks that are thinly traded because of lack of frequent investor participation for some reason or the other. Such issues are not traded continuously, which leads to price gaps being created very often. These gaps are very easy to spot because once you chart the price of the security, you will see that numerous gaps are being created regularly. Since in these securities, numerous gaps are a regular thing, there is no special implication attached with any one of these gaps. For example, if you look at the chart here, you see that numerous gaps are a common phenomenon within this chart, and hence you should not attach any special forecasting significance to any one of these gaps. The next type of gap without any forecasting implication is the one shown here. These gaps appear on the charts when a stock goes ex-dividend. This is because when a stock goes ex-dividend, the dividend is paid to the investor and the value of the stock is reduced by the amount of dividend paid per share. This leads to a gap being created because of the fact that this value has been paid to the investor. These gaps that appear on the charts when a stock goes ex-dividend do not possess any implication because these gaps are a result of an actual change in the book value of the stock. These gaps are not representative of underlying supply and demand relation. Hence, this type of gap has no forecasting implication. Now that we have covered gaps which do not have any specific forecasting implication, we will next look at gaps that have certain valuable forecasting implication. So see you in the next lecture. Welcome back. There are basically four types of gaps which have some forecasting implications. These gaps don't occur frequently, but when they do occur, they may be helpful in forecasting future moves. These four types of gaps are shown here. They are the common or area gaps, breakout gaps, continuation or runaway gaps, and exhaustion gaps. In this video, we are going to cover the first two types of gaps. In the next video, we are going to look at the other two types. So let's start with the common or area gaps. This type of gap occurs in a price congestion pattern, especially in patterns like triangles. Also, the activity in these patterns is concentrated in a range. When gaps occur in a congestion pattern, they have a tendency to get closed within few days. This closing of gap happens before the congestion pattern completes and the prices break away from the pattern. For example, in the chart here, there are numerous gaps. All of these are occurring as part of the congestion pattern. The pattern here is a triangle. If you look at all of these gaps, they got closed before the triangle pattern completes and prices broke away from the triangle pattern. Such gaps have very little forecasting significance in themselves, but if you see a number of gaps appearing and subsequently getting closed, it should tell you that some kind of congestion pattern is in the process. Hence, their presence tells you that probably a congestion pattern is playing out. These gaps are more likely to form in consolidation patterns rather than reversal formations. So, formation of many gaps and their subsequent close should tell you that prices are forming a consolidation pattern rather than reversal pattern. They should also tell you that prices are likely to move out in the direction of the preceding trend once the consolidation pattern is complete. The next pattern we will look at is breakaway gaps. The breakaway type of gap also appears in connection with a price congestion formation, but it develops at the completion of the formation. This gap occurs in the move which breaks prices away from the congestion pattern. These gaps may also appear at the end of a major trend. So for example, if prices have been in a major trend, the prices may accelerate after the trend has ended by the way of formation of a breakaway gap. A breakaway gap may also appear at a horizontal pattern boundary. So for example, in the chart here, the prices were not falling below this horizontal level here. There was a congestion formation here and prices had been trading in a range for some time. But once this congestion was complete and a new trend emerged, we saw the formation of a breakaway gap. This type of gap often occurs at decisive breakout from a horizontal congestion. They are sometimes not spotted on a daily chart because they may occur during the day. These gaps also develop when prices penetrate trend lines. Now the question is, what forecasting value is derived from breakaway gaps? Firstly, they alert you that a breakout in prices has occurred. In fact, such breakouts should be rarely doubted if there is a sharp move, because these kind of gaps are rarely formed in a false move. Secondly, if a movement is initiated by a breakout gap, then it should be expected to be a sharper move compared to a move initiated by a gapless breakout. Hence, the implication is that one should expect the prices to move farther or faster, or maybe likely both farther and faster. However, the gap in itself does not tell us how far we can expect the move to carry after the creation of the gap. This means we need to employ other tools to figure out how far the move may carry after the formation of a breakaway gap. With this, we have come to the end of discussion on area gaps and breakaway gaps. In the next video, we are going to look at the runaway gaps and the exhaustion gaps. So see you in the next lecture. Welcome back. In this video, we are going to look at the continuation or runaway gap and also exhaustion gaps. Let's start with the continuation gaps first. Continuation or runaway gaps are very important as they give a rough indication of the possible extent of the move that is likely to follow. For these reasons, these gaps are also known as the measuring gap. The runaway gaps are not associated with congestion zones, but they actually occur in rapid advances or declines. So as you see in this case here, there has been a rapid decline in the market. Runaway gaps usually occur in these kind of markets. For example, in a fast moving market, the trading volumes are at peak at the initial breakout, and then the volume tapers off a little in the middle of the trend. This volume again peaks up to a high turnover as the move is finally halted. In such fast moves, we see that often a wide gap develops right in the middle of the move. So you see in this case you had a breakout gap and you had a further movement down on the next day after the breakout gap, and then you see another gap forming the very next day, and there is a considerable amount of trading on the next day, and prices also move far away from this gap. Now this is a runaway gap. This runaway gap is formed right in the middle of this downward movement, and so this gap will be able to tell you the extent of further move after the gap has been formed. These kind of gaps occur just about the halfway point between the breakout which inaugurated the move and the reversal day, or the time the prices enter a congestion pattern. The idea is that prices will go as much beyond the gaps as they have already traveled before the gap. Because of this, one can get a measurement of the move right after the formation of the gap. Now if you see this move, once this gap is formed and you want to forecast the further downside in the prices for the security, then what you should do is that you should measure the price movement before the gap was formed. So you see that prices roughly formed an intermediate high of 8533 and moved to 8230 just before the gap was formed. After the gap was formed, the trading started from a price of 8060. So now you can say that since the gap is formed right in the middle, so this gap is kind of a midpoint, and you should expect the prices to move as much below from 8060 as they moved before the gap was formed. So since the price move before the gap was formed happened from 8533 to 8230, this is approximately 300 points. It would be reasonable for you to assume that the price movement after the gap was formed would also be of 300 points, and so a target for you based on these 300 points would be approximately 7700. Now usually what happens is once this kind of a gap is formed, many investors are caught off guard and often they don't know what they should do with their current position. For example, if they were short in this scenario, they may look for a point where they can book profits, or if they are long, they are probably looking for a point where they can average their existing positions or add new positions. Now once you see this kind of a gap, you should tell yourself that since a 300 point move happened before the gap was formed, now I should expect that the prices would move down by at least 300 points before I can expect some kind of correction. So you should definitely wait for prices to move by this much before you make any new investment. If 2 or 3 gaps intervene in a rapid move, then they all can be classified as a continuation gap. But as more gaps occur, the chances of one of them being an exhaustion gap increases, and an exhaustion gap actually indicates a reversal. So now we'll look at the other type of gap, which is the exhaustion gap. Exhaustion gaps, as the name suggests, comes at the end of the move. Hence, they indicate exhaustion of a major move. These gaps are associated with rapid extensive advances or declines. In contrast to runaway gaps, the movement before appearance of exhaustion gap does not indicate any increase in resistance as they proceed. Basically, there is no tendency to lose momentum. On the contrary, the move continues to speed up until suddenly it hits a wall of supply and the move is brought to an abrupt end by a day of terrific trading volume. In such strong moves, a wide gap sometimes occurs at the very end, that is, between the last day of the move and the day just before the last day. Now, what is not shown in this chart is that there was a terrific move from around 50 levels to this price of around 100. Also, the volume had tapered off in between, but on this day, when this exhaustion gap was formed, you see that there was a sudden spike in the volume of trading. Now, what had happened is that this upward price movement had suddenly hit a wall of supply, which is indicated by this spike in volume on this day. This gap formation with substantially higher volume on the last day indicates exhaustion of the move. The prices, though, may end up closing not very far away from the opening price of the day, and this formation combined with high volumes would indicate a likely exhaustion gap. This gap tells you that either the trend may reverse or the prices may enter a substantial consolidation phase before moving up again. Another thing to remember is that an exhaustion gap is usually preceded by at least one runaway gap or continuation gap, and hence the first gap in a fast moving market is very unlikely to be an exhaustion gap. Hence the first gap in a rapid advance or decline can be assumed to be a continuation gap for sure, but every other gap after the first gap should be treated with more and more suspicion of being an exhaustion gap. As a rule, continuation or runaway gap is not covered for a considerable length of time, but in case of exhaustion gaps, they are expected to be quickly closed, sometimes within 2 to 5 days. A word of caution here: an exhaustion gap taken by itself should not be read as a sign of reversal, but the halt is ordinarily followed by some sort of congestion development, which may in turn lead to either reversal or continuation of the move prior to the gap. However, in practically every case, enough of a minor reaction or delay ensues from the formation of an exhaustion gap before a new trend emerges. With this, we have covered the different types of gaps. In the next video, we are going to look at the topic of support and resistance. Welcome back. In this video, we are going to look at the concept of support and resistance. This is a very important concept, as mastering this concept will not only help you enter new trades, but also many times when you might be surprised by a market movement, this concept can really help you plan your exit strategy. And hence, mastering this concept may ultimately save you a lot of money. So let's start by understanding this concept. Support is defined as an area of buying that is powerful enough to halt a downtrend in prices for a substantial amount of time. So support is essentially a price level or a price range where one may expect the downtrend to either take a temporary pause or maybe potentially complete reversal. This support zone should potentially have sufficient demand expected to emerge in the area to bring about temporary or permanent price reversal. In contrast, resistance is the exact opposite of support. So resistance is defined as a price level or price range where one may expect the uptrend to either take a temporary pause or potentially complete reversal. The resistance level should potentially have sufficient supply emerging in the area to bring about temporary or permanent price reversal. So a support level is a price level at which sufficient demand for a stock appears to hold a downtrend temporarily at least and possibly reverse it. That is, when the prices reach the support level, they may tend to move up again. Similarly, resistance level is a price level at which sufficient supply of a stock is forthcoming to stop and possibly turn back its uptrend. Now, of course, you may understand that there is some supply and demand at every price level. So in order for a level to have any importance, there needs to be a concentration of demand or supply. So for example, for a price to have a support level, there should be concentration of demand because that is what would keep the prices from going lower. Similarly, for a price to be a resistance level, there should be a concentration of supply because that is what would keep the prices from going higher. Hence, whether a price level or price zone acts as a support or resistance depends on whether a large number of shares were traded around that level in the past. Any level where a relatively much larger number of shares were traded becomes a potentially important support or resistance level. These support and resistance levels are not completely different price points. In fact, there is a constant role reversal that keeps happening between support and resistance levels. Let me explain what I mean by this. If you know a price level which has acted as support in the past, and if the prices were eventually able to fall below this support level and trend lower, once this downtrend ends and the prices try to climb back up to the previous support level, this old support level will now act as a resistance level. This means that important price levels switch their roles from support to resistance and from resistance to support from time to time. To understand all this, let's look at an example. Let's say a stock declines from 60 to 50 and then finds some support emerging at 50 by the way of huge trading volume and corrects up. After spending some time above 50, the prices eventually manage to break below 50 and say they end up creating a new low around 40. Now if some buying emerges and the stock tries to edge up towards 50 again, you may expect some kind of selling emerging at 50. This is because of the simple fact that a lot many buyers may still be stuck with their long positions around 50. So as the prices try to climb back up to these levels, there is a good chance that these people will like to get out of their position around 50, which is a sort of break-even price level for them. So a level which acted as a strong support in the past has changed its role and is now acting as a resistance level. So you should be aware of this characteristic of support and resistance levels. Strong support levels may become strong resistance levels once prices fall substantially below it. Similarly, strong resistance levels may become strong support levels once prices rise substantially above it. With this, we have briefly looked at the concept of support and resistance. In the next video, we will look at some other important considerations related to this concept. Welcome back. Now that we have understood support and resistance concept, let's look at how we can determine which support or resistance level has more strength. We are sharing here 3 criterion that you may use to evaluate the relative strength of a support or resistance. These criterion are volume, distance, and time elapsed. Let's look at these one by one to better understand them, starting with volume. When we say volume, we mean the volume that has been traded at a particular support or resistance level. So when comparing two support levels, if you see that there is a price level where few thousand shares changed hands, while only a few hundred shares changed hands at the other support level, it is reasonable for you to expect that the level with higher number of shares traded will be a stronger support or resistance because there is potentially a larger demand or supply that may emerge around that level. This is simply because a larger number of people might be potentially stuck with a long or short position at that price level, and given an opportunity, they will be very keen at getting out even. The smarter and more experienced ones might even be ready to sacrifice a point or two because they realize that this level is a strong resistance level with many people stuck with long positions who are also eager to get out, and so the prices may not even reach that level because of the anticipated selling pressure. So to summarize, the higher the volume at a particular level, the more strong support or resistance it may provide. The next important criteria to estimate the strength of support or resistance level is the extent of move after the break of particular support or resistance level. The idea is that if a support level is broken and prices fell below it, then when the prices come back to test this level, which now will be a resistance level, the strength of this resistance will depend on how far the prices fall below before coming back to test this level. The further the prices fall away from this level, the stronger the resistance will be on this level. So for example, here are two different cases in which support levels get broken. As you see in the first case, the fall was further away, so you should expect this first level to provide stronger resistance as prices come back to test it. So in general, the greater the distance prices fall, if prices break below a support level, the greater the resistance from the level when the prices try to retest that level. The next criteria for estimating the strength of resistance of an old support level is the amount of time that has passed since it was formed. In general, a supply point which is only an year or two old will be more effective resistance level compared to a level that is 4 to 5 years old. But this is not to mean that the older resistance level loses all its importance. In fact, you may be surprised to know how effective a very old resistance or support level might be if it hasn't been attacked since it was created. This is because every time a support or resistance level is attacked, it loses some of its potency because some of the overhanging supply or demand would be used up in repelling the attack. So the next time this level is attacked again, it would be less capable in repelling the attack. In such cases, you may look at the subsequent trading volume at those levels and compare it to the trading volume when the support or resistance level was first created. This will help you in determining if the support or resistance level volume has exhausted itself. With this, we have covered the three main factors that you may use to evaluate the strength of the support or resistance. So see you in the next video. Now let's look at a practical example of how support and resistance can stay relevant even after 1 or 2 years. This example becomes more important because it illustrates how a particular event which creates a support and resistance may help us validate the relevance and strength of the particular level. So this is a chart of Nifty, one of India's leading stock indices. As you could see, the market had been rallying for months before the election results were due in anticipation of victory of Prime Minister candidate Narendra Modi of the BJP. Because of his persona and track record as a business-friendly administrator, the markets had run up to the results day in anticipation of his victory. This specifically is the day the election results came out, and so you see lows and highs created on this day happen to have formed a very important support and resistance levels. So specifically 7125 had been the low on the election day, and this level had worked even after few days, and the markets just didn't go below this level which was created on the day the results came out. As it happened, the markets rallied, they broke through the levels which was the high on the day the results were declared, and subsequently the markets continued to rally for quite a few months. Now fast forward 1.5 years after these levels were created, and we see that the market topped sometime in the early part of 2015 and entered a corrective phase. After correcting for few months, there was a brief rally which failed to sustain, and subsequently there was some very sharp movement in the market, whereby there was also a day where the markets gapped down open back close to 3% and continued their downward journey throughout the day. As is shown by this candlestick, the markets were down almost 7% on a single day. And as I told you, usually when such gap like patterns are formed in the market, most people become very confused as to what should be their next step and how should they handle their portfolio. This period of considerable volatility led to further fall in the market, and ultimately the market happened to take a support at exactly the levels created on the day the election results were brought in. So these levels of 7561 turned out to be an important support which happened to halt the fall of the market from over 9000 levels. This shows how levels created around important events may turn out to be key levels during times of market panic. As you see, the markets happen to take support around the levels created on the election day and then rallied almost 10% from market lows. And hence it becomes important that not only you mark important support and resistance levels on your chart, but it is also very important that you keep mental track of levels associated with substantial market moving events. As during times of confusion, you'll see that very often these kind of levels turn out to be the saving grace for the market. Welcome back. Now starting with this video, we will cover the very important concept of trend lines and trend channels. It is a common understanding among academics that the market goes up and down randomly, but the truth is that markets show a definite pattern in their movement. In fact, prices may move in trends for extended period of time. This trend may either be up, or the trend may be down, or the trend may be sideways. An uptrend is one where the prices move up overall, like shown here. A downtrend is one where the prices move down overall, like the one shown here. A sideways trend is one where prices tend to be in a broad horizontal range for a period of time. Any trend may last either for a brief period of time, or the trend may last for a longer duration as well. Whatever be the case, sooner or later, trends change. So for example, a trend may change from an uptrend to a downtrend, or from a downtrend to an uptrend. They may also change direction without reversing. So for example, an uptrend may be followed by a sideways trend, and after this sideways trend is complete, an uptrend may resume. Traders or investors essentially make money by capitalizing on uptrends or downtrends. This is done either by following a trend until it is reversed, or by anticipating a reversal of trend. As someone looking to profit from financial markets, your real challenge is to try and recognize a trend at the earliest possible stage of development so that you can enter a trade to profit from it. Your next task is to figure out whether the trend has ended so that you may book profits and exit the trade. Trend lines are a basic tool that helps us in identifying and following a trend. So without further ado, let's go ahead and understand trend lines. A trend line is a line that helps in identifying a trend because all the price action and retracements in the trend are supported by this trend line. So you will find that often all the smaller counter-trend fluctuations in a trend are supported by a trend line. You may also see that when prices are plotted for many years, many times longer-term uptrends are also supported by a single trend line. Trend lines often help in identifying if a trend is likely to continue or not. That is, trend lines may also help in identifying if the current trend has reversed. Specifically, when prices come and touch a pre-existing trend line and reverse, it indicates that the trend is going to continue. In contrast, if prices come to touch a pre-existing trend line but don't find any support and instead fall through it, then it's an early sign that the trend may be about to reverse, or at least a substantial counter-trend move might be in action. Apart from this, trend lines can be combined with other price patterns and concepts like support and resistance in order to make trades. In an uptrend, trend lines are formed by joining the lows of minor fluctuations that are against the trend. So the bottoms formed by minor counter-trend moves in an uptrend are connected to form an uptrend line. The tops formed in an uptrend may or may not lie on a straight line. This implies that if you were to connect the various intermediate tops in an uptrend, they may not lie on a straight line and may instead have some kind of a crooked formation. In some special cases though, this may not be true, and these intermediate tops may also fall on a straight line. We will be discussing this aspect of uptrends when we cover trend channels. Now let's look at how we can create a trend line in a downtrend, that is when the prices are falling. A trend line may be created by joining the intermediate tops of the minor upward corrections in a scenario of falling prices. These intermediate tops often lie on a line which would be a downward sloping trend line. In this case though, the various bottoms formed in the fall may or may not fall on a straight line. Now let's formally look at how we can draw trend lines. As you would already know, a line can be drawn by joining any 2 points. So in order to draw a trend line, we need to determine 2 points. In case of an uptrend, these 2 points are supposed to be 2 minor counter-trend reversal bottom points, while in case of downward trending lines, these 2 points are supposed to be 2 minor top reversal points to establish a downward sloping trend line. So we have essentially connected 2 important established bottoms in order to create an uptrend line. Similarly, we have connected 2 established tops in order to create a downtrend line. As you can see in this chart, once we have established a trend line, further price movements seem to have been supported by this trend line again and again. Also, a trend reversal seems to occur only once this established trend line is broken so that the prices trade below the trend line. Similar is the case in a downtrend line. Once we have established a trend line using 2 established tops, we see how prices cannot sustain above this trend line as long as the prices are in a downtrend. Once the downtrend is over, the prices start trading above this downward sloping trend line. Once a trend line is established, it serves us 2 purposes. Let's understand this by looking at the uptrend line here. The first purpose of a trend line is that once a trend line is broken, that is when prices go through it, it decisively signals that the advance has run out and it calls on you to get out of your position and look to reinvest the proceeds elsewhere. Another purpose served by the trend line is that it tells you how long you should stay on in a trade. So for example, in this case, if you see that some kind of reversal formation takes place far away from the trend line, you should not exit the position just because of the formation of this reversal pattern. This is true unless you see that in subsequent move, the prices fall below the trend line. So if the prices continue to stay above the trend line, then it is best for you to ignore this reversal formation. And this will enable you to stay on to the trend for incremental profits. Experienced traders find this important because they realize that they should hold on to their positions for as long as possible to maximize the returns on profitable trades. Experienced traders realize that it is expensive to keep switching out from one position to another on appearance of every reversal pattern, as with experience they have learned that the trends just don't reverse on appearance of a reversal pattern. So by getting out of a position on appearance of a reversal pattern, you may stand to lose by exiting trades prematurely. So it becomes important not only to identify trends using a trend line, but also to hold on to winning positions unless these trend lines are broken decisively. In order to determine whether the trend line has been broken, we will be looking at some other concepts in the next video. So see you in the next video. Now let's look at some tests that can help us in determining how good is a trend line. These tests are referred to as tests of authority. Let's look at them one by one. The first important consideration in testing a trend line is the number of bottoms or tops. The greater the number of bottoms or tops that have been developed, either at the trend line or very near the trend line, the greater the importance of that line in the technical sense. With each successive test, the significance of the line increases. A first and a tentative uptrend line can be drawn as soon as two bottoms have been formed. So for example, a first and tentative uptrend line can be drawn when two bottoms have been identified. So once we have identified these two bottoms, we can draw a trend line through them by joining those 2 points. Now if prices move away from the trend line and then come back to retest this trend line and do not break this trend line, then the validity of the trend line will be confirmed because the trend line has acted as a support for the trend. Now if it so happens that this trend line is tested again a fourth time and again the prices take support at this trend line and rally, then the significance of this trend line is considerably enhanced. Another way to test the authority of the trend line is by looking at the length of the trend line. The longer the trend line holds without being penetrated, the greater its technical significance. So when comparing two trend lines, if a trend line has existed for longer period, then that trend line is the more significant one. However, when comparing trend lines, greater weight should be given to the number of bottoms or tops that have formed on a trend line than to its length alone. The next important criteria for testing a trend line's authority is the angle of the trend line. The angle of the trend line should be measured against the horizontal axis. The angle of the trend line is a good criterion of its validity as a true delimiter of the intermediate trend. If the angle of the trend line is very steep, then such a trend line can be easily broken by a brief sideways consolidation move. Such steep lines are of little forecasting value to the technical analyst. The less steep the trend line, the more important it is considered to be technically. And so greater significance is attached to any downside breakout for a trend line that is flat compared to a trend line which is steep. However, the degree of steepness or flatness is a subjective criteria and one requires significant experience and practice to determine which trend lines are steep enough to be not of much forecasting value and which ones are flat enough to be of technical importance. For example, if we compare these two trend lines here, this trend line is more steep because its angle to the horizontal is greater than the angle to the horizontal for this trend line. So this is the more steeper trend line and this is the trend line which is less steep. And so when you see a downside break through this trend line, it would be of much greater significance than a downside break from a trend line which is much steeper than this trend line. As you can see from this chart, once the prices broke the flatter trend line, the downside movement was much sharper when compared to the downside movement when this steeper trend line was broken. So you should remember that the flatter the trend line, that is the more nearly horizontal the trend line, the more important it is technically, and a downside break through it is of greater significance. Next, let's look at what criteria we should use to test the validity of penetration of a trend line. We'll be discussing essentially three criteria for appraising the authority or accuracy of an intermediate uptrend. The first of this is the extent of penetration. For a penetration to be decisive, it is important that prices must not only push through the line, but close beyond it by a margin equal to about 3% of the stock's price. This movement of 3% need not be accomplished in a single day, although what is seen is that whenever there is a valid penetration of a trend line, it so happens that the prices move by 3% beyond the trend line in a single day. But sometimes the 3% penetration may come as a result of 2 or 3 days of gradual decline. The second important criteria for validity of penetration is the volume of trading. If the prices have moved by a margin of 3% beyond the line, it is not necessary for volume to have expanded much at that point in order to confirm the validity of the penetration. However, what is seen is that the breaking of an intermediate uptrend is usually attended by some visible intensification of trading activity. To this extent, an increase in volume may be regarded as confirmation of a decisive penetration. Volume also happens to be a useful adjunct in case of borderline cases. For example, if prices start to decline from a point somewhere above the trend line and move down through the trend line on conspicuously expanding turnover and say close beyond the trend line by only 2% of the price, but at or near the bottom of the day's range, then in such a scenario the 3% margin rule which we had set here would not be satisfied. But if this move is accompanied by a substantial increase in volume, then we may regard such a penetration as decisive. Also, when you start using trend lines, you will realize that many times there are certain shakeout moves that happen in which the prices crack down through the trend line with a great flurry of activity, and after some minutes, the prices turn back up again and close the day either back above the trend line or at least very close to it. This usually is a false move so far as that particular movement is concerned. In such a scenario, it becomes important to watch the next few days' performance very closely, and the analyst should be aware that the technical situation is very critical because a shakeout like this could not have been easily staged. Another test for validity of penetration is the break of a support or resistance level. This test also applies particularly to breaks which are borderline in as far as the margin of penetration is concerned. Now, suppose a stock has managed to penetrate a trend line but does not meet our criteria of 3% move below the trend line, and also suppose that there has not been any increase in the trading volume. Now, suppose if it fluctuates there for a day or two in a dull and narrow market and then starts to rally, and suppose there is no pickup in activity on this recovery move, and the prices simply come and touch back the underside of the trend line and then tend to round over without being able to close over the trend line, then in such a situation, the slightest sign of renewed selling pressure must be taken as a signal that the uptrend has been decisively broken. Now, these three tests with respect to establishing the validity of a trendline penetration cannot be applied inflexibly and without a modicum of judgment. These rules should be considered to be general guidelines rather than hard and fast rules. As you keep applying these rules with experience, you will learn to interpret which penetrations are for real and which penetrations are just false moves. Welcome back. In this video, we are going to discuss when you will need to redraw a trend line. In this video, we are going to discuss this scenario by focusing on just the uptrend line to understand the basic concepts. Now, in scenarios where prices go through a trend line but do not break it by a decisive margin, and instead they come back above it, then you may be doubtful as to the authority of this original trend line. In such a scenario, you need to decide if this trend line should be discarded, or should it be revised, or should you just leave it as it is. Now, if the original trend line has only 2 points, that is, if the original trend line has not been subsequently tested by a minor counter trend move, then in such a scenario, you should redraw the line by using the first bottom and the new third bottom once the prices have moved up from the third bottom point. However, in scenarios where the original trend line has been tested before, if you see that prices briefly close below the trend line but then return to trade above the trend line, then you may disregard this penetration and continue to track the original trend line. Another little detail that you should remember is that any intraday break through a trend line that has been tested before should always be disregarded and the line should be left as it is. There is another scenario where you may require to redraw a trend line. So for example, say you have a trend line passing through two minor bottoms in an uptrend. Now suppose you see a third minor bottom is formed, but this bottom is formed well above the trend line. Then in such a scenario, you should keep the original trend line, but you should also draw a new line by joining the second and third minor bottom, and then you should track both these lines. If you see that the new trend line is broken soon, then you should discard the new trend line and you should stick to the original trend line. However, if you see that the new trend line happens to stay valid for a substantial period of time, say for a few weeks, then you may discard the old trend line in favor of the new trend line, and you should use this new line to track the uptrend. Let's look at an example to understand this. Here is the chart of a cement stock from the Indian markets. When you see the trend unfolding here, you see that there are two bottoms that have formed. You may connect these to form a trend line. Then you have this kind of a price up move followed by a correction resulting in another bottom formation. Now you can connect this new bottom to the second bottom to form another trend line. Now you can continue to track both these lines to see how the price action evolves. As it happens in this case, the second trend line gets tested a little later, resulting in validation of this trend line. So now you can safely discard the first trend line and rely on this new trend line. With this, we have covered all the details with respect to trend lines. In the next video, we will look at another related concept, which is the concept of trend channels. Welcome back. In this video, we are going to look at the concept of trend channels. When we started the discussion on trend lines, we said that in an uptrend, trend lines are formed by joining the lows of minor fluctuations that are against the trend. So the bottoms formed by minor counter-trend moves in an uptrend are connected to form an uptrend line. We also said that the tops formed in an uptrend may or may not lie on a straight line. However, often it may happen that the tops may lie on a straight line as well, and this straight line may be parallel to the original trend line. We call the original trend line that connects the bottoms in an uptrend as the basic trend line, and the parallel line that is formed by connecting the tops in an uptrend is called the return line. The entire area between the basic trend line and the return line is called a trend channel. Trend channels are commonly found in actively traded liquid stocks. They don't appear very often in less liquid stocks because these stocks often do not get a lot of attention from investors. Now you may naturally ask, what is the value of identifying a trend channel? As a beginner, you might think trend channels are a good way to identify a profit-taking level. You may also look at the return line. You may look at the return line and think that it may be a good area to book your profits. However, experienced traders use trend channels in a more negative sense. The idea is that if a rally is not able to reach the return line, then it is a sign of deteriorating strength of the uptrend. So if you see that a rally failed to reach the return line after rallying from the baseline, you may assume it is highly likely that the prices will be able to break below the baseline if the prices were to test it again. Let's look at an example to understand this. Here is a chart of India's leading stock index, the Nifty. Here we see that this up move is bound by two trend lines, that is the baseline and the return line. Hence these lines form a trend channel. Now here you see that the prices were not able to touch the return line after bouncing from the baseline in an up move. On seeing this, you should be alert that the next time the prices touch the baseline, it is very likely that the prices will break below it as the rally might be losing momentum. This loss in momentum is the reason prices are unable to reach the return line. Once the prices come back to test the return line, we see here that they break below it, leading to a substantial fall. With this, we have covered the topic on trend channels. In the next video, we will look at another important tool for analysis, which is the technical indicators. So see you in the next video. Welcome back. In this module, we are going to look at technical indicators. Technical indicators are essentially tools that help us in our analysis by signaling how potential changes in supply and demand might affect a security's price. Let's start by defining what is a technical indicator. A technical indicator is a measure based on price, market sentiment, or fund flows that can be used to predict changes in price. In context of this course, when we say technical indicators, we are referring to price-based technical indicators. These indicators are essentially derived from the price of the security. These indicators often signal potential change in the security's price. Price-based technical indicators use current and past history of market prices. Price-based indicators may be simple indicators like moving averages or more complex indicators like oscillators. Here is a list of technical indicators that we will look at as part of this course. These include the moving averages, the Bollinger Bands, the momentum oscillators like rate of change, the relative strength indicator or RSI, stochastic oscillators, and in the end we will look at moving average convergence divergence or MACD. So starting next video, we'll first look at the technical indicator, which is the moving average. So see you in the next video. Welcome back. In this video, we will look at moving average. A moving average is the average of the closing price of a security over a specified number of periods. Moving averages smoothen out short-term price fluctuations and give a clear picture of the market trend. There are mainly three types of moving averages which are used by different traders. These include the simple moving average, the weighted moving average, and exponential moving average. The most basic of moving averages is the simple moving average. A simple moving average is the average of closing price of a security over a specified number of periods. In case of simple moving average, this average weighs each price equally over the period. This is in contrast to other types of moving averages which give relatively more weight to prices from the recent period. Let's start by looking at the formula of simple moving average. This here is the formula of simple moving average. Essentially, if you want to calculate a 5-day simple moving average, you take closing price of last 5 days and you add them up, and then you divide this sum by 5. So n here represents the number of periods for which the average is calculated, and you add the closing price of security for each of these periods and divide it by the number of periods to arrive at the simple moving average. Now let's break down this formula into subparts. Here is a different way of rearranging the same formula. So for a 5-day moving average, you are dividing each day's closing price by 5. This means for each of 5 days, a weight of 1 by 5 is assigned. So this is what we meant by saying that each price is given equal weight when calculating the simple moving average. Hence, the latest price of the security will receive the same weight as the price from older periods. This characteristic is in contrast to other types of moving averages which give more weight to data from recent periods. We'll cover this in a bit. The main question you may ask with respect to simple moving average is what should be the value of n that should be used to calculate the moving average. In other words, you may ask what period moving average you should be tracking for analysis. Now the number of data points to be included for creating a moving average depends on the intended use of the moving average. A 20-day moving average is often used because a month contains roughly 20 trading days. Similarly, a 60-day moving average is used because it represents a quarter year of trading activity. In general, longer-term analysis requires use of more number of days compared to shorter-term analysis. Now there are multiple ways to use moving averages. The first way to use moving average is to use it as a confirmation signal in conjunction with a price trend. Another way to use moving averages is by combining them with other moving averages and look for crossovers which may signal a change in trend. Apart from this, moving average lines are often used to determine support and resistance levels. But before we go into details with respect to moving averages, let's first understand the different types of moving averages, and later we'll look at how we can use moving averages. So for now, we move on to the next type of moving average, which is the weighted moving average. So in the next video, we will look at the weighted moving average. Welcome back. Now in case of simple moving average, we saw that the recent prices receive the same weight as past prices. This implies that the latest price changes, which actually reflect the latest information, is not reflected fast enough in the moving average. By assigning the same weight to the latest price and past price, effectively one is giving the same weight to past information and the latest information. But as you can understand, the latest information should be assigned more weight because it may provide a more accurate picture of supply and demand. In order to overcome this shortcoming of simple moving average, other types of moving averages give more weight to the more recent information and progressively lower weight to older information. This ensures that in case of weighted moving averages and exponential moving averages, the averages reverse direction more fast as compared to the simple moving average. Let's look at how weighted moving average achieves this. We will see how we can calculate the 5-day weighted moving average, as it would be easier to understand concepts if we are using numbers. In case of a 5-day moving average, we have 5 price data points. The fifth data point is the latest price, and the first data point is the oldest price among these 5 data points. We have also shown the price values associated with these data points. The first step in determining the weighted moving average is to determine the sum n. For example, in this case, the sum of n is the sum of numbers from 1 to 5. This is what is represented by sum n. In this case, this sum is 15. So you add 1, 2, 3, 4 and 5 to get the sum, which is 15. The next step is to calculate the weighted moving average by using the formula here. What you need to do now is to multiply the most recent price by n, which is the number of periods. So for a 5-day weighted moving average, this n is 5, and hence we will multiply the latest price, which is 9 here, by 5 and divide this multiple by the sum of n, which is 15 here. So effectively the latest price of 5 has a weight of 5 divided by 15, which is essentially n by sum of n. Then you take the closing price of the second last period, which is 12 here, and multiply it to n minus 1, which is 4, and again you divide this by sum of n, which is 15. So here you see that the second last data point has a weight of n minus 1 divided by sum of n, which is 4 divided by 15 in this case. Now you calculate all these fractions and sum them up to arrive at the weighted moving average. As you see in the last column, here the latest price receives the highest weight, and the weight proportionately reduces as you go to the older data. Thereby the oldest price receives the lowest weight. So this is how a weighted moving average is calculated. In the next video, we are going to look at exponential moving average. Welcome back. Next we will look at the exponential moving average. In order to calculate the exponential moving average, you first need to calculate the simple moving average. So for example, if you want to construct a 20-day exponential moving average, you should first construct a 20-day simple moving average. The simple moving average becomes the starting point. The next step is to calculate a multiplier m, which is given by the formula shown here. So the multiply m equals 2 divided by number of time periods plus 1. So in this case, if you are calculating the 20-day moving average, then our multiplier m is given by 2 divided by 20 plus 1, which is approximately 0.1. The next step is to calculate the exponential moving average by using the formula shown here. In order to calculate the exponential moving average price for the current period, you take the closing price of the current period and subtract the exponential moving average of the previous day. You multiply this with the multiplier m. You add this calculation to the exponential moving average of the previous day to arrive at the exponential moving average of the present day. Let's try to understand the calculation by using numbers. Suppose these are the previous 20 data points. The 20-day simple moving average on day 20 is 9. So on day 20, we will start calculating our exponential moving average, since our formula shown here requires a previous day exponential moving average, which we don't have currently, as this is the first period for which we are calculating the exponential moving average. So we will use the simple moving average value as our exponential moving average value for day 20. On day 21, we start applying our formula to calculate the exponential moving average for the period. So we subtract the exponential moving average of day 20, which is 9, from the closing price on day 21, which is 11. We then multiply this difference by the multiplier 0.1. We add the value of this expression to the previous day exponential moving average, which is 9, in order to arrive at the figure of 9.2, which is the day 21 exponential moving average. Now let's calculate the exponential moving average for day 22 to understand this better. So here we again subtract the exponential average of day 21, which is 9.2, from the closing price of day 22, which is 12. We multiply this difference to 0.1. We then add the value of this expression to the previous period moving average, that is day 21 moving average of 9.2, to arrive at the day 22 moving average value, which is 9.48. Now this calculation can be a bit overwhelming, but the good news is you don't need to perform this calculation, as technical analysis softwares do it for you. But what you need to remember is that exponential moving average give more weight to more recent period prices, and increasingly less weight is assigned to older prices. While it is not easily apparent by the formula here, but you need to remember that exponential moving average gives more weight to recent price compared to the weighted moving average, which in turn gives more weight to recent price compared to a simple moving average. By using exponential moving average, the recent price changes get reflected in the moving average faster. As we already mentioned, since simple moving average gives same weight to all the previous prices, they are slow to respond to changing prices. So the exponential moving average is fastest to respond to changing prices, while the simple moving average is the slowest to respond to changing prices. Now that we have seen the different types of moving average, in the next video, we are going to look at how to use moving averages. Welcome back. In this video, we are going to look at how to use moving averages. Now this tool can be used in multiple ways. The first way to use moving average is to compare the price of a security to the moving average. You basically want to see if the price of the security is above or below the moving average. Now this is important because if a security has been trending down in price, then it will trade below its moving average. Similarly, if a security has been trending up, then its price will trade above the moving average. So when the trend is up, the security is likely to trade above its moving average. Similarly, when the security is trending down, it is likely to trade below the moving average. In general, this implies that the penetration of the moving average is a signal that a change in trend may have taken place. Also, in general, the longer the time frame of the moving average, the greater the significance of the crossover. The second way moving averages are helpful is that the moving average themselves can act as important support and resistance zone. Now this is reasonable to expect if you understand the significance of prices crossing the moving average. Since prices crossing a moving average is significant, the moving average is likely to provide some support or resistance when prices near it. So for example, if you look at this price chart, you see that how when the prices went far away from the moving average and then reverted back to it, then the moving average levels act as resistance to this move. Similarly, you see here that the prices moved up above the moving average, and then when they came back to the moving average, this moving average acted as a support zone for the prices. The third way to use moving averages is to use multiple moving averages to generate buy and sell signals. So for example, one may use a 20-day average and a 60-day moving average to determine that a buying trend may be emerging. Since 60-day moving average uses more data points, it is the smoother and less volatile moving average compared to the 20-day moving average. This is simply because 60-day moving average uses more data points, and so any one extreme data point is less likely to skew its value. You can mathematically understand this by seeing that in case of simple moving average, the weight of each data point for a 60-day moving average is 1 divided by 60, while the weight for each data point in case of a 20-day moving average is 1 by 20. In general, you can assume that the more the number of periods, the less volatile and more smooth the moving average line is. Investors often use moving average crossovers as a buy or sell signal. When a short-term moving average crosses a long-term moving average from below it, then this movement is considered bullish. So for example, here the 20-day moving average crossed the 60-day moving average from below it, and this signal is considered bullish. This movement is referred to as the golden cross. The inverse of this is also true. So for example, if the 20-day moving average crosses the 60-day moving average from above it, then it is considered a bearish movement, and this movement is referred to as the death cross. With this, we have come to the end of our discussion on moving averages. From the next video onwards, we are going to look at some other technical indicators. Welcome back. In this video, we are going to look at Bollinger Bands. Bollinger Bands are named after John Bollinger, who combined his knowledge of statistics to create an indicator called the Bollinger Bands. Bollinger Bands consist of 3 lines. First of this is the moving average line. So for example, here you see the 3 lines. This middle one is the moving average line. The other 2 lines are plotted certain deviations away from the moving average line. So here the upper band here is constructed by adding 2 standard deviations to the mean value, while the lower band is constructed by subtracting 2 standard deviations from the mean value. Now you might naturally ask, why is standard deviation used to create these 2 bands? Standard deviation is a measure of volatility in the prices of a stock. Hence, it reflects the variation in stock's price around the mean. If the stock's price were assumed to be normally distributed, then a range of 2 standard deviations from the mean reflects the range where the stock's price would lie 95% of the time. Since standard deviation is a direct measure of volatility, the more volatile the security's price, the wider is the range between the 2 outer lines or the outer bands. So for example, here the 2 bands are far away from the moving average line because there is high volatility, but as the volatility decreases, these 2 bands come closer to moving average line. Bollinger Bands can be used to create trading strategies that can be easily computerized and tested. A common strategy using the Bollinger Bands is to sell a security when prices reach the upper band and buy the security when it reaches the lower band. So the strategy will give a buy signal along these lines, which is where the prices reach the lower band, and the strategy will give a sell signal when the prices reach the upper band. As we explained, since a range of two standard deviations from the mean reflects the range where the stock's price would lie 95% of the time, the idea is that prices have high probability to revert to the mean. This kind of a strategy assumes that the security's price will stay within bands. This kind of a strategy is likely to lead to a larger number of trades, but it also limits risk because the trader can quickly exit unprofitable trades. But in the event of a sharp price movement and a change in trend, this strategy would not be profitable. So this strategy would only work when the markets are relatively less volatile and the prices are in a consolidation phase. Now prices of most securities spend around 30% of time in the trending phase and around 70% of the time in the consolidation or the corrective phase. So when prices are in a corrective or consolidation phase, they are likely to be less volatile and the prices are likely to trade in a comparatively narrow price range. So you can understand that in such a scenario, using this strategy can give very good returns. But as soon as there is a sharp price movement and change in trend, this strategy is likely to incur losses. Keep this in mind that many times long-term investors also buy on a significant breakout above the upper boundary band because a major breakout would imply that a change in trend is likely to persist for some time. Similarly, a long-term investor may sell on a significant breakout below the lower band. So for example, a long-term investor may buy on a significant breakout above this upper Bollinger Band because such a breakout may imply a change in trend that is likely to persist for some time. Similarly, a long-term investor may sell on breakout from the lower Bollinger Band in the anticipation that the downward trend may continue for some time. In this strategy, significance of a breakout will be defined as breaking above or below the band by a certain percentage point. So for example, if the prices move 3% above the band, one may buy the security, or if the prices move below the lower band by 3%, then one may sell the security. With this, we have come to the end of our discussion on Bollinger Bands. In the next video, we are going to look at momentum oscillators. Welcome back. In this video, we are going to look at oscillators. Oscillators are indicators that are used to discern extreme changes in market sentiment. These indicators are constructed from price data, but they are calculated so that they either oscillate between a high and a low. This high and a low is typically 100 and 0. So an oscillator designed using price may vary between 0 and 100. An oscillator can also be designed so that it oscillates around a number like 0 or 100. Because of this kind of construction, extreme highs or lows are easily visible. These extremes can be viewed as graphic representations of market sentiment when selling or buying activity is more aggressive than historically. These oscillators can be analyzed by using other tools we have learned so far, so concepts like trends, support and resistance can also be used to analyze oscillators. Another way of analyzing using oscillators involves looking for convergence or divergence between oscillators and price. We will cover this topic of convergence and divergence in context of specific oscillators we discuss. For now, all you need to remember is that this concept is often helpful in identifying a reversal in trend. Oscillators will alert you to overbought and oversold conditions. In an overbought condition, market sentiment is unsustainably bullish. In an oversold condition, market sentiment is unsustainably bearish. In both cases, one should be alert to the possibility of a sharp reversal. Oscillators essentially serve three purposes. The first purpose of oscillators is to determine strength of a trend. Extreme overbought levels may be warning signals for uptrends, and extreme oversold levels may be warning signals for downtrends. Correspondingly, oscillators may also signal a pending trend reversal. When oscillators reach historically high or low levels, this might indicate that a trend reversal may be in the offing. For oscillators that move above and below 100, whenever the oscillator crosses the 100 level, it signals a change in the direction of the trend. Also, for oscillators that move above and below 0, crossing the level 0 signals a change in the direction of the trend. Apart from this, oscillators can be used for short-term trading decisions. They are specifically useful in non-trending markets where reliability of buy-sell signals arising out of overbought or oversold levels is high. So oscillators can be reliably used in non-trending markets to buy when they indicate oversold conditions or sell when they indicate overbought conditions. However, in trending markets, these overbought or oversold levels may persist for very long without resulting in change of trend. Now that we have had some general discussion around oscillators, in the next video we are going to look at the momentum or rate of change oscillator. So see you in the next video. Welcome back. In this video, we are going to look at momentum or the rate of change oscillator. The term momentum oscillator and rate of change oscillator are synonymous. Rate of change is often abbreviated as ROC. The ROC oscillator is calculated by taking the most recent closing price and subtracting the closing price from a set number of days in the past. We multiply this difference to 100 in order to calculate the momentum oscillator. So here is the formula for momentum oscillator. Here M stands for momentum oscillator value, V is the last closing price or the latest closing price, and Vx is the closing price from X days ago. When you construct the oscillator using this formula and plot the data, you see that as the ROC oscillator crosses 0 in the same direction as the direction of the trend, this movement is considered a buy or sell signal. For example, in an uptrend, if the ROC oscillator crosses from below 0 territory to above 0 territory, it's a buy signal. Alternatively, if prices are in a downtrend and the oscillator crosses from the above 0 territory to the below 0 territory, this would be a sell signal. You should ignore crossovers that happen opposite to the trend because you should always take into account the general trend when using oscillators. This same oscillator can be constructed in a way that it oscillates above and below 100. Here is the formula to design the oscillator such that it oscillates above and below 100. This oscillator is calculated by dividing the latest closing price of the security by the closing price of the security from X days ago and multiplying this to 100. This is just another way to construct the oscillator. The basic interpretation stays the same, only the calculations would have changed. Let's look at an example to understand how we can use oscillators. Here is the chart of an emerging market stock index, and although it is not shown here, this momentum oscillator moves around 0. The oscillator is actually moving between the values of plus 10 and minus 10. In the month of February, this market made a new high and entered a period of correction. This market then made a bottom sometime in February and rallied to a new high in March. Now, if you were to look at the price made a new high, and this line here signals that the prices were able to make a new high. But now look at the oscillator. The oscillator failed to make a new high when the prices made a new high. So if we connect the oscillator values around these two highs, we get a downward sloping line. However, if we connect the price highs, we get an upward sloping line. This here is the concept of divergence. A divergence happens when only either the price or the oscillator is able to make a new high or a new low. So for example, if prices have made a new high, ideally what should happen is that oscillator should also make a new high. Similarly, if prices make a new low, then the oscillator should also make a new low. If this happens, we say that both prices and oscillators are converging. Whenever this does not happen, we say that there is a divergence between price and oscillator. This implies that this recent high or low is not sustainable. So here we see that the prices made a new high while the oscillator did not make a new high. This implies that the prices are not sustainable, and what happened is, as you see, the prices reversed substantially. Here you see another example of divergence. You see here that the prices here were able to make new lows, but the oscillator failed to make new lows. The result was again the same. The prices were unable to sustain these new lows for long, and the prices reversed considerably. Here is another example of divergence where prices made new highs, but the oscillator failed to make new highs. Here too the result was a change in trend. As a trader, you should realize that a divergence in itself is not an actionable indication, and so as a trader, you should look for further indication of a trend's end before acting. So for example, if you notice a divergence and that the trend had been following a trend line, now suppose you see a break of the trend line, then you have got your confirmation signal on break of the trend line, and only when you get such a confirmation, you may take a trade in the market. With this, we have come to the end of our discussion on momentum oscillators. Welcome back. In this video, I am going to discuss the most popularly used indicator, which is the relative strength index. This indicator is commonly known as RSI. Even if you are new to financial markets, chances are you have heard of this indicator thanks to your TV studio analysts. But surprisingly, the way these analysts use this indicator is often not accurate. So even though you may know broadly how RSI works, you should still watch this entire video because you are likely to find something new here. RSI is used to graphically compare a security's gain with its losses over the set period. The creator of the RSI, which is Wells Wilder, recommended a 14-day time period. This is generally the default period used in most softwares. RSI is a momentum oscillator which provides information on whether an asset is overbought or not. The formula for RSI is shown here. In order to compute RSI, what you need to compute is something known as RS. RS is calculated by this formula shown here. RS is calculated by dividing the sum of up changes in the period by the sum of down changes in the period. You see here that we have used the mathematical mod operator here. Since down changes in the period will be negative, this mod operator is used to ensure that RS is always positive. Also, by ensuring that this term RS is positive, we make sure that RSI oscillates between 0 and 100. In general, a value above 70 in the RSI represents an overbought situation, and a value below 30 suggests that the asset is oversold. While the range of 30 to 70 may be a good rule of thumb, but you will find that some stocks actually trade in a much narrower range. You will see that less volatile stocks may have their RSI value oscillate in a lower range, and highly volatile stocks may have their RSI values oscillate in a broader range. So you might find that normal range of RSI for some stocks is say 40 to 60. In such a case, you should treat values above 60 as overbought signal and values below 40 as oversold signal. Now let's look at an example to understand multiple concepts related to RSI. This chart here shows several aspects of the use of an RSI. For example, because the RSI oscillator was higher than 70 around here, so one might think that one should sell the stock because it is probably overbought. Doing so, however, would have been a mistake, as you would have missed a significant advance. A more careful analysis should take into account the trend. The trend indicates that the stock is in an uptrend, so RSI readings above 70 could be expected in a strong uptrend. Since RSI is a price-based oscillator, you can use trend lines to analyze it. As the chart here shows, both the share price and the oscillator were in an uptrend, but the RSI uptrend was broken on 22nd of February. This was a potential warning that the uptrend in price might have broken down. So subsequently, you see that the share price broke its uptrend support line as well. With this, we have come to the end of our discussion on relative strength index. In the next video, we are going to look at another oscillator known as the stochastic oscillator. So see you in the next video. Welcome back. In this video, we are going to look at the stochastic oscillators. The stochastic oscillator is based on the observation that in uptrends, prices tend to close at or near high end of their recent range. Correspondingly, in a downtrend, prices tend to close near the lower end. The logic is that if prices of a stock are constantly being bid up during the day, but if they lose their value by the close of the day, then the rally is unlikely to continue. This is because if sellers have enough supply to overwhelm buyers, it is logical to conclude that the rally might not continue. In contrast, if you see that a stock rallies during the day and is able to hold on to some or most of the gains by the close of the day, then it is a very bullish sign. The stochastic oscillator oscillates between 0 and 100. Stochastic oscillator also has a default 14-day period like the RSI. The oscillator is composed of two lines. These are the %K line and the %D line. These are calculated by the formulae shown here. Here C stands for the latest closing price, while L14 stands for lowest closing price in the past 14 days. H14 stands for highest closing price in the past 14 days. %K is derived by subtracting the lowest closing price in past 14 days from the closing price of the day, and then you divide it by the difference between the low and high price in the last 14 days. We multiply this to 100 in order to arrive at the percentage K line. Percentage D is just the average of last 3 percentage K values calculated every day. You can think about the percentage D line as a long-term average line, which has to be seen in conjunction with the short-term percentage K line. This is because the percentage D line is just the average of the 3 percentage K values. Hence, percentage D line is the slower moving line or the smoother line. Hence, this line is actually called the signal line, because when the percentage K line is able to cross the percentage D line, it actually has some implications, and hence percentage D line is called the signal line. Percentage K is the faster moving line. The percentage K value means that the latest closing price was in the percentage K percentile of the high-low range. The default overbought and oversold range for stochastic oscillators is based on reading the signal line relative to readings of 20 and 80. The default overbought oversold range for this indicator is 20 and 80. That is, values above 80 reflect that the stock might be in an overbought zone, and values below 20 may reflect that the stock may be in an oversold zone. But like we said in case of the RSI, you also need to look at each security separately to derive the normal range of values for the indicator. You should look at both percentage K and percentage D line relative to the normal range in which they usually trade. If the indicators move above the normal range, then the security may be overbought, and this should be regarded as a bearish signal. However, if the indicator moves below the normal range, then the security is oversold, and this should be regarded as a bullish signal. Like in the case of RSI, stochastic oscillator should be used with other technical tools like the trend lines. If other methods like say trend lines suggest the same conclusion as the indicator, then you have convergence or confirmation. But if they give conflicting signals, you have a divergence which you should regard as a warning signal. Crossovers of two lines can also give trading signals the same way as crossovers of two moving averages. When percentage K line moves from below the percentage D line to above it, this move is considered a bullish short-term trading signal. Conversely, when percentage K moves from above the percentage D line to below it, this pattern is considered a bearish signal. Let's look at an example of how to use the stochastic oscillator. The chart here shows how stochastic oscillator can be used together with other forms of analysis. Here we see that the security is in an uptrend. In an uptrend, it is common for the indicator to move above its normal range of 80 and signal an overbought situation. But this overbought signal should not be used as a sell signal, because in a strong uptrend, the underlying trend is so strong that the indicator can easily go to the overbought zone. However, in the same uptrend, if you look at when the indicator entered the oversold zones, you see that each time it gave a valid buy signal. So in a strong uptrend, you may rely on this indicator going into oversold zone to indicate that you should be looking to buy. Similarly, when the security is in a strong downtrend, you can rely on this indicator going to overbought zone to signal that you should be looking to sell. Specifically, you should ignore overbought signals from the indicator when it is in a strong uptrend, and also you should ignore the oversold signals when the indicator is in a downtrend. With this, we have come to the end of our discussion on stochastic oscillators. In the next video, we are going to look at another indicator, which is the MACD indicator. So see you in the next video. Welcome back. The next indicator we will look at is what is known as the MACD. MACD stands for Moving Average Convergence Divergence Oscillator. Let's define this indicator. MACD is essentially difference between the short-term and long-term moving average of a security's price. The MACD is constructed by calculating two lines. First is the MACD line and the second is the signal line. Let's understand this one by one. MACD line is the difference between the 12-day exponential moving average and the 26-day exponential moving average. So you take the two moving averages and you calculate the difference between them to create the MACD line. The signal line is just the 9-day average of the MACD line. This indicator oscillates around 0, but it has no upper or lower limit. So this indicator is not used the same way as RSI or other oscillators, as there is no specific set overbought or oversold range for the MACD, but instead you need to compare the current level of MACD with the historical performance for each security in order to determine when the price of the security may be out of its normal range. This is just one way of using MACD. Overall, there are three ways you can use MACD. These three ways are shown here. The first way is to look for crossovers of the MACD line and the signal line. The crossover of the MACD line may be a way to generate a buy or sell signal, since the signal line is the slow moving line while the MACD line is the faster moving line. When MACD line crosses the signal line from below it, it is said to be a bullish crossover. Similarly, when the MACD line crosses the signal line from above this line, it is said to be a bearish crossover. But bullish crossovers are valid only when the MACD and signal line are in the negative territory. Similarly, bearish crossovers are valid only when the MACD and signal line are in the positive territory. The second way to use the MACD indicator is to look for when the MACD is outside its normal range for a given security. This may be seen as an indication of an overbought or oversold condition. However, you cannot use this directly as a signal to buy or sell, as overbought or oversold condition may persist for very long. In fact, you would need to combine the signal with other patterns to form a definitive conclusion for trading. Another way to use MACD is to use trend lines on the MACD indicator to detect divergence between the indicator and the price of the security. When MACD and the price are trending in the same direction, we say that there is convergence. In contrast, when MACD and price are trending in the opposite direction, the pattern is divergence. Let's look at an example to understand this. You see here that this convergence seems to be bottoming out, as you see the congestion in price and the indicator. This provides an initial hint that a change in trend might be in the offing. This is further confirmed by this fast moving MACD line crossing the slow moving signal line and hence giving a buy signal. As you see in this chart, the price and the indicator start moving up, and this is another example of price and indicator converging. Sometime around the last 3 months of the year, you see that there is a divergence between the price of the security and the indicator. So you see here how the price here made a new high while the MACD indicator fails to make a new high. As you already know, the easiest way to detect divergence is by drawing trend lines on price and the indicator. So when you connect the two price highs, you get an upward sloping trend line. Similarly, once you connect the oscillator values, you get a downward sloping trend line. This is clear case of divergence, which suggests that the new price high may not be sustainable. And you see how there has been a substantial correction following this. With this, we have come to the end of our discussion on the MACD indicator. Welcome back. In this module, we are going to share with you one of our favorite trading patterns for all time frames. We very recently used this pattern to identify major turning points in various markets and in quite different time frames. In this module, we are also going to share these examples with you so that you see for real how powerful this pattern is even in an extremely volatile scenario. But before we do that, let us first share with you as to what we think makes a great trading pattern. We believe there are three important characteristics of a great trading pattern. First of these is that the trading pattern should have a detailed trading pattern DNA. The next important characteristic is that the trading pattern should give clear confirmation signals. And lastly, we think that for a trading pattern to be useful for trading, it should have a complete trading strategy, including trade entry points, price targets, and stop losses to make it really useful to be used in trading. Let us look at what we mean by these important characteristics one by one. Now, the first important characteristic of a great trading pattern is that it should have a detailed trading pattern DNA. As you might be aware, every human being has a unique DNA that identifies them. The DNA may be composed of building blocks common to all individuals, but the pattern in which this is arranged is unique. Hence, this DNA can be used to identify an individual and distinguish him from another individual. Similarly, for a trading pattern to be of any use, it has to have a unique DNA. Not only that, the DNA system should be detailed enough to ensure that you can clearly identify the pattern and be confident that a particular trade setup is in play. The second important characteristic of a great trading pattern is that it should have a clear confirmation signal that tells you that the pattern is complete. Once a pattern is complete, you would know the implications of that pattern, and then you should be able to trade the pattern in accordance with the pattern's trading strategy. The pattern completion might not necessarily mean that you immediately trigger a trade. It may sometimes mean that you wait for further confirmations to trigger your trade. The price behavior between pattern completion and pattern trigger can often help you in successfully avoiding trades if there is an error in the pattern identification or the pattern fails to turn into a successfully profitable trade. The third important characteristic of a great trading pattern is that ideally there should be a complete trading strategy associated with the pattern. To start with, the pattern should clearly tell you when you should enter the market and on which side, that is whether you should buy or sell. Essentially, the pattern should tell you when to pull the trigger and in which direction. Not only this, it should also have a profit booking strategy for profitable trades. That is, it should clearly demarcate a price target for your trade, which is essentially the price at which you should book profits if the trade goes in your favor and the profits materialize. Apart from this, the pattern should also have a reliable exit strategy if things go against you in the market. So for example, if either you have wrongly identified a pattern or if the pattern fails for some reason, whereby essentially the prices move in your favor for some time but reverse course midway without hitting your profit target, then the exit strategy should be able to clearly tell you at what price point you should get out because the pattern is not working for you. If a pattern has a reliable entry strategy, exit strategy, and a take profit strategy, you will clearly know the reward to risk ratio before you are entering the trade, which can in fact help you in deciding if you should be taking a trade at all or not. For example, if a trade can potentially give you 80 points in profit, but if you lose, you would lose only 20 points, then the reward to risk ratio is 80 divided by 20, which is 4. This is essentially a good reward to risk ratio, as if you were to enter 5 trades out of which 4 trades resulted in a loss and 1 trade results in a profit, you would still break even. On the other hand, if a trade can potentially give you 40 points profit, but if you lose, you might lose 60 points, then the reward to risk ratio is pretty low and you are better off avoiding such trades. Ideally, we would recommend not executing trades where the reward to risk is less than 2. It's better if the reward to risk is slightly higher, say around 2.5 or 3. Now that we have understood the characteristics of a great trading pattern, in the next lecture we are going to look at one such pattern that also happens to be our favorite pattern, not only because it has all these characteristics, but also because it is good at identifying important reversal points in the market. Welcome back. Now the trade setup we are going to discuss is known by a couple of different names in different schools of technical analysis. For example, it is called a wedge in classical technical analysis, but within the purview of classical technical analysis theory, this pattern is not covered in as detailed a way as it will be covered by us. Essentially, most books on this topic happens to miss on one or more details that really make this pattern very powerful in real life application. The best description of this pattern we ever came across came through a different school in technical analysis, which is known as Elliott wave theory. This theory is a very powerful theory that requires quite a bit of in-depth study and practice in order to master it. But the pattern we are covering here can be applied even without any specific knowledge related to the Elliott wave theory. In fact, we'll be covering this pattern in such a way that it does not refer to the original theory at all. But we would never want to take away the fact that most details that make this pattern so powerful actually emerge from the Elliott wave theory. So let's get on with the pattern. Now this pattern is called the ending diagonal triangle or a wedge. Now this pattern may be a rising pattern referred to as the rising wedge, or this pattern may be a falling pattern referred to as a falling wedge. The words rising and falling refer to the overall price movement as the pattern develops. So in case of a rising wedge pattern, prices move up as the pattern unfolds, while in the case of a falling wedge, the prices move down as the pattern unfolds. We'll start by explaining the theory with respect to rising wedge, and this theory is applicable as it is for the falling wedge itself, except that the price movement in case of rising wedge is up, and on completion of pattern the prices are expected to move down, while in case of the falling wedge, the prices move down as the pattern develops, and on completion of this pattern, the prices are expected to move up. Let's start by describing the DNA of the rising wedge pattern. Now this is how a rising wedge pattern looks like. The first thing to notice about this pattern is that it consists of 5 legs that are marked as 1, 2, 3, 4 and 5. So you see that this is the first leg which moves up overall. Then this is the second leg which moves down overall. Then this is the third leg which again moves up overall. Then you have the fourth leg and the fifth leg. Overall, when you see all the 5 legs together, you see that the net price movement is up, Hence it is called the rising wedge. Now each of these legs, that is legs 1, 2, 3, 4 and 5, is subdivided into 3 sublegs. So leg 1 consists of 3 sublegs. These sublegs are marked as A, B and C. Similar is the case with leg 2. Again, leg 2 consists of 3 sublegs. These are again marked as A, B and C. And you will see that this is the case for all the 5 legs. That is, all the 5 legs consist of 3 sublegs each, and these sublegs are marked as A, B and C. While this is the ideal price behavior, sometimes when you are practically using this pattern, you may not be able to divide one of these legs into 3 sublegs A, B, C, which is fine. In real life, what you should see is that most of these legs are clearly subdivided into 3 sublegs. However, if one or two legs have worked out in such a way that you cannot divide them into 3 sublegs, you can still look at the other characteristics associated with the pattern and move ahead to successfully identify this pattern. The next thing to note is that how we have joined the points where the leg 1 and leg 3 end to form a trend line. Similarly, we have joined the points where leg 2 and leg 4 end to form another trend line. Let's call the trend line obtained from joining ends of leg 1 and leg 3 as T1, and let's call the trend line obtained from joining ends of leg 2 and leg 4 as T2. You will see how T1 and T2 converge towards each other. This is another defining characteristic of this pattern. The price action is moving up in this case, but at the same time the price action is converging, because of which these two lines are converging. It is very important that lines T1 and T2 converge towards each other. If you are tracking a pattern in which lines T1 and T2 are not converging, then it is definitely not a wedge or an ending diagonal pattern. Now another characteristic that defines the DNA of this pattern is the price action around end of the last or the fifth leg. Here, very often it is found that the price briefly moves up the trend line joining the points 1 and 3, that is the T1 trend line, and then quite quickly the prices reverse to come back and close below this line. This action is known as throwover action, and it happens often in this pattern, but it is not necessary that this price action at the end of the fifth leg might happen. But in cases where this throwover action actually occurs, it becomes much more easy to identify this pattern, which makes it easy to enter into your trades quickly. Now, opposite of this rising wedge or the rising ending diagonal pattern is the falling wedge or the falling ending diagonal pattern. This pattern is shown here. As you can see, this is just the inverted version of the rising wedge pattern, but the essential DNA of the pattern is the same. This is so because the only difference between the rising and the falling wedge is that one appears in an uptrend and the other appears in a downtrend. So again, here you see that the pattern is broadly divided into 5 legs. So you have the leg 1 which moves down, then you have the leg 2 which overall moves up, then the leg 3 which overall moves down, and so on for leg 4 and leg 5. If you look at the price action by combining all these 5 legs, then the net movement is down, which is why this is called as a falling wedge. Now each of these legs is further broken down into 3 legs each. So you see how leg 1 is broken into 3 sub-legs marked as A, B and C. Same is the case with leg 2 and all other sub-legs. Also, you notice how trend lines T1 and T2 converge towards each other, indicating a converging price action. If these trend lines are not converging, then it is not a wedge or an ending diagonal pattern in action. Finally, in this case also, it is often found that a throw over price action develops near end of leg 5, where the prices briefly and often violently fall below the trend line T1 and then sharply reverse to close above the trend line T1, thus indicating that the throw over action is complete. Now that we have understood the DNA of this pattern, let's look at the confirmation signals for this pattern. The single most definitive confirmation signal for this pattern is when the prices reverse after leg 5 ends and start moving in the opposite direction and ultimately close above the line T2. So when the prices cross T2, this pattern is confirmed, and now you can determine what are the various parameters of your trading strategy associated with this pattern. If you remember, we outlined 3 parameters that would determine your trading strategy. First is the trigger price. For this pattern, the trigger price is the price at the time the prices cross the line T2. This is where you initiate your trade, and this should be your conservative entry point. The second parameter in your trading strategy is your exit price or the stop loss price, which is the price where you know that the pattern is not working for you, and so you book your loss and exit your trade. This point happens to be the end of leg 5, so your stop loss should be just below the price at which the leg 5 ends. Now by subtracting your stop loss price from your entry price, you can determine the risk and the potential loss in the trade if the trade goes against you. The third and the final parameter in your trading strategy is your target price or the profit booking price, that is the price at which you book profits if the trade works in your favor. The target price for a profitable trade in this pattern is actually the start of leg 1. So this is the area you should be targeting if the trade works in your favor. Now by subtracting your entry price from your profit booking price, you can determine the reward or the potential profit in the trade if the trade goes in your favor. Now by dividing your potential profit by the potential loss, you can arrive at your reward to risk ratio and take a decision whether or not you should initiate your trade. If you initiate your trade, then you can place a stop loss order and a take profit order and sit back and wait for the markets to do their action until either your profit booking levels are reached or your exit price or your stop loss is hit. It is essentially that simple. Now we can understand if you do not believe that this can work. So let us next show you some very recent examples of actual trades that worked using this pattern. Now in the coming lectures, we are going to take you through examples in different asset classes to see how universally valid this pattern actually is. See you in the next lecture. Welcome back. Now in this lecture, we'll look at an example of using this pattern in analysis of dollar index. Now dollar index essentially represents the value of dollar against other currencies. In December of 2015, the Federal Reserve decided to lift interest rates after a prolonged period of accommodative policy stance. Now a fundamental question to answer is, what should happen to the value of dollar if the Federal Reserve increases rates? Since the interest rates are going up, it should of course yield to an increase in value of the dollar against other currencies, and hence the dollar index can be expected to go up if one were to only look at the fundamental factors. Now this is a chart of dollar index. This chart was issued by us to our subscribers in December. Now this, as you see, is an ending diagonal pattern. It is broken into 5 waves, with each of the 5 waves divided into an ABC pattern. The pattern though hasn't yet given the confirmation signal, which as you will remember would only come after the prices breaks through the lower trend line L2, which is essentially the line joining the points 2 and 4. Once the confirmation occurs, we would expect the prices to fall towards the start of wave 1. So ultimately, this pattern was signaling that the dollar index is likely to fall. So while a rate hike was widely expected, and fundamentally this would mean the value of dollar should rise, this pattern is signaling the complete opposite. So now the question is, between the fight of fundamentals and technicals, who really won? Now this is the chart immediately after the Federal Reserve's decision to hike rates. As you can see, the prices continued to trade in a converging price range between two trend lines until markets gave a confirmation signal. Once the confirmation signal was given, things escalated pretty quickly. The price move was so violent that in fact the prices fell even below the target zone for the pattern. As you start using this pattern, you will find often it is the case that fundamentals and technicals point to diametrically opposite directions. In such cases, my recommendation to you is that you stick to what the technicals are saying, but at the same time, you should strictly observe the stop loss associated with this pattern. Now that we have seen the application of this pattern to currencies, in the next lecture, I am going to see how this pattern worked very well in an emerging market index. See you in the next lecture. Welcome back. Now in January of 2016, the markets were crashing and many people said that it reminded them of the crash they saw in 2008. The panic was quite perceptible across world markets, and emerging markets were especially hit due to China's currency devaluation. In a jaded market scenario, we issued this chart to our subscribers just after market close on 20th of January. You would quickly recognize this as an ending diagonal pattern or the falling wedge. The price action at the end of the day on 20th January is typically how a throwover is expected to behave. In cases like these, when throwover action is complete and the prices move back and close above the trend line T1, you can actually ignore to wait for a confirmation signal, which, as you would remember, happens at the break of line T2. For aggressive traders, it is possible to treat this price action around the line T1 itself as a confirmation signal and act on it immediately. The stop loss should be kept just below the end of leg phi. While this may sound easy, often it takes a lot of courage to execute such a trade, and here is why. These are snapshots of some of the articles from local news in the country on the 20th January evening. The first media house is carrying a financial news on a non-financial website. It clearly says that the global stocks have been whacked by oil tumble and bear confirmation nears. So you see, a non-financial media house is not only running a financial news, but it is also acting as an advisor for the general public by signaling that a bear confirmation nears. Here is another non-financial media house covering this news. After the markets close on 20th January in the emerging markets, there was a big sell-off on the Wall Street. So another non-financial media house is covering this news, which says that there has been a big sell-off on Wall Street, and also the emerging market index, that is the Sensex, gives up the Modi momentum and falls to 2014 levels. It is clearly referring to a politician whose arrival led to a major rally in the stock markets, and it is pointing that there has been a loss in the momentum which was generated due to the election of this leader. Now, while articles related to movement in stock prices or stock indices may be normal in the financial media, but in this case, these articles started appearing on non-financial media, which in fact rarely report any financial news. However, this is not all. There were also comments like the ones shown here appearing across financial and non-financial media. These comments were mostly made from retail investors, and the sheer number of negative comments were overwhelming. All this should tell you enough about how negative was sentiment in the market. This is why it would make it hard for you to execute such trades even if the pattern is signaling otherwise. It is why trading this pattern may sometimes require a lot of courage. But as you start trading using this pattern, you'll find that such extremely bullish or bearish sentiment are not uncommon around this pattern. In fact, the likelihood of this pattern being profitable in such times goes up manyfold, as not many people think that the markets can reverse their trend. Which is why all the buying or selling that many people expect to happen is already exhausted near the completion of this pattern. This is so because everyone just throws in the towel and a sentiment extreme is reached. These sentiment extremes should be seen as confirmation signal and should in fact encourage you to take the trade. Now coming back to our example, here is what happened in the next few days. In 10 days, what seemed like a very bearish market rallied by over 6% and hit the target zone in accordance with this pattern. If you were not paying attention to this pattern and trading according to news or fundamentals, not only would you have missed the rally, but you may even have been caught short in a rising market. Now that we have covered examples in dollar index and an emerging market index, in the next lecture we are going to see what this trade setup is saying for gold prices in 2016. See you in the next lecture. Welcome back. Now that we have seen the application of the ending diagonal pattern on currencies and an emerging market index, in this lecture we are going to share what the pattern is saying for gold prices in 2016. Now gold prices made a high over $1,900 way back in 2011. In close to 4 years, the prices tumbled all the way down to around 1050 levels. Around these lows, there didn't seem much hope for gold, as the fundamental analysts would put it. Inflation was low, and in fact the world was facing deflation, and since gold is primarily considered to be a hedge against inflation, the prices were widely expected to head lower. In the second week of December 2015, we issued a report titled "Can Gold Shine in 2016?" This report had this chart on gold. Now as you see here, marked in Roman numerals 1, 2, 3, 4, 5 and bound by two converging trend lines T1 and T2, you can see a possibly ending diagonal triangle in play. It was a little tough to identify this pattern because it was being preceded by another pattern just before it, which was actually a triangle pattern. We may cover triangle pattern in a later update, but for now what you should note is that the ending diagonal pattern began right where the triangle pattern ended. Now the prices were trading between two converging trend lines as part of this pattern, and thus they created an ending diagonal pattern. Note how there is no conventional confirmation at the time of issue of this report, as the prices haven't yet broken above the line T2, but in this pattern also, a small throwover price action occurred at the end of leg 5, which is what prompted us to issue this report. It has been close to 2 months since, and this is what has unfolded after we issued the report. Now the prices have rallied by close to 13% from their lows in December of 2015. On 4th of Feb in 2016, they happen to have broken above the upper trend line T2. This breakout essentially confirms the pattern. Now that we have seen the conventional confirmation signal associated with the pattern, we can further expect the prices to go up to the start of wave 1, which in this case is close to $1330. If this pattern works out as expected, then it would mean a return of close to 30% for investors in gold. We'd like to end this module by issuing a disclaimer. Please do not treat this as a trading idea or recommendation. The targets are still quite far off, and there is always the risk that the pattern fails. Also, it will be very expensive for anyone to implement this view using futures, as you might need to roll over contracts often, And there may also be wild swings before the targets are achieved, if at all the prices do reach our targets. We have just used this example to demonstrate how this pattern can be used to identify important change in trends even on very long term charts. We won't be liable for any losses if you decide to trade based on this analysis and end up losing money. Welcome back. Now, since this is a course on the stock market, I'm going to start by defining what is a stock or a share. But instead of just giving you a definition up front, I'm going to give you an example so that you get a better feel for the topic. Now, let's say you have some money saved up and you want to start a manufacturing business. So, if you have, say, $10,000 saved up and you are using that to start your business, the first thing you probably would need is a place where you can manufacture goods. Let's assume that real estate is really cheap where you live, and say you buy a place for $3,000. Now you're really smart, so you want to keep an account of what you're doing, and so in order to do so, you just simply write it down. Since you purchased a piece of land or a building for $3,000, you write this transaction down. So you write down land or building, and right beside it, you write down $3,000. Next, you probably need some manufacturing equipment, and let's say that costs you another $3,000. You again note it down and say you write machinery, you bought machinery for $3,000. Next, you'll also need some raw materials that can be fed into the machinery so that you can produce finished goods. Also, probably you'll need employees to operate the machinery, and of course, you would need to pay them. Apart from that, you'll need to pay for some other miscellaneous expenses like the electricity bill. Keeping all this in mind, you keep the remaining $4,000 as cash, which you'll use as and when needed. Now, to make sure you have accounted for all the money, you need to keep track of the original money you started with. So on the right hand side, you create another column to write down your original sum of $10,000. In accounting, the term owner's equity is often used to denote this sum, so we are also using the same term here. So in order to keep track of our investment, we have created this simple table here, which is actually a simplified balance sheet. By looking at this sheet, anyone can clearly see that around $3,000 was invested in buildings, another $3,000 went into machinery, and $4,000 is kept as cash for meeting other expenses related to the business. All these items are denoted as assets, and since the business owner paid for all these assets, he owns everything, and this is denoted as owner's equity of $10,000 on the right hand side of this table. Since the total on the left hand side and the right hand side of the table are the same, we can be sure that we have accounted for every penny of the business owner's money. Now let's assume instead of having $10,000 in savings, you have only $8,000. So now if you want to start the same business at the same scale with the same assets, you're short of capital by $2,000. So now what do? Obviously, you can get a loan for this amount to fill for this shortfall. In order to keep track of money, we represent this item in our balance sheet as borrowings. So on the right hand side, we now write borrowings, and against this item, we write $2,000. Now this balance sheet reflects the fact that you don't have complete ownership of all the assets of the business. In fact, now your ownership is only limited to the net assets of the company. Net assets is essentially the value of assets after selling your liabilities due to borrowings. Hence, net assets is defined as total assets minus total liabilities. This is so because now the business has obligation to people who have lent the business money. Now the lenders hope to receive interest over the borrowing period and also the principal after the borrowing period has ended. So if you were to liquidate all your assets today, these people have the right for their money to be returned to them, and this right comes before your rights to these assets. Accordingly, the value of your equity is equal to the net assets of the company. So this is how the balance sheet of a simple business looks like. Now shares or stocks essentially represents anyone's percentage interest in the owner's equity. So continuing with this example, if for some reason you today decide that you no longer want to invest $8,000 in this business, and say now you only want to invest $4,000 as you need the rest of the capital for some other purposes, but at the same time you don't want to disturb the activities of your current business by either reducing the size of the business or by borrowing more money, you have the option to bring in another partner who can give you this $4,000, and in return he'll become a part owner of the business. This partnership can be represented by a piece of paper or agreement which states that you own one share which is worth $4,000 and your partner owns one share which is worth $4,000. By making this arrangement, you have managed to release your money without affecting a running business. This arrangement also clearly says that since you own one share out of total of 2 shares issued by the business, you have 50% ownership of the net assets of the company. This also means that each shareholder has right to 50% of business's net profits. This net profit is arrived after paying the borrowers the interest due to them on the loans. Hence, here too, you are entitled to a share in the profits of the company only after the lenders have got their due. So now we'll formally define what is a stock or a share. A stock or a share represents a fixed percentage ownership in a company or business. For example, if a company has issued 100 shares and if someone were to own one share, then they essentially have 1% ownership in the company. This means that the shareholder has rights to 1% of the net assets of the company, and they also have right to 1% of the net profit of the company. So now, having defined what is a stock or a share, next we are going to see what is a stock market. Now, stock market is a marketplace for stocks where willing buyers and sellers of stocks come together to trade with each other. This trading may happen either on a stock exchange where the exchange manages the risk of trading in various stocks, or this trading may happen privately between two willing parties. Stock exchange is essentially a platform where buyers and sellers transact in any security. We'll cover stock exchanges in greater detail in a later lecture, but what is important to note is that even in case of private trading, where two willing parties trade with each other, in case the stock they are trading is listed on an exchange, then the buyer and the seller, in case of private trading, are also obliged to register the trade with the exchange. However, in the case the stock of the company being traded privately is not listed on the exchange, then this is not applicable. For the purpose of this course, we are limiting ourselves to stock trading on exchanges. When it comes to the stock market and stock exchanges, the trading of stocks may happen either in the primary market or in the secondary market. We'll cover this topic in detail in one of the later lectures. Welcome back. Now that we have defined what is the stock market, one might wonder who all actually trade in the stock market. Now there are various types of investors and traders who trade in the stock market. These can be broadly divided into two categories based on the quantum of their investment and also based on the complexity of their investment strategy. Now these two categories are the retail investors and the institutional investors. Let's look at them one by one. Retail investors are essentially individuals with surplus savings in their personal account. They either trade based on their own analysis or they may trade on basis of recommendations from various financial intermediaries like stockbrokers or research analysts. Now retail investors usually do not follow a very complex investment strategy. Also, the quantum of investment made by any single retail investor is very low when compared to institutional investors. Also, retail investors may not necessarily have all the resources and time to do a thorough study of any investment idea before making an investment decision. This is probably the single biggest reason why most of the retail investors do not end up making a lot of money in the stock market. Essentially, many retail investors come in with a mindset that they can just buy and sell some stocks and make quick money. This strategy, as many people find out after losing a lot of money, just doesn't work. Stock investing requires considerable amount of hard work and commitment in order for it to be profitable in the long run. We'll provide guidance on this aspect of stock investing throughout this course. For now, let's just move to the next category of investors or traders. Now, these are the institutional investors. Now, institutional investors may be corporates, banks, government organizations, mutual funds, insurance companies, pension funds, and other such entities. Now, institutional investors are considered to have specialized knowledge and skills in investing. Now, institutional investors, as a rule, do a lot of research and due diligence before making an investment. They may also frequently deploy complex investment strategies and try to achieve superior returns using derivatives. Also, the quantum of investments made by institutional investors is large as they have access to large amounts of capital. This is so because most of these investors pool financial resources from many individuals and entities. For example, mutual funds collect money from a wide range of individuals in order to manage it in accordance with a particular investment objective. Similarly, insurance companies collect insurance premiums from a diversified group of individuals in order to provide insurance cover. The idea is that ultimately only a few individuals from this group would require compensation for loss due to death, disability, or accident. In the meanwhile, the insurance company collects premium from a much larger group of people. These premiums result in a corpus that has to be managed in order to meet future insurance claims. Now, in order to manage this corpus, institutional investors employ fund managers with considerable experience and skills. These fund managers are supported by a dedicated team of research analysts and traders who devote their entire time to this activity of investing. Hence, institutional investors often deploy complex investment strategies and achieve superior returns. Now, another common question that many people ask is that why is the stock market really important? Now, many people ask this question because of the wide coverage the stock market receives in various media sources. Now, it's a fair question and one we'll try to answer in this lecture. Stock market is important because it serves a range of important functions and purposes. Firstly, stock market is one of the most important ways for businesses to raise money. The alternate way for companies to raise money is by raising debt, which is basically taking a loan where they have to pay regular fixed or floating interest rates, and also they have to make principal repayment at the end of the loan term. This means that they have a fixed obligation to lenders whether or not their use of funds turns out to be profitable. In contrast, when a company raises money using equity, it is not required to pay any money regularly to the investor or at maturity. So you can understand how raising debt could make things difficult in terms of cash requirements, as because of interest payments, lesser cash would be available to be used for working capital purposes or for expansion purposes. Also, since the loan raised has to be returned at maturity, the company has to manage its working capital and investments accordingly to ensure that it repays its debt on time. If the company fails to repay its debt on time, the lenders may require the company to liquidate its assets in order to repay its loan. This, of course, may affect the day-to-day operations of the company adversely. In contrast to this, there is no such maturity date associated with equity. So once a company raises cash by issuing equity, it has relatively more freedom to take long-term investment decisions using that money. Now, raising money by issuing equity also allows businesses to be publicly traded on an exchange, which allows the company to raise additional capital for expansion by selling more shares. This is also beneficial for investors because since the company's stock is trading on the exchange, it becomes easy for the shareholder to sell his stock when he wants to. In absence of the stock market, it would be very difficult for the investor to find a buyer who is interested in his share of the business. This means the shareholder benefits by the presence of a liquid market which can be used to buy or sell their stake as and when they deem fit. This makes stock investment a very attractive option when compared to other options like real estate, which are very liquid, as it is very difficult to find a willing buyer or seller for real estate. Stock markets are also considered to be the primary indicator of a company's economic strength and development. Rising share prices are associated with increased business investment. Share prices also affect the wealth of a household, which directly affects their consumption pattern. This in turn means that the government and central bank of a country often follow stock markets very closely, and this is one major reason why the stock markets are very well covered by the media. Hey there, welcome back. Now, when we started this course, we said that when it comes to the stock market and stock exchanges, you can buy stocks either in the primary market or in the secondary market. We also said that we'll cover this topic in greater detail in a later lecture. So in this lecture and the next lecture, we are going to look at primary market and secondary market. In this lecture, the focus will be on primary market, and in the next lecture, we'll cover secondary market. Now, in the initial stages of any business, the capital for the business is brought in by promoters and their relatives or friends. Now, this is how most businesses start, but as the requirement of capital grows, it becomes necessary to source funds from a wider group of investors. This may be because the existing investors either do not have the capacity to invest more, or maybe because they want to reduce their dependence for money on a small group of people. Primary market is essentially the market where debt or equity securities are issued by businesses. Hence, these businesses are called the issuer. Now, the issuer receives funds from investors. These investors may be individuals or institutions. Since investors are buying securities directly from the issuer, this market is known as the primary market. Also, since the securities are issued for the first time in this market, it is also known as the new issue market. This process of issuing securities in the primary market is commonly known as going public. Through this process, the retail investors or the public gets the opportunity to buy these securities for the first time. Apart from the promoters of the business, sometimes even institutional investors like private equity funds offload their stake in a business by selling some or all of their securities in the primary market. Now, the ability of a company to raise funds through primary market depends on the performance of the company in the past and also the company's expected performance in the future. Now, when investors are buying securities in a new business, they require protection against a possible default or against their rights getting diluted in some way. Since primary market securities are issued under scrutiny of the regulator, these securities are protected against such wrongdoings. Regulators impose obligation on issuers in order to ensure that issuers honor commitments made at the time of raising funds. Apart from this, the new investors in the company also need the flexibility to exit the investment when needed. Since these securities which are issued in the primary market are listed on the exchanges, the investors now have the opportunity to exit the investment as and when they see fit. This also means that even if the shares of a company change hand and go from one investor to another, the existing business essentially remains unaffected. Also, since exchanges require companies to regularly disclose key information, the investors can regularly evaluate their investment, and the stock prices reflect the expected performance of the business in the future. Another question that commonly is asked by many new investors is that, are all issues in the primary market open to the public or the retail investors? Now, the short answer is that not all primary market issues are open to the public. It is very common for companies in early stages of growth to issue equity capital to certain institutional investors only, like venture funds and private equity investors. Only when the issuer doesn't choose any specific group of investors but instead offers securities to anyone interested in buying a security, only then the issue is called a public issue. Now we have presented here a rough classification of various types of issues in primary market. Let's briefly look at them one by one. The first of them is the public issue. A public issue is issued to members of public or anyone interested in buying security, including various institutional investors. The public issue may be an IPO, which is the initial public offering, or an FPO, which is the follow-on public offering. We'll cover these terms in a bit. The next type of issue is called private placement. Now, when securities are issued only to a select set of investors like institutional investors, this is known as private placement. Then you may have what is known as the qualified institutional placement. This is essentially a type of a private placement only, which is done by a listed company to qualified institutional buyers like mutual funds. Another type of issue is the preferential issue. Now, in case of preferential issue, the securities are issued to an identified set of investors on preferential terms. These preferential terms may be offered to promoters and employees also. Through these preferential issues, the promoters and employees may get superior rights when compared to a normal investor. Another type of issue is what is known as the rights and bonus issue. Now, rights issue is where the securities are issued to existing investors in order to enable them to buy more securities at a specified price. Now, in case of bonus issue, the existing investors get allotment of additional shares without any consideration, that is, without making any extra payment. Now, coming back to the most common of these type of issues, which is the public issue, we said that the public issue may be an IPO or an FPO. So let's look at what is an IPO or what is an FPO. Starting with the IPO. Now, IPO is the first public offer made by a company. Post the IPO, the shares of the company become widely available for investment by retail investors and institutions. Thus, there is a change in shareholding pattern of the company, as instead of just the promoters and some select institutional investors, various different types of investors also become the shareholders. Now, IPO may involve either fresh issue of shares by the company, or it may involve offer for sale by existing promoters or institutional investors. The fresh issue of shares involves company issuing new shares so that they can be sold to the public. Since new shares are sold, the issued capital of the company increases and the percentage shareholding of existing shareholders comes down. On the other hand, in case of offer for sale, the existing shareholders of a company offer a part of their holding to other investors. Now, in this case, the issued share capital of the company does not change, as the company doesn't issue new shares. Also, the proceeds of these sales go to the existing shareholder who are offering their stake for sale, and hence the proceeds do not go to the company and there is no change in the capital structure of the company. As a result of sale of shares, the percentage shareholding of existing shareholders comes down, while new shareholders see their percentage shareholding go up. Now, the next type of public issue is the FPO or the follow-on public offer. The FPO is made by an issuer that has already made an IPO in the past but now wishes to make a further issue of securities to the public. So for example, if a business has gone through a IPO process and so is now listed on a stock exchange, but now wants to raise more capital to the public, they can do so by the way of a follow-on public offer. Now usually a company takes the FPO route when it requires additional capital for growth, or if it requires to restructure its capital by retiring some debt. Now sometimes FPO may also happen through offer for sale, where existing shareholders may offer some of their shares for sale. This may happen if the promoters would like to dilute their holdings in the company after the lock-in imposed at the time of the IPO is over. Now with this we have broadly covered the important terminologies surrounding the primary market. In the next video, we are going to look at the secondary market. Welcome back. Now in the previous video, we looked at the primary market. In this video, we are going to look at the secondary market. Now we said that the primary market is where the various securities are issued for the first time. After the process for issuing securities is complete, these securities are available for regular trading in the secondary market. So essentially the universe of stocks you can trade on the exchanges actually constitutes the secondary market. Now you should understand that the transactions in secondary market do not result in additional capital to the issuer. This is so because only existing shares are traded between different investors, and the issuing company doesn't receive any funds because of the trades in the secondary market. The capital raising function for which the stock markets are used, now this function is only performed by the primary market, while the secondary market supports the capital raising function of the primary market by providing liquidity, price identification, and information signaling. Secondary markets also act as the barometer of economic activity. Actually, secondary markets serve a range of important functions. We'll look at each of these one by one. The first important function of the secondary market is that secondary market provides liquidity and thus improves marketability of existing securities. This is so because secondary markets provide investors the option to sell their equity shares. This implies that the investors can stay invested without the fear of their funds being blocked, as they can now sell their shares whenever they want to. This also means that new investors get the opportunity to buy these shares if they want to. Also, secondary markets enable price discovery of traded securities. Now, the price at which an investor buys or sells a security depends on his assessment of future prospects of the company. The logic is that when a company performs well, it is likely to attract buyers. Similarly, when the business suffers, there is a lack of buyers as many of the existing investors would like to sell their holdings. Hence, there is a continuous market evaluation of the company and its future prospects. This continuous process also benefits issuers when they have to raise further capital from markets because their existing security is trading at a fair indicator of the price at which fresh capital can be issued by them. Secondary markets also serve as an indicator of economic activity. Secondary market trading data is used to generate various benchmark indices. Every country has some leading stock indices which are continuously tracked and are viewed as the barometer of economic performance. For example, there is S&P 500 and the Nasdaq in US. There is the DAX in Germany. There is the Sensex and Nifty in India. A sustained rise in these indices indicates healthy revenue, profitability, flow of capital investment, and expansion in large companies. This also indicates a strong growth in the economy, as many times the company in these indices are the source of a chunk of GDP output for the country. Similarly, a decline in indices may indicate a weakening economy. Hence, secondary markets serve as a quick indicator of economic activity. Also, secondary markets are many times referred to as the market for corporate control. Essentially, markets promote efficient governance by facilitating changes in corporate control. For example, if a management is inefficient, the company will likely perform below potential, which would probably lead to a fall in their share prices and consequently undervaluation. This would lead it to become an acquisition target, and acquirers would likely replace inefficient management with efficient management. Hence, there can be a change in corporate control facilitated by the secondary market. Now that we have covered the basics of the primary and secondary market, now what we are going to do in the next lecture is look at how the prices for various securities are set in both primary and secondary markets. Welcome back. Now what we are going to do is answer the basic question as to who really sets the price in the stock market. That is, we are going to address both the primary and the secondary market. Let's begin with the secondary market first. Now, in case of the secondary market, the stock prices are a result of continuous buying and trading by all the various types of participants in the market. This includes the retail investors, institutional investors, short-term or long-term traders, and market makers. Since this group of participants covers people from all walks of life, including those individuals who are trading in the stock of a company they may be employed in, it would be fair to assume that some individuals who trade in the market might have access to insider information as well. This implies that every information available to anyone, that is both retail and institutional investors, is reflected in the market prices. Hence, it is said that the prices reflect the collective wisdom of all market participants, and the price of any security in the stock market is set by these participants. However, this discussion relates specifically to the secondary market. Now, pricing in the primary market, that is the IPO market, works a little differently. So now let's look at how pricing works in the IPO market. While the details on how IPOs are priced may vary from country to country, still we can broadly say that there are two ways in which an IPO may be priced. These are the fixed price issue and the Dutch auction, which is also known as the book built issue. Let's look at them one by one, starting with the fixed price issue. In a fixed price issue, the company issuing the security consults with the lead manager and decides the issue price. The lead manager justifies the price based on expected performance of the company and also on the basis of price of shares of comparable companies in the market. Once the company makes this information public, the investor knows at what price the shares would be issued to them. All the relevant information, including financial performance of past few years, is made available so that the investors may decide if they should invest in the issue or not. Another way of pricing IPOs is by the way of a Dutch auction. Dutch auction or the book built issue method determines the price market is willing to pay for the security being issued. The company and the issue manager may specify a floor price, which is the minimum bid price they are willing to accept. Alternatively, they may specify a price band, that is a minimum and maximum price within which the investor can bid. So when the issue opens, retail investors place a bid price and bid quantity. The bid price is required to be above the floor price or within the price band. Once all the bid has been received, the issuer of the security, in consultation with the lead manager, decides on the cutoff price of the security. All bidders who have bid above the cutoff price get an allotment of shares at the cutoff price. Let's look at an example of how this might work. For example, say a company wants to issue 1000 shares through a book built offer within a price band of 120 to 144. Now bids are received like what is shown here in the table. Now the company would sort the bids received with the highest bid price at the top. So you see here how the highest bid price and the bid quantity is at the top and the lowest bid price bid quantity is at the bottom. Now the company would start by allocating shares to the highest bidder first and progressively moves down until all shares that need to be sold are allocated. So in this example, first the company allots 200 shares to the bidder with bid price of 144. Since the company intends to sell 1000 shares, it still has 800 shares left. Hence, it will look at the next bid at 140 and it will allot the 300 shares. After both these allocations, still 500 shares are left. So now it will look at the next bid. Here again, it will allot 500 shares. So now the company has allotted all the 1000 shares it wants to sell. Now since 135 is the lowest bid price at which shares were allotted, this becomes the cutoff price. All investors who bid at this price and higher are eligible for allotment. The company may also decide the cutoff price at a price lower than the price at which the issue is subscribed for the benefit of the investors. There could also be a clause for retail investors to be allotted shares at a discounted price. Now that we have discussed the primary and secondary market, it's time to develop some understanding on stock exchanges, which is where most of the action takes place. Stock exchange is a platform where buyers and sellers transact in various securities. These transactions take place in an organized manner and within certain rules and regulations so that the risk of settlement of funds and securities is minimized. Stock exchanges minimize these risks by stipulating rules for all the members transacting at the stock exchange. Stock exchanges also stipulate rules for listed companies in order to protect investors against any willful wrongdoings by the company. Any person looking to buy or sell a stock can only do so through a registered member of the exchange. These members are known as the trading members, also known as the stockbrokers. Members are admitted to the exchange only if they fulfill certain minimum requirements for capital, qualification, net worth, and other criteria. The exchange members can be either trading members, clearing members, or both. We'll cover this in a later lecture. Now, exchange monitors all its members for their positions, capital, and compliance to rules and regulations. Stock exchanges may also provide facilities for issue and redemption of securities and corporate events like payment of dividends. Apart from stocks, a range of other types of securities also trade on the stock exchange. Example of these securities include derivatives on stocks, bonds, and currencies. Also some pooled investment products like close-ended mutual funds and corporate or government bonds often trade on exchanges. Now let's look at what are the advantages of trading on a stock exchange as opposed to, say, trading privately. So for example, if instead of trading on a stock exchange, investors trade amongst themselves, then such trades are known as off-market trades. In such a scenario, they do not enjoy benefits of regulatory and redressal provisions of law. If investors trade on stock exchanges, they get liquid market to transact, which ensures that they get best price for their trade. This also means that their trades can be completed efficiently. That is, they need not waste time and energy in searching for counterparties to trade with. Also, all investors trading on the exchange have to comply with KYC, which is the Know Your Customer norms, and have to trade through a broker. The broker also provides investors with market information, updates, research reports, and some analytical tools to analyze securities for buying and selling. This information might not be readily available to retail investors otherwise. Apart from this, the stock exchanges considerably reduce the settlement risk between various parties. The settlement risk is a risk that one of the parties to the trade may default on its obligation to deliver a security or its value in cash as per the agreement of a trade. So stock exchanges have risk management systems in place to ensure that the parties to a trade fulfill their obligation to the other party. In order to manage this risk, the stock exchanges operate with various intermediaries. So in our next lecture, what we'll do is look at the life cycle of a typical transaction on the exchange and also learn a bit about the various intermediaries associated with the exchange. Welcome back. Now that you have some understanding of a stock exchange, let's take few minutes to understand how a typical transaction gets completed at the exchange. Essentially, secondary market transactions have three phases. The first phase is trading. Trading involves actual buying and selling of securities. Exchanges use electronic order matching systems where they essentially match buy and sell orders from different people so that the trade may be executed. So for example, if these are the various buy orders on a security and these are the various sell orders, so the matching system tries to see if there is a match between a buy and sell order at a particular price, and if so, fill both the orders. By doing so, the exchange facilitates efficient, speedy, and anonymous execution. All investors depend on brokerages to execute their trading orders. So brokerages essentially collect orders from various investors and pass it on to exchange, so that when you start trading, brokerage is the intermediary you will be directly interacting with, and the broker will interact with the exchange on your behalf. The next phase in the life of a secondary market transaction is clearing. So once two orders match and a trade is executed, the trade has to go through something known as the clearing process. Clearing is the process of identifying which securities and in what quantity is owed to a specific buyer and what payment is owed to the seller. So for example, if for a trade, investor A is the buyer who buys 100 shares of a company X at $10 each from a seller B, the clearing house would do the math and conclude that buyer A is owed 100 shares of company X and seller B is owed $1,000. Now if the buyer or the seller has performed multiple transactions, then the clearing house will identify all securities owed to them and the net payment owed to or owed by them. Clearing houses or clearing corporations are independent entities who manage this entire process. Once the clearing process is complete, the next process is known as the settlement process. So after the clearing process is complete, it becomes clear what security in what amount is owed to an investor and what funds are owed to or by them. The next step now is to fulfill these obligations, which is done by following the settlement process. So settlement is essentially the process of fulfilling the respective obligations to buyers and sellers of security. By the way of this process, the buyer receives the security owed to him and the seller receives the payment owed to him. Once buyer of the security receives the security and the seller of the security receives the payment, we say that the transaction has been settled. Now different intermediaries play different roles depending on where they are involved in the transaction. Let's look at them one by one. Starting with the trading members. Investors can trade only through members of a stock exchange. Trading members are also called stockbrokers and their affiliates are called subbrokers. Trading members are admitted to an exchange only if they fulfill certain minimum requirements for capital, qualification, net worth, and other criteria. Exchange members can either be trading members or clearing members or both. Exchanges monitor these members for their positions, capital, and compliance. Their obligation towards clients is also clearly laid out to them. These trading members are the intermediary that a typical investor deals with directly. The next important intermediary are the clearing houses. Clearing houses facilitate the clearing process we described earlier. Now, clearing houses are set up as independent entities who act as counterparties for all trades executed on exchange. Hence, all buyers pay funds to the clearing house and all sellers deliver the securities to them. Clearing members are members of clearinghouse who facilitate these transactions by directly interacting with buyers and sellers. The clearinghouse may be wholly owned subsidiaries of stock exchanges, or they may be a completely independent financial institution. The purpose of clearinghouse is to reduce the settlement risk by using certain risk management mechanisms. Clearinghouses often implement netting mechanism and a system of requiring margin deposits to mitigate settlement risk. Another important intermediary are the depositories and depository participants. Now, depository is essentially an institution that holds and facilitates exchange of securities. Centralized depositories enable brokers to deposit securities so that book entry and record keeping services can be performed. In order for a security to trade in the secondary markets, the security should be held in electronic or dematerialized form. The issuer who issues the securities admits them to the depositories, where they are held as electronic entries against investor names. In order to facilitate this process of keeping this list updated, depositories appoint depository participants who act as intermediaries between the depository and the investor. Every investor holds a demat account with a depository participant. The settlement of securities is done through this demat account with the depository participant. The depository participant in turn notifies the depositories about change of ownership. The payments for respective trades are settled through pre-identified clearing banks. Another important intermediary we like to mention are custodians. Custodians are institutional intermediaries authorized to hold funds and securities on behalf of large institutional investors like banks, insurance companies, mutual funds, and foreign institutional investors. Custodians essentially settle secondary market trades and may also act as clearing members and clearing banks for the institution in order to manage settlement of both securities and funds. Welcome back. By now we have learned about stocks, stock exchanges, and the various intermediaries involved with the process of stock trading. While the focus of this course is on stocks, we would like to mention that stock exchanges don't just deal with stocks, but actually they deal with a wide range of securities, all of which are traded on exchanges. Let us understand the term security first. A security essentially represents terms of exchange between two parties. So for example, a stock is a security which defines your percentage ownership in the firm and which has no maturity date. By owning a stock, you are entitled to a proportionate share in profits of the firm. So these are in a nutshell the terms of exchange between a stock investor and the issuer. Now the different types of securities may be issued by different institutions like corporates, governments, banks and other financial institutions. These securities are purchased by various investors who have surplus money to invest. Securities allow investors to convert their savings into financial assets that can provide them returns. The issuer of the security proposes the terms on which they want to raise capital. The investor who invests in this security has the claim to rights represented by the security. These rights may involve ownership, participation in management, or claims on assets. Essentially, different types of securities belonging to different asset classes can trade on exchange. The exchange decides which securities can be traded after taking due permissions from relevant regulator. Typically, stocks, corporate debentures, government bonds, close-ended mutual funds, and currency futures trade on an exchange. Also, some derivative instruments like futures and options, which derive their value from one of these underlyings, also trade in the derivative segment of the exchange. It is the exchange who decides which securities would have derivative securities also available to be traded on the exchange. We'll cover some of these topics in a later lecture, but before we move on to details on stock trading, we'd like to tell you something about what is known as a stock index, as we may refer to this term repeatedly throughout the course. A stock index is a number calculated to represent a particular section of the stock market. Usually it is seen as the leading measure representing the entire stock market. Very often we see one stock index associated with an exchange which represents the leading stocks trading on that exchange. Stock indices are widely quoted in the press and tracked by the public as they reflect the prevailing sentiment about the state of the economy. Stock indices are also often used as a benchmark for determining if a fund manager has added value by selecting stocks for a fund. A fund manager's return over the year can be compared to the return of a stock index over the same period to determine if the fund manager has generated greater return due to his stock selection strategies. Stock index is only one type of index from a number of indices that can be calculated using price of various stocks. For example, one can create an index from price of stocks of all banking companies to represent a banking index, or one may create a real estate index from price of stocks of real estate companies. Let's now look at how value of an index can be calculated. There are primarily two ways of calculating the value of an index. An index can be calculated by the price weighted method or the capitalization weighted method. In case of a price weighted index, the value of the index is calculated by adding the price of each stock and dividing the sum total by the number of stocks. So you essentially add prices of all the stocks that constitute the index and divide this sum by the number of stocks in the index. This implies that the stock with higher price has a greater influence on the value of the index compared to a stock with lower price. So for example, if stock A is trading at 10 and another stock B is trading at 10,000, and let's assume these are the only two stocks in the index, so the value of the index is 10 plus 10,000 and this sum divided by 2, so the value of index will be 5005. Now if only stock A were to move by 10% while stock B remains unchanged, new value of the index would be 11 plus 10,000 and dividing this sum by 2, so the new value of the index would be 5005.5. On the other hand, if stock A remains unchanged while the price of stock B moves by 10%, the new value of the index would be 5505. Since both the stocks are given equal weightage, the same percentage move in stock B may move the index more than the same percentage move in stock A. So the key drawback with price weighted index is that a stock with higher price may end up dominating the movement in the index, and hence such an index may not be truly representative of the section of the stock market from which it has been created. In order to avoid this, indexes are often calculated using capitalization weighted index. A capitalization weighted index is also known as the market weighted index. In case of capitalization weighted index, the market cap of the stock is used to determine the weightage attached to the stock prices, and hence a stock with greater market capitalization will have greater influence on the value of the index. So for the example we looked before, if stock A has 100,000 stocks outstanding, while stock B has only 10 stocks issued, the market capitalization of stock A would be 1 million, while that of stock B would be 100,000. We'll use each stock's market cap and divide it by the total market cap of the index constituents. So in this case, the total market cap would be 1.1 million. In order to arrive at the weightage to be given to each stock's price, we'll divide the stock market cap to the total market cap. Hence, weightage for stock A would be 1 million divided by 1.1 million, which is equal to 10 by 11. On the other hand, the weightage for stock B would be 100,000 divided by 1.1 million, which is equal to 1 by 11. So here it is easy to see that the stock with the higher price cannot simply dominate the index just because of its higher price. This addresses the drawback of price-weighted index, where a stock with higher price may end up dominating the movement in the index. Hence, capitalization weighted index are considered to be more representative of the section of the stock market from which they have been created. Welcome back. Now, if you are new to the stock market, you might naturally have this question as to how you can start trading in the stock market. In order to start trading in the stock market, you will need to open a trading account with a stockbroker in your country. The stockbroker would guide you on all the formalities to be completed so that the trading account can be set up for you. Once a trading account is set up, you will need to transfer funds to your account so that you can start trading. If you would like to start trading, you should also broadly understand how your trade is executed. So we have listed here the steps in a typical trade life cycle. The first step in life cycle of a trading transaction is trade or order initiation. In this stage, the investor places an order with the broker. He decides on the price at which he will like to buy the security and the quantity, that is the number of shares or stocks he wants to buy. Depending on his preference, he places a market order or a limit order. What is a market order and what is a limit order, we'll look at later. Once the order is taken by the broker is responsible for the risk management and order routing process. The broker is essentially responsible to ensure that the client does not default on his trade. So it is essentially up to the broker to check that the client has the required fund or securities to deliver once the trade is executed. In order to manage this risk, the broker carries out checks with respect to funds or securities and sends the order to the exchange only on verifying that the client has the required funds or securities to honor his obligation. The broker accordingly blocks the required funds or securities so that the client cannot execute another trade using the same funds or securities. Once the broker passes on the order to the exchange, the order matching and trade execution process begins. So once the exchange receives the order, the exchange collates all the buy and sell orders, and then the exchange tries to allot the security to the best available price. Once a match is found, the trade is executed and the exchange sends the notification to the broker, who in turn informs the investor. Once a trade is executed, it has to go through a clearing and settlement process. A trade is cleared through a clearinghouse, but neither the investor or the broker directly interacts with the clearinghouse. Instead, there are some intermediaries which are known as clearing members who act as an intermediary between the clearinghouse and the broker. Essentially, the clearinghouse takes all the trades executed through a clearing member and informs them about net obligations in terms of securities or cash for each security. Similarly, clearing member takes all the trades executed through a broker and informs the broker about his net obligation in terms of securities or cash for each security. It is the clearing member's responsibility to ensure that the broker fulfills its obligation to the clearinghouse. Once all members have cleared their obligation, the settlement of security and cash takes place. The buyer essentially gets the securities credited in their account, while the seller receives the cash settlement that is due to them. In the coming lectures, we'll see some basic concepts related to placing your orders with a broker. These are important if you are new to the area of stock investing, as you will invariably need to place your trading orders with a broker. So see you in the next lecture. Welcome back. Now let's look at what is meant by the bid price and the offer price. Bid price is the price a buyer of a security is willing to pay in order to buy the security. Correspondingly, an offer price or ask price is the price a seller of the security is willing to accept to part away with the security. Often traders and investors place orders that specify the bid or offer price and a bid or offer quantity associated with the price. The list of all such active orders is available and updated with the exchange in real time. Often an investor can get a snapshot of top 5 bid prices and top 5 offer prices from the broker just before he places the order. A sample snapshot is shown here. By looking at this snapshot, one can clearly see the highest bid and the highest offer price. So we see here that the highest bid available is at 179.3 and the bid quantity associated with that bid is 100. On the other hand, the best offer currently available is at 179.35 and the corresponding offer quantity is 50. Now let's look at a few examples to understand how the execution of an order placed by an investor will work given this bid offer price quantity situation in the market. So now if these are the available bids and offers in the market and you wish to sell 50 shares at 179.3, you can do so by placing a market or a limit order. If the order reaches the exchange in time and the market bid offer price and quantity does not move in the interim, you will be able to sell your 50 shares at a price of 179.3. Similarly, if you wish to buy 50 shares at 179.35 and you place an order which reaches the exchange in time, you would be able to buy 50 shares at 179.35. Now instead, suppose you place a market order to buy 100 shares and the market bid offer price quantity does not move by the time your order reaches the exchange, you will be able to buy 50 shares at 179.35 since only 50 shares are available at that price and another 50 shares would be bought at 179.4 as that is the next best offer available in the market at the time. Now we have mentioned the terms market order and limit order here. So now let's look at the various order types that are commonly used in the stock market. Now the purpose of entering any order is to execute a trade in a particular stock or security. The investor enters a buy order in order to buy a security so that he can own the security. Once this order is executed, the investor is said to have a long position. Similarly, the investor can enter a sell order in order to sell a security so that he no longer owns the security. Once this order is executed, the investor is said to have sold the security. However, it is also possible that an owner may not already own a security and yet decide to sell the security so that he can profit if the prices of the security falls. In such a scenario, the investor is said to have a short position. Now there are various types of orders in terms of execution type that are available. This includes market order and limit order. A market order is the most basic type of trade order, which basically instructs the broker to buy or sell the security at the best price that is currently available in the market. When you enter a market buy order, the order will be filled at the lowest available offer price. When you enter a market sell order, the order will be filled at the highest available bid price. The upside of placing a market order is that it is guaranteed that your order will be filled and your buy or sell trade will be executed. The downside is that you won't know at what price you will end up buying or selling a security until the time the trade has been already executed. So for example, if at the time of placing your buy order you see that the stock is trading at 118.7, it may so happen that by the time your order reaches the exchange, the stock has moved to 119, so you might end up buying the stock at 119 instead of 118.7, which was the price you were probably hoping to get at the time you entered your order. So essentially, with respect to market orders, you always face the risk that the market may move adversely by the time your order reaches the exchange for execution. In order to eliminate this risk, there is the option to place limit order. Now in case of limit order, there is certainty about the price at which you would buy or sell a security. At the time of placing the order, the investor needs to specify a limit price. In case of a limit buy order, the limit price instructs the broker that the order should be executed only if it could be filled at or below the limit price specified by the investor. Similarly, in case of a limit sell order, the limit price instructs the broker that the order should be executed only if it can be filled at or above the limit price specified by the investor. With respect to limit order, while there is certainty about the price at which the order will be executed, at the same time, there is no certainty whether the trade will be executed at all. This is so because by the time the order reaches the exchange, the price of the security may have moved, and so it may not be possible to fill the order within the limit price specified within the order. For example, when you place a limit order with limit price of 100, and by the time the order reaches the exchange, the price of the security has moved to 101, the order cannot be filled as it is not possible to buy the security within the limit price of 100. There is also another type of order which is known as the stop loss order. A stop loss order is used to limit loss on a trade by specifying a stop loss price for an existing trading position. Once the security's price reaches the stop loss price, the existing trading position is closed out by the broker, thus limiting the loss to the investor. For example, if you are long 100 shares of a company A at 20 and you don't want to hold it anymore if the prices fall below 18, in such a scenario, you can place a stop loss order with your broker with a stop loss price of 18. If the prices reach your stop loss price of 18, the broker would automatically sell your 100 shares and close out the position so that you don't suffer further loss if the prices continue to slide below 18. With this, we have completed the basic terminology that you should be aware of in order to execute trades with your broker. Next, what we are going to do is address the topic on how do you go about selecting a broker. Welcome back. Now, one question that we often get from many individuals is how do I go about selecting a stockbroker? We'll try to address this question in this video. Broadly, you can divide brokers into two categories. One is a full service broker and the other is a discount broker. Now, a full service broker provides a range of services to their customer apart from executing transactions for their clients. Often, full service brokers have a dedicated research desk which provides recommendations to the clients. They may also provide portfolio management, tax planning, retirement planning services, and educational courses for their clients for free or at some extra cost. Discount brokers, on the other hand, do not provide a full range of service to the client. They mostly deal with executing the trade for the clients at much lower cost when compared to a full service broker. They generally also do not provide any investment advice. If you are new to investing, it is better to stay with a full service broker instead of going for a discount broker, as you can get to have a look at a range of investment options and gain knowledge about the markets. Once you have had some experience, it is always possible to shift from a full service broker to a discount broker. It is always important to do your research before selecting your broker. Now we'll outline the different factors that you should consider for evaluating different brokers. The first factor that you should look at is the website availability. Since you would most probably be trading electronically, it is always a good idea to check the availability of the website during peak trading hours. Do check on how fast their website responds. This is especially true for discount brokers. The next factor you should look at is alternative trading facilities. It is important to check what alternative options does the broker provide to take your orders. For example, most brokers provide an option where you can directly call them to place your trades. Also, you should check if they charge a different brokerage on these services. Thirdly, and it is one of the most important factors you should look at, is customer feedback. It is good to consider the feedback of the investment community while choosing a broker, since they speak from their experience of using different brokers on a day-to-day basis. You should search various discussion forums where you can find reviews from the investing community. The next factor you should take into account is the minimum deposit requirements. Now, most brokers ask you to deposit a minimum amount with them. This deposit is often available for you to trade. Sometimes you will also find that the deposit amount is negotiable, especially if you're talking to multiple brokers at the same time. You should let them know that you're talking to multiple brokers, because that may help you in getting your minimum deposit requirements lowered. Now, the next important factor to consider is the product selection. See, if you're a beginner, you're probably thinking about trading in stocks, but there are also alternatives available to trade. For example, after you gain some experience, you may like to trade futures and options on stocks. Usually, there is substantial difference in brokerage fee for these products between brokers, so you should compare the brokerage fee of different brokerages before choosing a broker. The last factor we'll ask you to definitely consider is the interest you will be offered on your deposit. Now, most brokerages offer a rate of interest on the money deposited with them. Since you are probably going to have some deposit with them at any point in time, you should check and compare the interest rate offered by them on your deposit. Also, many times you will find that many full service brokers give you the facility to make other investments like investing in mutual funds and also buying insurance. You'll usually see that discount brokers do not offer you these facilities. So in this case, while there is substantial price difference between their brokerages, if you are someone who is looking to only invest for the long term and won't be trading frequently, you might be better off by just staying with a full service broker. So it is probably another factor that you would like to consider before making your decision. Welcome back. Next topic that we will briefly touch upon is that of algorithmic trading. A lot of new investors often come to us and ask us, what is algorithmic trading and should they be doing it? So let's use this lecture to explore this topic a little. Now, algorithmic trading uses mathematics and computer programming to reduce effect of human emotions and biases in trading. As such, algorithmic trading is often used for two purposes. First is to automate order execution for efficiently executing large orders. Second, it is used to place automated trades in order to profit from such trades. Often the term algorithmic trading is used to refer to automating the order executions, while there is another term which is very popularly used. This term is automated trading. Now, this term is used to refer to the practice of placing trades in order to profit from those trades. Automated trading essentially involves automation of the complete trading process. When a new investor asks this question, he often has automated trading in his mind, where he wants to profit from using a programmed trading strategy in order to automatically execute his trades so that he can profit from it. Whatever the case may be, in order to do effective automated or algorithmic trading, one needs skills in essentially two domains. The first domain is that of computer programming, and the second domain is one of a background in mathematics or statistics. Now, these skills may or may not be readily present in an individual. While in case of algorithmic trading, the individuals who place large orders may have their broker assist them in better executing their trades. The same is not true for automated trading. Automated trading requires developing a trading system that applies certain rules to determine the entry point for the trade. This is also known as the trade initiation. And the system also applies certain rules to determine the exit point for the trade. So before deploying any trading system in the markets, one needs to backtest this system using historical data to determine if the trading system has been profitable in the past. This essentially means that a trader may need to create and test multiple trading systems before he comes across a profitable trading system. Even after finding and fine-tuning such a trading system, it is not uncommon to find that a system that works in a simulated setting does not quite work as well when implemented on real-time markets. What is more, even if a trading system works, one needs to continuously monitor these systems when they are operating in the market, as they may require manual abort if something goes wrong. So if you have the idea that you can design a trading system and then leave it alone so that it can trade on its own while you are busy doing something else, then it is never going to be the case. These systems need to be closely monitored. This is not just because you may lose money if these systems go wrong. It is also because if your system goes out of hand and executes a lot of orders on the exchange, you may face stiff penalty from the regulators. Now, as you can probably understand that there are multiple tasks that need to be performed in order to be successful in an automated trading environment. So it is often best to work in teams instead of working alone. Also, automated traders need to adhere to strict guidelines from various exchanges in terms of capital requirements, system requirements. Now, many of these requirements may be capital intensive in nature. Also, it is not uncommon for stiff penalties to be levied by exchanges if automated trading firms are found in violation of their rules. Hence, considering the complexities involved in automated trading, it is best for new investors to not immediately indulge in automated trading, especially in individual capacity. Welcome back. Now, in this lecture, what we are going to do is address an important question. How much money should I invest in the stock market? Now, you should understand that since each individual's personal and financial situation is different, it would be imprudent on our part to give a specific number or percentage asset that might work for everyone. In fact, we'll go one step further and urge you to not pay attention to some common formulas for asset allocation that are touted in public. For example, one common suggested formula is that 100 minus whatever is your age is the percentage allocation you should have in equities or stocks. Now, this kind of a formula is flawed not only because it fails to consider the specific situation of every individual, but also because it does not take into account the possibility of wild fluctuation in investment value, which may lead to liquidity issues for the investor. To understand this, consider the following example. Say a recent graduate from college who may have limited savings even after working for 2 to 3 years. He may also be serving an education loan. Now, in such a scenario, if he decides to invest close to 70 to 75% of his savings in equities, he runs the risk of getting into liquidity issues very early in his life. So, for example, what if the stock market crashes and his portfolio goes down by over 30%? Will he be comfortable exiting his position in such a loss? What if the market-wide crash is so severe that he ends up losing his job? He'll immediately run into trouble not just for his living expenses, but also on his education loan. Considering all this, ideally you should only invest some portion of your excess savings into the stock market. Note that when we say excess savings, this is slightly different from savings. So let's first elaborate some terminologies. Say for example, we say that savings in a given month is given by savings equal to income minus expenses. So you deduct your monthly expenses from your monthly income to arrive at your monthly savings. Here income may be income from salary, business, profession, or the income may come from multiple sources, while expenses should include both essential expenses and discretionary expenses. Essential expenses include living expenses, rent, loan repayments, health and life insurance premiums, while discretionary expenses include expenses on travel, luxury, leisure, and other non-essentials. Now, your accumulated savings is essentially the sum of your savings over your lifetime. Also, one should always hold at least 6 months of essential expenses. Now, this will be defined as emergency fund. Now, for example, if your accumulated savings is less than your emergency fund, your first priority should be to build up your emergency fund. Hence, most of your monthly savings should go to your emergency fund. Needless to say, no part of your emergency fund should be invested in equities because there is a chance that the value of your investment may come down substantially at any point in time, and your emergency fund should be insulated from any such volatility in your investment value. Now, in case your accumulated savings over your lifetime is greater than the emergency fund, then the excess of your accumulated savings over your emergency fund is your investable surplus. This investable surplus is the money that can potentially be used to make investments in the stock market. But before you decide on the percentage of investable surplus that can be invested in equities, you need to figure out your foreseeable fund requirements over the next 2 to 3 years. For example, if you know that you would require a sum of money in the next 1 or 2 years to meet some obligation, then this amount should not be invested in equities, as equity returns are inherently volatile. This fund requirement must ideally be invested in products which provide fixed returns. After you deduct all your fund requirements over the next 2 or 3 years from your investable surplus, you arrive at the sum that is available to you that can be allocated to equities. Let's call this sum as your investment portfolio. While your investment portfolio can be allocated to equity, it should not necessarily be entirely allocated to equity. If someone has just started working, it is possible that the investment portfolio is only 20 to 30% of his entire savings. In such a case, it may be possible to allocate the entire capital to equities. On the other hand, if someone is in their early 50s, it is possible that their investment portfolio is more than 60 to 70% of their entire savings. Since they are only few years away from their retirement, it won't be advisable for them to allocate their entire investment portfolio to equities. For example, if they have created a corpus for their retirement, they would not want most of it to be allocated to equities. Instead, most of their portfolio should be allocated to instruments which offer fixed returns, and only some portion, say 20 to 30% of the corpus, should be in equities. A lot of people just before the 2008 market crash made the mistake of allocating a lot of their retirement funds into equities. Some people had actually invested more than 80% of their retirement corpus in equities. Needless to say, when the market crash happened, they were devastated by seeing the fall in the value of their investment corpus. So this is the flip side to allocating your entire or most of your investment portfolio to equities. That is, if there is sudden fall in the equity markets, you have to forego on the opportunity to invest more capital in equities at lower prices. Another flip side to allocating your entire investment portfolio to equities is that if there is a sudden fall in the equity markets, you have to forego on the opportunity to invest more capital in equities at lower prices. Doing so could have actually helped you gain better returns in the long run. Such sudden falls are many times great opportunities which could help you gain better returns in the long run. Hence, your allocation towards equities should always take all these factors into account, and you should always have substantial surplus cash, which is actually a part of your investment portfolio, so that you can benefit from such opportunities that may come from sudden fall in the equity market. When investing in equities, one should always try to diversify into multiple mutual funds and individual stocks in order to protect themselves from losing too much money in one equity investment. Doing so also has the benefit that some securities may provide positive returns, which may offset negative returns from some other securities. For investors who are risk averse, this reduces the overall volatility in returns from their equity investments and helps them stay invested for longer periods during times of volatility. Welcome back. Now, in the previous lecture, we addressed the question as to how much money should you be investing in the stock market. Now, the next logical question that can come to anyone's mind is that how much money should you invest in a particular stock? Now, the answer to this question depends on a number of factors. For example, are you a beginner or do you have prior experience with investing? Do you have the skills to evaluate securities or are you willing to learn the skills? Another important factor to consider is that do you have time to invest in this activity of stock picking? And lastly, are you comfortable with evaluating new information on a particular security and doing so quickly? If you are new to the stock market, you would be better off investing most of your money in equities through mutual funds, and a substantial but only small portion of your money should be invested in individual stocks. In order to invest in individual stocks, one needs to have skills to evaluate securities. If you don't already have this skill, then one needs to learn these skills and start investing in small amounts in different securities based on one's own analysis. Learning new skills and stock picking are activities that require time. In case you have commitments that don't allow you to invest time in any or all of these activities, you would be better off passively investing through mutual funds. If you choose to invest in individual securities by doing your own analysis, you are bound to come across a scenario where a sudden news affects a stock substantially and the prices move quickly. In such a scenario, you would need to be able to evaluate the effects of news and make a decision quickly. If you are a beginner, you may not be in a position to evaluate news. It is why in the initial stages it is better to make most of your equity investments through mutual funds and a comparatively smaller portion through individual securities. Now, whether you are a beginner or experienced in stock picking, your portfolio of individual stocks should consist of multiple securities. This gives you diversification benefits and shields you from adverse movement in the price of any one of the securities. Also, by not allowing yourself to invest in only one stock, you avoid being too carried away and excessively vested in one idea. This is crucial because if one is too vested in one idea, it usually does not work, which in turn could have adverse effect on the individual's confidence. It is always prudent to remember, no matter how confident you are in your analysis of a particular security and its future prospects, you can still be wrong. Hence, it is important to limit your investment in security to a level that effectively does not solely dominate your portfolio returns. Hence, it is a good rule of thumb to limit your investment in particular security to less than 10% of your entire portfolio. This way, you would at least have 10 securities in your portfolio, which is necessary to have a reasonably diversified portfolio capable of withstanding substantial specific risk. By specific risk, we mean the risk that a stock price gets affected only by developments specific to that stock. So these are the factors that you should take into account before deciding on how much money should you invest in a particular stock. Welcome back. Now in this video, we are going to address another common question, and this question goes like this. I have less money, so should I start trading in futures and options? Now it is not uncommon for someone just starting out to invest in the stock market to have little money to invest. Also, one may feel that they don't have enough money to invest and hence they won't be able to make a lot of money very soon. In such a scenario, people often turn to futures and options to make more money with little investment. But the fact is that futures and options were not created for this purpose. The primary purpose for futures and options was to serve as a hedging instrument for existing positions in the cash market. Futures and options on indices and certain stocks are often used for this purpose by individuals and institutional investors, but a lot of people also use it to take positional trades. It certainly has the advantage that the investor needs little upfront money to take bigger positions in the market. Investors can often take the same notional position by investing less than 20% of the notional money, depending on the margin requirement in place by the exchange. For example, if a stock future contract has lot size of 2000 stocks, that is buying or selling one future contract is equal to buying or selling 2000 stocks, and say the stock is trading at 100, and if the margin requirement, which is set by the exchange actually, and if that margin requirement is 15%, then you would only require 15% of 2000 multiplied by 100. This is just the quantity multiplied by price, so you only require 15% of quantity multiplied by price, which is equal to 30,000 in this case, in order to take a long or short position on 2000 stocks of a company. Now in the cash market, you would have required the entire amount, that is quantity multiplied by price, which would have been 2000 multiplied by 100 or 200,000. If you compare these two amounts, then you see that trading in the cash market requires more money compared to the futures market, even if you are taking essentially the same position. As the calculation here shows, by investing via the cash market, the ROI in case the stock price has moved 10% in your favor is also 10%. So your ROI is the same as the percentage movement in the price of the stock in your favor. So if the price moved by 10% in your favor, your ROI is also 10% if you are trading in the cash market. However, if you are taking the same position in the futures market, then this ROI goes up to 66.67%. This is only because the initial investment outlay in case of futures is lower, as you only need to deposit the margin money in order to take this position. This is why many beginners think of circumventing the issue of having low capital for investment by taking futures position. A person with 30,000 rupees can buy 20,000 shares using the futures contract, but would be able to buy only 300 shares if he was trading in the cash market. However, using futures is a two-edged sword, and while many investors only like to think about profits on their trades, it is much more important to take into account the possible loss on any trade. Take a look at the calculation here to see what happens in case the price of stock moves against you by 10%. As it is clear from the table here, using futures not only magnifies the return on investment if a trade works in your favor, but your losses also get magnified. Hence, someone starting with a capital of 30,000 looking to make quick money by trading through futures may also end up losing 2/3 of his capital if the stock prices move against him by 10%. In fact, it is more often the case that a beginner takes such a risk, loses most of his capital, and gets disenchanted with the stock market. If you are a beginner or an experienced investor with low capital, using futures and options is not an advisable solution to your problem of having low capital. The investor would be wise to exercise restraint and patience to trade within their constraints. We'll be covering the basics of futures and options concept in the next couple of lectures. Welcome back. Now in this lecture, we'll see what is a future contract, and in the next lecture, we'll look at what are options. So let's start with what is a future contract. Now a future contract is essentially a derivative instrument, or in simple words, it is a financial contract between two parties. Now one of the parties in this contract is the buyer and the other party is the seller. Now by entering into this contract, the two parties agree to transact a financial instrument. This financial instrument may be a stock or a bond, or alternatively they may agree to transact a physical commodity for future delivery at a particular price. Now while this definition mentions that the contract is for delivery of a financial instrument or commodity, it should be understood that the delivery is optional, and in fact most of the contracts do not end up in delivery of securities or commodity, but are actually settled by the way of cash. Now let's look at this and the fundamentals of future markets in greater detail. Now a future contract is a contract traded on exchanges, just like a stock is traded. Essentially, buyers and sellers place their bid prices and offer prices, and the exchange electronically matches this order and executes trade. So as far as actually executing trades in these contracts is concerned, it is not very different from what you are doing with stocks. What is different though is the nature of what you are buying or selling. So to understand the underlying concept of future, let's take an example. Let's say a bread maker enters a contract with a farmer for supply of grains at a fixed price at the end of the month. Now the farmer is obliged to deliver him the grains at the end of the month, and the buyer will pay him the fixed price decided in the contract at the time of initiation of the contract. Now if during the period from the time the contract was initiated to the time the delivery has to happen, now if during this period the price of the grain goes up, the buyer of this contract is insulated from the change in price, and this is essentially the essence of a future contract, and this is how it works in case of a commodity future contract. Now in case of stocks, just the delivery of grains is replaced by delivery of stocks, where the buyer of the contract is insulated from an increase in the price of the stock during the period. Since the future contract is a legal contract, everything is essentially specified in a standardized way in the contract. The exchange essentially specifies the details of the contract. In case of stock futures, the exchange specifies the name of the stock to be delivered, the quantity of the stock to be delivered, and the date at which the stock has to be delivered. Now, we said before that it is not necessary that there may be actual delivery of stocks or commodities at the expiry of the contract. This is so because there is an alternative to delivering the stock or commodity, which is known as cash settlement. Let's understand the concept of cash settlement using an example. If a future contract on a stock is entered between a buyer and a seller at a price of 10, whereby at the end of the month the buyer agrees to buy 1000 stocks from the seller at a price of $10. Now, if at the end of the month the value of the stock goes up to 11, the buyer has benefited from the contract since he is essentially buying a stock at 10 and the same stock is trading at 11 in the market. So from a buyer's perspective, if he were to immediately take delivery of the stock and sell in the market, he will make a profit of $1 on each stock. On the other hand, the seller of the contract is essentially at a loss from this contract since he is essentially selling a stock at 10 when the same stock is trading at 11 in the market now. If he wouldn't have entered this contract, he could have sold the same stock in the market at 11. So he is essentially making a loss of $1 on each stock as part of the contract. This is the case if he already owns the stock that he has to deliver. But if he does not already own the 1000 stocks that he needs to deliver as part of the contract, he will need to buy the stock at 11 from the market and sell it to the buyer of the future contract at 10. So he'll be incurring a loss of $1 on each stock. By performing all these actions, the seller of the stock is essentially losing $1 on each stock, or a net of $1 multiplied by 1000, which is around $1000. That is his loss on the contract. While in case of the buyer, by taking the delivery in the contract and selling the stock in the market, the buyer is essentially gaining $1 on each stock, or a net of 1000 into $1, which is $1000 in the contract. Now the easier way for both parties, which avoids all these cumbersome activities, is to essentially exchange this $1000 amount, whereby the seller directly pays to the buyer the sum he is losing on the contract. So he need not buy from the market and deliver to the buyer, and the buyer need not take the delivery from the seller and go to the market and sell these 1000 stocks in order to realize his profits. So essentially they can just exchange this sum of money, and this is what is known as cash settlement of futures contract. And the fact is, this is how most contracts are actually settled in the market. When it comes to actually trading the futures contract in stocks, we already discussed how by using futures contract you can implement the same view on a particular stock with lesser money. But as we have already mentioned, this is a double-edged sword, as both your losses and profits are magnified due to leverage. Now in the next lecture we are going to look at options, which is another popular derivative instrument. Welcome back. Now in the previous lecture we looked at one particular derivative instrument, which is the futures contract. Now in this lecture what we are going to do is we are going to look at options, which is another very popular derivative instrument. Now an option is a contract between the buyer of the option and the seller of the option that gives the buyer the option to buy or sell a security or a physical commodity. But unlike a futures contract, the buyer has no obligation to necessarily buy or sell the underlying asset. On the other hand, the seller of the option is obligated to buy or sell a security depending on the type of the option. So while in case of the futures contract, both the buyer and the seller of the futures contract were required to fulfill their obligation. In contrast, in options, only the seller of the option is required to fulfill his obligation. Let's understand the concept of option by using an example. Say you want to buy a diamond ring in 3 months' time. Now the price of this ring today is $35,000. You feel that the price of this ring may rise in 3 months' time, but since you don't have enough money right now, you cannot buy this ring immediately. Now let's say you negotiate with the seller that he gives you the option to buy the ring after 3 months at today's price of $35,000. The seller agrees to your deal but asks you to give him $500 as a price for this gesture of providing you the option to buy this ring in 3 months' time at today's price. Now consider two situations. Say the price of diamonds increase and the price of the ring after 3 months is $39,000. But since you bought an option to buy this ring at $35,000, you can now buy this ring at this price and it will save you from the price increase. So now you'll be saving close to $3,500 because of the fact that you owned an option to buy this ring at $35,000. Now the other situation is, what if the price of diamonds actually decrease and the price of the ring after 3 months is $31,000? Now since your deal was to buy the ring at $35,000 and the price in the market now is $31,000, you can forego the $500 option price you paid, and so you need not buy this ring by paying $35,000, and instead you buy the ring from another shop for $31,000. So by negotiating an option deal, you had the option to buy the ring without the obligation to do so. Now let's move towards formal terminologies and look at two basic types of option, which are called the call option and the put option. A call option is an option that gives the buyer of the option the right but not the obligation to buy an asset within a certain period of time at a certain price. The example on buying a ring we discussed before is example of a call option. By owning a call option, you essentially have a long position in the stock or the asset on which you have bought the option. The value of this option increases if the price of the underlying asset increases. Now another type of option is what is known as a put option. Put option is an option that gives the buyer of the option the right but not the obligation to sell an asset within a certain period of time at a certain price. By owning a put option, you essentially have a short position in the underlying asset which benefits if the prices fall. So from this it should be clear that actually there are 4 participants in options market of any asset. This is in contrast to the futures contract where there were only 2 participants, which is the buyer of the futures contract and the seller of the futures contract. In case of options, there are 4 participants. The first is buyer of the call option. The second is buyer of the put option. The third participant is the seller of the call option. And fourth and final participant is the seller of the put option. Now, as far as the buyer of the options is concerned, they are not obligated to buy or sell the asset. They will choose to exercise their rights only if it is profitable for them to do so. While as far as the seller of the option is concerned, they are obligated to buy or sell the asset if the buyer of the option exercises his right. Whenever the buyer of the option exercises his right, he'll do so only because it is profitable to him, which means the seller of the option will be at loss but still would need to fulfill his obligation. Since the seller of the option is obligated to buy or sell the asset on the wish of the buyer of the option, he is compensated for this in the form of option premium, which is paid to him by the buyer of the option at the time of initiation of the contract. If the contract expires and the buyer does not exercise his option because it is not profitable for him to do so, then in such a case the seller of the option keeps the premium, which essentially is his profit. This is the basic concept of a call option and a put option. Now for the benefit of new investors, we would like to emphasize that dealing in F&O is very risky, as it is very easy to lose entire money invested in these securities fairly quickly. This is so because of the kind of leverage employed in these instruments. Hence, as a new investor, it is best to stay clear from derivatives until you gain sufficient knowledge. See you in the next lecture. Welcome back. Now in this video, we'll address another question that is asked by many people. This question goes like this: where can I find good tips on the stock market? Sometimes they also ask, is there a good WhatsApp group where I can get good sure shot trade ideas so that I can trade and profit from it. Now it is common for inexperienced and experienced traders also, some of them who have had better experience, to look for stock tips so that they can make easy money. Now most people learn it the hard way, the futility of this search. Some learn their lessons only after losing a lot of money. If you are new to the stock market, your energies would be better directed in learning stock analysis instead of looking for tricks or shortcuts. These activities invariably lead people to scams looking to fool gullible investors. In order to demonstrate how easy it could be to fool a new investor, let's look at a technique that any person without any knowledge of the stock market can use to trap investors. Imagine a stock operator or a scamster with 200 contacts. Now he starts by dividing his 200 contacts into two groups of 100 each. He sends a buy signal to one group and a sell signal to another group on the same stock. Now since the stock price would either go up or down, one of his signals would obviously be correct. Now he takes the group that gets the right call and divides it into two groups of 50 each. Now one of these groups is again given a buy signal on a particular stock, and the other group is given a sell signal on the same stock. Now again one of the group gets the correct call because the stock price would either go up or down. Now he again takes the group that got the correct call and divides it into two groups of 25 each. Now one group gets a buy signal on a particular stock and the other group gets the sell signal on the same stock. Now again one of these groups got the correct call. So at the end of this process, the operator has a group of 25 investors who have got 3 consecutive correct trading calls, and now these people would think that the operator gets all his calls correct. So now this fraudster can actually try and sell his services to them, and let's say he might say that on my next call I'll be charging you this X amount of money. You have seen how highly accurate my calls are, so if you want my next call, then you need to pay so and so amount of money. And investors who are greedy, they might fall for this trap and end up paying him money in spite of the fact that this operator does not have any clue about what is happening in the particular stock or the stock market. Now the best way to avoid all such scams is to not look for quick money making ways. We'll also urge you to treat stock picks and stock tips performance reports with high degree of skepticism. Now of course we understand that many people might feel that they won't be able to invest in stocks on their own. Now it's a fact that many people find the activity of learning about the stock market and stock picking a time consuming activity. Also, every investor's hard work is not necessarily rewarded, and it is possible to not have much success in stock picking even after working hard. Now some may also find over time that they just don't have the knack for this activity. Also, it is possible that mere thought of incurring loss might deter some from executing on their analysis. Now whatever be the case, if you want to invest in the market and feel that you cannot do it on your own, you have the option to invest through mutual funds. There are a wide array of equity mutual fund products available to choose from based on how comfortable you are with risk taking. There are also products that invest your money in equities and yet ensure that you do not face loss of capital. These are commonly marketed as capital protection fund, and the returns for such funds are proportionately lower because they take much lower risk compared to a normal equity mutual fund. Mutual funds have another benefit that they provide a degree of diversification that may not be possible to achieve if you have less capital. For example, it is not possible to buy 30 blue chip stocks on your own if your investment is only $100. But with mutual funds, it is possible to achieve exactly this kind of diversification with any sum of money. This is so because mutual funds pool money from various investors and invest it on their behalf. So for example, if 100 investors want to invest $100 each, Then the mutual fund can invest $10,000 on their behalf, and with this amount, it would be possible to buy stocks of 30 blue chip companies to create a diversified portfolio. Since we have touched upon the topic of mutual funds, what we are going to do now in the next lecture is look at this topic in greater detail so that you develop a complete understanding on this topic. So see you in the next lecture. Welcome back. Now let's look at what are mutual funds, and later in this lecture we'll also answer as to why you should be investing in mutual funds. Mutual funds pool funds from various investors who have the same investment objective in order to create a corpus that is managed in accordance with the investment objective. So the investors from whom the money is raised should have the same investment objective, and so it makes it easy for the mutual fund to manage this corpus in accordance with the investment objective. Now each fund is managed by a fund manager who has an analyst team supporting him. This analyst team helps him in analyzing various securities. The fund manager's main responsibility is to allocate the funds from the corpus to various securities in order to maximize returns from investments. Mutual funds provide investors with the option of investing in an asset class of their choice. This asset class may be equity, debt, gold, or real estate. Now, any investor who is uncomfortable with directly investing in an asset class can choose to invest through mutual funds. Mutual funds allows the investor to invest in small amounts. Also, by investing in mutual funds, the investor can employ the services of a fund manager to make investment decisions related to choosing securities on a cost-effective basis. Fund managers essentially make decisions related to security selection, timing of mutual funds, review and rebalancing the portfolio periodically, and also executing certain operational decisions related to mutual funds. Mutual funds are not only a good investment vehicle for those with little knowledge about security analysis, but also for those who are comfortable with security analysis. This is because equity mutual funds provide greater diversification benefit for investments with smaller amounts. Also, even if one may be comfortable with investing directly in equities, one can still use mutual funds to invest in other asset classes like debt, gold, or commodities. Hence, mutual funds are a good option for both beginners and seasoned investors. Welcome back. Now in this lecture we are going to look at what are corporate actions. Let's start by defining what is a corporate action. Now corporate actions are actions on the share capital of the company that has a direct impact on the shareholders. Now these actions are proposed by the board of the company and approved by the shareholders. At times, companies also require the approval of market regulators before these actions can be implemented. Now corporate actions can broadly be divided into two categories. The first category is one where the company shares the surplus profits of the company by paying dividends or buybacks, which are also known as share repurchases. The other category of corporate action is one where changes in capital structure takes place through issue of bonus issue, rights issue, or mergers and acquisitions. Let's look at the different types of corporate actions one by one. Starting with dividend. Now dividends are portion of profits of the company received by its shareholders. Now a company may declare dividends more than once in a financial year, but they are allowed to declare dividends only out of the profit and loss account of the company and the profits of the year in which the dividend is being paid. So a loss-making company cannot declare a dividend. In case of the dividend, it is the board of the company who recommends the dividend, and this dividend requires further approval from the shareholders of the company. The next corporate action we'll look at is buyback or share repurchase. In a share buyback, the company buys some of its share listed on the stock exchange. Now the company buys these shares from its reserves and surplus on its balance sheet. The shares bought back are extinguished by the company and leads to reduction in its share capital. Since shares bought back are extinguished by the company, so the number of shares outstanding are reduced. This essentially leads to an increase in earnings per share for the remaining shareholders as their percentage shareholding in the company goes up. In order to be eligible for share buyback, the company should not have defaulted on interest payment, loan repayment, or dividends. Now the next corporate action we'll look at is a bonus issue. A bonus issue of shares is made to the existing shareholders of the company. As part of the bonus issue, the existing shareholders receive new shares in a certain proportion at no extra cost. For example, if the company declares a 1:3 bonus issue, this would mean that each existing shareholder will receive one extra share for 3 existing shares held by them. A company is eligible for bonus issue only if it has not defaulted on its interest payment or dividend payment or loan repayments. The next corporate action is rights issue. Now rights issue involves giving existing shareholders the first right to buy new shares issued by the company. Whenever a company decides to issue new shares in order to raise capital, it would affect the existing shareholders adversely. This is so because the action of issuing new shares reduces the percentage shareholding of existing shareholders. In order to avoid this, companies go for rights issue to existing shareholders so that if they want, they could buy the new shares before they are offered to others. In case the investors do not want to buy more shares, they can sell their right entitlement to others. In order to facilitate this, right entitlements are traded separately from the shares of the company. The last corporate action we'll discuss is mergers and acquisition. Now mergers and acquisition involves buying, selling, dividing or combining of different companies and similar entities. This action helps an enterprise to grow rapidly in its own sector or a completely new sector. Mergers are legal consolidation of two companies into one entity, whereas acquisition occurs when one company takes over another and completely establishes itself as the new owner. In general, merger of two companies results in creation of a new entity, while acquisition results in one company buying the other and no new company is formed. Now that we have covered some basics of corporate actions, in the next lecture we are going to cover some important dates associated with dividend and corporate actions in general. So see you in the next lecture. Welcome back. Now in the previous lecture we looked at dividends, which is a way for companies to share a portion of their profits with their shareholders. Now in this lecture we are going to look at some important dates associated with dividends. Now we'll list the important dates with respect to dividends one by one. The first important day is the dividend declaration day. This is essentially the day on which the board of directors announce that the company is going to pay a dividend. They also announce the quantum of the dividend and also the record date for the dividend, which brings us to our next important date associated with dividend. Now record date is the date on which the company looks at the shareholding records to determine the shareholder who will be receiving the dividend. The investor's name must be on the records on this date so that he can receive the dividend. In order to ensure that his name is on the records, the investor may need to be holding the shares 2 or 3 days before the record date. Now whether he should be holding the shares 2 days before the record date or 3 days before the record date depends on the settlement cycle in the country in which the stock is listed. Also, we'd like to mention that while we have defined the record date with respect to the dividends, record dates are actually applicable to all corporate actions. So for example, if there is a bonus issue, again there is a record date associated with the bonus issue which is used to determine which investors are eligible to receive the benefit due to the bonus issue. So record date is not just applicable to dividends, but it is associated with almost all corporate actions. The next important date associated with dividends is the date of actual payment of dividend. So this is essentially the date by which the company intends to pay out the dividend to those shareholders who are eligible to receive the dividend. Now the company declares this date, and this date may be a week or more after the date of record, so that the company has sufficient time to accurately pay dividend to all those entitled to receive dividend. Now let's look at an example to understand all these terminologies a bit better. So now let's look at an example with respect to dividends. Now in this table you see that the ex-dividend date is the 15th. So anyone buying the stock on 15th would actually not be eligible for receiving dividends. Hence, in order to receive the dividend, one needs to be the owner of the stock on 14th. So if the ex-dividend date is 15 and you happen to buy the stock on 15th, you won't be receiving the dividend, but instead the person who sold you the stock would be receiving the dividend. Now if the exchange follows a T+2 settlement, this would mean that the transaction would be settled in 2 days and the records will be updated in 2 days. In such a scenario, the record date would be 1 day after the ex-dividend date, as this way anyone buying the stock 1 day before the ex-dividend date will be the shareholder as per the records on the record date. On the other hand, if the exchange follows a T+3 settlement cycle, then the record date would be on 17th, which would be the second day after the ex-dividend date. And again, this is so because anyone buying the stock 1 day before the ex-dividend date will be the shareholder as per the records on the record date only if the record date is kept 2 days after the ex-dividend date. With this, we have covered all the important dates associated with dividends.